Welcome to the European market open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
And here are your top stories. However, the outlier, the BOJ resists the global wave of central bank tightening, sticking with super easy monetary policy and hitting the yen again. Wall Street crushed, the rout resumes, driving the S&P 500 to the lowest level since 2020 as recession fears return. But futures limp higher even as Treasury yields rise. Plus, capping spreads, ECB President Lagarde tells officials that the bank's new crisis-fighting tool will protect borrowing costs for weaker Eurozone nations.
Tom, if you look at the futures, look, they're stabilizing somewhat. U.S. futures are certainly a bit more stable than we saw yesterday with that huge round. But again, there's not much conviction. So I think they're just waiting to have a bit more, I guess, news from central banks on whether there's a real risk of recession to decide whether they go higher or lower.
Yeah, that indecision, as you say, that lack of direction, that lack of conviction within these markets after a heavy day, as we said in the headlines, of selling. The Nasdaq ended lower by around 4%. The S&P 500, Dow Jones, all very badly hit as investors, as Francine was saying, reassessed the risks of recession as central banks around the world moved to more hawkish positioning. Apart from, of course, the BOJ reiterating its commitment to that ultra-dovish policy, yield curve control, even as they highlighted their concerns about the pressure on the yen. The CAC 40 over in France pointed to gains, looking at gains now, 0.3%, just up 20 points. You do have the politics of France back in focus this weekend with the second and final round of parliamentary elections, what it will mean for President Macron and his abilities to push through his reform agenda. The FTSE 100 gaining 0.2% after BOE, as expected, hiked by 25 basis points. The market's now pricing in around 50 basis points for the next meeting. 5 straight hikes in a row for the Central Bank of the United Kingdom. The Spanish IBEX gaining 0.2%. Over in Italy, some relief then in Italian bond yields. We'll look at that shortly on the back of that announcement, or not announcement, the information that Madame Lagarde gave then to finance ministers around how this crisis tool would be deployed, gaining around 0.2% on the FTSE mid. Let's switch it over, see how things are shaping up then across other assets. We'll look, of course, at the Bloomberg Dollar Index as well. It remains bid in the session today, 0.7%. So that safe haven move. The Nasdaq futures looking at gains of 0.7%, but nowhere near making up the losses that we saw yesterday as things stand. Of course, the Italian BTPs remain central to what's happening this week. 3.73 on the Italian 10-year. Not a lot of movement, but there was some relief, of course, on the back of that announcement that the anti-fragmentation tool would be deployed specifically for weaker nations in the Eurozone, like Italy, if those yields do blow out. Below that 4% level that, of course, triggered concern, it seems, for officials at the European Central Bank, 3.73 on the BTPs. Francine.
Yeah, that's, of course, a significant, huge story. But then we also have an interview, I think, from the Germans in the FT saying, look, they're not too worried about widening spread. So it's unclear at what point some kind of mechanism where these new tools will be triggered. If you look at, of course, some of the sectors. So first of all, there's some breaking news, I think, on Gazprom. And I would watch out for gas on those on the back of really strong words from Germany. And Italy yesterday is saying that actually there is not a problem with Gazprom. It's just that Vladimir Putin is actually weaponizing it. In terms of the sectors on the upside, we have auto parts, we have banks, we have real estate amongst the biggest gainers, and then energy and utilities, and also basic resources down. But they're down about 0.3%. And then NE says, for example, Gazprom will supply around 50% of gas requested for June 17th. So again, I think this is probably one of the most significant stories, Tom, is that if Russia decides to turn off the taps, suddenly what what does Europe do? Do we go into plan B and choosing what sector can use energy or not? And that, of course, would probably put extra pressure on the markets.
They've been trying to build out resiliency within Europe. They have some way to go, as you suggest, if indeed we did get to that point. But Russia weaponizing, arguably, again, its gas supplies to the continent this week. The other commodity story that's in focus for us, particularly on today, is iron ore. The pressure on that commodity, that's reflecting in the basic resources that Francine highlighted there on concerns around China, the demand picture, COVID zero. Every single resident in Shanghai to be tested on a weekly basis. Glencore, different story though. Sales for the first half expected to be very high indeed. Record levels. In fact, they could be posting more sales in the first half than they do in a typical year, gaining 1.8%, 1.9% on the London-listed mine at Glencore. When it comes to Tesco's, concerns about changing consumer habits have been flagged by this business, this retailer, of course, down 0.3% around the inflation picture. Continue to watch that after their numbers came in below the estimate. Santander, you've got a new CEO. The name has come through. Alvarez will be stepping down. Is expected, the new CEO, to take over in January, early January 2023. That bank gaining 0.9, almost 1% on the back of that move. Right, and that news. Let's get over to Bloomberg MLive managing editor now, Mark Cudmore, for his analysis on all of these market moves. The BOJ was front and centre for today, and I know you've been unpicking what we've been hearing from Kuroda. Mark, what is on your mind at this point?
Well, Tom, it's been a very tough week for stocks out there. And because of that, I think we're having a great amount of rhetoric around the idea that recession risk is increasing. I actually think the probability of recession in the US in particular has not changed at all this week. We are always going to be heading for a recession. It's just a matter of when it comes and how deep it'll be. And I still think it's probably next year, not later on this year, but we're definitely going to get one at some point. To me, recession talk's a little bit of red herring. This week's been about financial conditions. We've seen a very, very aggressive tightening of financial conditions. So this is the Bloomberg US financial conditions chart. When the line falls, that's a tightening of financial conditions. So you can see we're down now at the lowest level in the last year, in fact, the last couple of years, in a really, really sharp adjustment. And that's weighed on stocks. But if you put this on a longer term time span, if you put this on a going back over the last 25 years, you can see that this correction is really nothing yet compared to what we saw in the financial crisis, during the pandemic, even back in 98, the early 2000s recession, even in 2012 where we didn't see a recession. And given that we're seeing the worst inflationary environment for many, many decades, I think financial conditions need to tighten aggressively much later this year. So I guess my point is that overall, over the next year, we're going to see financial conditions tighten much, much further, and therefore we're going to see much, much more pain in stocks. One other chart very, very quickly. Bloomberg Financial Conditions Plus Index includes a speculative component, tells the exact same story, but makes it even more clear we still have extraordinarily easy conditions. We really shouldn't. That's bad news for stocks later on this year.
Okay, more pain ahead for stocks. That is the take from Mark Cudmore after, of course, a volatile week. Bloomberg's MLive managing editor. Now, the ECB's Christine Lagarde has told euro area finance ministers about the bank's plans to limit bond spreads if borrowing costs for weaker nations rise too far or too fast. That is according to people briefed on their discussions. Joining us now is Bloomberg's Lizzie Burden. Lizzie, tell us more about this new anti-crisis tool, what we learned then from this briefing by Madame Lagarde to the finance ministers of the Eurozone.
Well, Tom, the whole point of this tool is to stabilise market movements when the ECB does hike and lift off for the first time since 2011. And it's the weaker nations that the ECB is concerned about in these times of financial turbulence. So what Madame Lagarde said yesterday was that if bond spreads widen past a certain threshold, or if market movements speed up past a certain level, that's when this tool will kick in. But she didn't say whether those limits are going to be made public. The whole point, though, is to prevent the flaws in the euro area's weaknesses being exposed.
So Bank of England, Lizzie, let's get back to that. The central bank only went for 25 basis points, but actually what's being priced in the markets is aggressive moves.
Yes, because yesterday's decision is being seen as dovish, but the guidance as hawkish. They only went for, I say, 25 basis points because the context is the bank has never gone for 50 basis points before. This was already the 5th straight hike. That's unprecedented for the BOE. And let's not forget, the bank was the first out of the gates to tighten among its major peers. But really the reason why 6 of the 9-member Monetary Policy Committee didn't want to do more is they're concerned about this recession in all but name in the UK. The economy is contracting, consumer confidence is low, the housing market's slowing, and really they're not as optimistic about the resilience of demand as the other 3 members of the committee who went for 50 basis points.
Lizzie, thanks so much. Lizzie Burden there with the very latest on some of the central bank moves. Now, Alex Brazier is deputy head of BlackRock Investment Institute, and he joins us now. Alex, I guess, first of all, good morning.
Good morning.
I guess the concern is that if you have someone like the S&B that doesn't have that much skin in the game in terms of inflation, and they hike by 50 basis points, is the Bank of England, have they relinquished control because they had that first mover advantage?
Well, I think the bank's in a slightly different position, but take a step back. All central banks here are in a common position in that they face not just high inflation driven by food and energy prices, but actually quite high and stubborn core inflation as well. And why is that? Well, that's symptomatic of something deeper, which is an imbalance of demand and supply in economies. And unusually, it's not to do with unusually high demand. It's that we've got impaired supply capacity across all major economies coming out of the pandemic restart. So we're in this world shaped by supply, and that puts them all in this pretty invidious position. They either have to slam the brakes on the economy, or they have to live with more persistent inflation. And I have a lot of sympathy for them. They have a more difficult job than I ever did when I was in a central bank. But some of them, like the bank, have acknowledged now that they need very weak growth or a recession to get inflation down again. But what's different, I think, in the UK is that other forces are going to do the bank's work for it. And so they're striking this balance here between thinking they need a recession to get inflation down. They're probably right about that. But they're going to get one anyway. And that's why what markets are pricing at the minute for the Bank of England, in our view, looks overdone.
Looks overdone. So it's still the BlackRock view that central banks are going to have to they will adjust to living with higher inflation, higher and above target inflation, because it didn't seem this week that that is the direction of travel. Jay Powell's very clear, inflation, 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 getting it back down to that 2% target.
I would make a distinction between the ECB and the BOE on the one hand, who are determined to get inflation down, have acknowledged that it will take a recession or very weak growth to do it. Other things will probably do their work for them to some degree. The Fed is in a different position. It hasn't acknowledged the trade-off it faces, this kind of invidious choice. And so it's dead set on raising interest rates this year to restrictive levels. The interesting thing isn't so much now what happens this year, it's, as an earlier speaker was saying, what happens next year. And this year, the Fed's responding to the politics of very high current inflation. It's determined to raise rates in response to that. But imagine what things look like in December. Financial conditions will have tightened materially. Europe probably will be in or very close to recession, spilling over to the rest of the world. And as a result, we're going to see a very severe slowdown, possibly recession, certainly rising recession risks in America. And the politics of current inflation at that point will give way to the harsh economic realities of what happens when you raise rates. The Fed will probably do what it did in 2018 and reverse course, because remember, it hasn't acknowledged that it's looking for a slowdown here. As a result, we're probably in for a bumpy ride, a roller coaster rate profile, a growth slowdown, and at the end, living with more persistent inflation as well.
But Alex, so you were actually also in charge of the UK forecasting team at the Bank of England until 2011. Why did we now get it so wrong? Is it much more difficult to see some of the shocks because of COVID, or is it something in the data that is so antiquated that it just is not working?
Well, like I said, I do have a lot of sympathy for them here. What's unusual, and this is a marked shift in the regime we've been used to for decades now, is the sheer scale of the apparent supply shock that we're facing. You know, when you look at where core inflation is, it must imply a very big impairment of the supply potential of the economy. And that's really hard to measure, possibly impossible to forecast. And so the only way you can get there is by knowing where inflation is. So you only find out after the event. You're driving with only a rear view mirror. And that's what makes it so difficult. But it's also what puts them in a very difficult policy position. And they have to acknowledge that they either have to live with more persistent inflation or slam the brakes, have very weak growth, possibly recession, in order to get inflation down again.
How concerned are you about the Eurozone? And how much comfort do you draw from this anti-crisis, anti-fragmentation tool that officials we know at the ECB are still building out?
Some comfort, but I wouldn't go all the way there. And I go to this point about, the work for the Bank of England is going to be done partly by higher energy prices, squeezing real incomes, driving the economy probably into recession in any case. In Europe, we will see higher energy costs squeezing real incomes. It's coming slightly later. But in addition, we are seeing, and we will continue to see, even with the best will in the world with the new tool, we will see much tighter financial conditions in the periphery. Put those two things together, and a lot of the ECB's work is being done by the end of QE and higher energy prices. As a result, a bit like the sterling curve, we think the market expectations of ECB rate rises in the short term are also overdone, even though the ECB, unlike the Fed, has acknowledged that it needs some sort of recession and growth slowdown to get core inflation back down again.
Okay, Great analysis. Alex Brazier, Deputy Head at BlackRock Investment Institute. We'll get more calls from Alex in terms of positioning in these markets after the break. Francine.
Yeah, coming up, don't miss our exclusive interview with the BOE Chief Economist, Hsu Pill. That's, of course, on the latest MPC decision. I think it's the first official to come on TV, on the record, to talk to us about it. It's at 10:30 a.m. London time today, and this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Global economy is at a turning point. Will the inflation continue so strongly, and will the central banks be able to slow it without creating a recession? I am optimistic, so my answer would be yes.
Even if there is a recession here or there, and there has been recessions in the past, I'm pretty confident about the ability of the beauty industry and of L'Oreal to be totally resilient in whatever the context. And that's what we see today. Today, the beauty market hasn't slowed down a bit versus 2021. We see that consumers want to socialize after 2 years of lockdown.
We also know that for employees, and 60% of them told us that globally, that their number one concern is how to keep their purchasing power. How can you do that as an employer? Obviously, you have to raise the salaries, but sometimes you are not able to cope with the pace of inflation. So you have a digital solution. It's a Edenred solution, access to 250 different programs of benefits where you give money in benefits. It's very well appreciated by the employees.
Okay, the CEOs there of LVMH, L'Oreal and Edenred speaking to Bloomberg about pricing power, margins and inflation at VivaTech at the conference in Paris. Still with us, Alex Brazier, Deputy Head at BlackRock Investment Institute, after, of course, a tumultuous week for these markets and central banks. Alex, you were talking about your expectations that at least in the first half of next year, there could be at the very least a pause from the Federal Reserve as they wake up to the potential recessionary impacts of further tightening and maybe maybe a slowdown in Europe and other parts of the world. What does that mean for portfolios and the way that you are looking at investing? We spoke to Wei Li earlier this week, the esteemed Wei Li of BlackRock. Of course, she said we are hunkering down at this point.
Yeah, I mean, Wei is much more esteemed than I am, so I'll try and build on that. I mean, the main point is that we are not buying this dip because it's not a dip. It's actually driven by a shift in the fundamentals of the equity market. We've got a higher rate path. We've got now a rising probability of recession in the US, very high likelihood of recession in Europe at the same time. And as a result, equities don't look cheap to us. And when you throw in as well that margins, particularly in America, are at an all-time high, real wages have been squeezed. That's the flip side of those high margins. And one of the things that needs to happen in the United States coming out of the pandemic is labor supply needs to recover. And the thing that's going to drive an increase in labor supply is an increase in real wages. So one of the things that's going to help the US to sort out its macro position is actually something that's kind of macro bullish but micro bearish.
So what does that mean? You go to cash?
No, I think there are other opportunities out there. I talked before about the opportunities at the short end of the European and sterling markets. I think also we see opportunities in credit now as well. Credit has repriced. Valuations look more attractive than, say, equities, and the yields have now increased. So this isn't a market where you come out necessarily into cash, but it is a market where we're more cautious. We're looking for signs, particularly from the Federal Reserve, over time, that it is acknowledging the impact it's having on growth. And as I said before, we think the interesting thing is what happens in the first half of next year when the Fed sees what this tightening of financial conditions has done and sees it slowing growth more than it thinks is necessary to actually get inflation back down again.
You came on in April and you called it right on the energy markets. You spoke to Francine, you said, I see further tightness in the energy markets. We are still tight, and the expectations from the from OPEC and the IEA is that will continue. How do you invest around that proposition? Because many people come on and say energy along with healthcare is a place to find some shelter here. Do you want to be positioning around the energy markets?
Yeah, I think so. I mean, like I said back in April, we see persistently tight energy markets and volatile because the underlying structural issue here is the West, particularly Europe, weaning itself very quickly off of Russian energy supply. You talked earlier about the risk now that Russia cuts off gas supply to Europe, which is a very serious economic risk. The ECB talked about it in its most recent projections. That means that we're going to see scramble for alternative sources of supply in the West. We're seeing the US begin to increase production, but still it's these very high prices that are needed to bring that on. For that reason, energy, commodities, all going to be in short supply and therefore offer investment opportunities.
China's property sector is under extreme stress and we're seeing defaults. Is this the year where we're going to see a China crisis?
Unlikely. And I say that because for two reasons. One is the COVID crisis at the minute is, of course, slowing Chinese growth this year. We're talking 3.5 for calendar year growth now. But remember, that's a shutdown, not a recession. It's going to restart next year. The key thing to watch there, by the way, is whether China is successful in vaccinating its elderly population to open up the possibility of a restart. I think, though, the authorities still have quite a number of tools at their disposal, but will they hit their 5% growth target in an environment where the world economy is slowing, demand for Chinese exports is falling as the US economy rotates back towards services? Also unlikely.
Alex, thanks so much for joining us. Alex Brazier there, Deputy Head at BlackRock Investment Institute. Now, coming up, the European Commission plans to recommend Ukraine and Moldova be granted EU candidate status. We'll have the details on that next. This is Bloomberg.
thing we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
You have to hold crypto in context what's gone on macro, right? And we talked about there were going to be headwinds this year because the Fed was going to have to withdraw liquidity. And so assets that went up based on cheap money forever, if they're growth stocks or expensive watches or crypto, were certainly under pressure all year long. What's exacerbated this move in crypto is a bunch of leveraged players that had far more leverage than I think people thought. And so you can talk about Celsius or 3 Hours Capital. That's caused almost something similar to what happened in 1998 with long-term capital management. Alleged, market neutral players with monster leverage, and that's being unwound. And that's created a ton of fear in the space. And so you've seen lots of credit being withdrawn from the space. And when credit's withdrawn, you've seen prices collapse. And so I had hoped this year was 30,000, 50,000 Bitcoin. And once we took out, 30,000, 28,000, we've cascaded. 20,000 is a pretty good target with 1,000 on Ethereum. We've tested that 2 days. When I look at the US stock market, it looks like it's got probably 4% more to go to 3,500, which is where the 200-week moving average is, where support comes in. And I think you're seeing this liquidation of risk, and crypto's gotten caught up with it.
Mike, tough question, but did you directly have any sort of exposure to those counterparts that you mentioned, the likes of Celsius, the likes of 3 Arrows, or is it more third order effects that you gain the exposure, and is it systemic?
Yeah, you get exposure indirectly from any big player in the space, right? And when you have really big players that have borrowed money from all over the place, it creates this daisy chain effect. And I think that's burning through the system right now. My sense is it's mostly burned out. Like these fires go until they run out of oxygen. And so, you'd have to be one heck of a diamond-handed player to have sustained all of this if you have too much leverage. And so my guess is leverage has been knocked out of the system. But Humpty Dumpty doesn't, get put back together right away. It takes a while to kind of sort through. There'll be bankruptcy proceedings in many companies. And so I think while we should bounce off of 20,000 and bounce off of 1,000, it's going to take a little while for crypto to regain a narrative and regain confidence.
Galaxy Digital CEO Mike Novogratz. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Ever the outlier, the BOJ resists the global wave of central bank tightening, sticking with super easy monetary policy and hitting the yen again. Well, Wall Street crashed. The rout resumes, driving the S&P 500 to the lowest level since 2020 as recession fears return, but futures limp higher even as Treasury yields rise. Plus, capping spreads, ECB President Christine Lagarde tells officials that the bank's new crisis-fighting tool will protect borrowing costs for weaker Eurozone nations. Now, Tom, if you look at the markets, I mean, they're kind of rising, but without any big conviction, really.
Yeah, you talked about the lack of conviction at the top of the Dow, and that's right. That's what's been reflected, really, in these markets after that significant sell-off yesterday on Wall Street. The Nasdaq ending lower more than 4%. The S&P getting back to kind of December 2020 levels. So that significant pressure on equities in the US yesterday. Today, across the European space, you're seeing gains of just 0.4%. Again, a lack of conviction, as Francine was saying. 66 points of the gains you're seeing in Germany, just gaining 0.5%. Madame Lagarde then giving some more details to finance ministers about how this anti-fragmentation tool will be used to cap the yields of weaker nations like Italy. In fact, the last time I looked, Italian BTPs were coming off about 4 or 5 basis points on the yield. So FTSE 100 just getting 0.1%. Basic resources proving something of a drag. We'll see that when we break out the sectors shortly. Let's do that now as we come towards the end, of course, of a very volatile trading week. The central bank's front and centre. The Bank of Japan, as Francine was saying, committing to that ultra-dovish policy, not walking back from that, Kuroda, at least for now. Top of the list when it comes to these sectors is travel and leisure, despite the turmoil that we've seen there in Europe. We're going to unpack that story in the next 10, 15 minutes or so. Retail is getting 1.2%. You've got 4 sectors currently in the red, led by energy and basic resources. Iron ore is under pressure. Around 4 to 5% drop you've seen in iron ore on concerns about demand out of China. On the corporate stories, one of the most interesting one, and it has been for a number of months, is, of course, Twitter. And Elon Musk has held his first meeting with Twitter staff since agreeing to buy the company for $44 billion in late April. The world's richest person told workers that people should be allowed to tweet, quote, pretty outrageous things. Joining us now is Matt Bloxham, senior analyst at Bloomberg Intelligence. Matt, what did you make then of the discussion that Musk had with potentially his future employees?
Yes, about a 45-minute discussion, which he did over a smartphone, I think, from a hotel room. So quite interesting. I guess, there was a lot said about what he wants for the future of Twitter as a business. But unfortunately for investors, nothing really about whether he's actually going to go through with the bid or not. And certainly, if he is, at what price. And I guess if you look at the current Twitter share price below $38 against that $54.20 offer price, the market's still anticipating that if he does do the deal, it's going to be a significant discount to that original bid price. But, a fascinating kind of discussion he had with employees, talked about work from home, talked about, maybe getting to 1 billion users of the service over the next 10 years, which would be a 4x increase.
I have to say, man, it was a bit rough, wasn't it? It was like, guys, don't worry. You don't have to worry about your job as long as you're an exceptional worker. All right, but Elon Musk, never dull. He's also been hit by a lawsuit accusing him of allowing a toxic workplace culture to fester at Tesla.
That's right, and well, I guess maybe not that much of a surprise because I mean the US market's quite litigious. You know, it's kind of sue first, ask questions later. So whether there's any merits to this or not, who knows? I mean, there have been a lot of noise and investigations around practices at Tesla, so there probably is something there. And obviously, in May, Elon Musk said that Tesla was going to be hiring a crack team of lawyers. So perhaps he's been anticipating some of these things coming their way. So you know, impossible to say whether there's any merit to this case or not. But not surprising given it's the US market and how far share prices have fallen that lawsuits are flying.
Okay, Matt Bloxham, senior analyst at Bloomberg Intelligence on the litigation facing Musk, some of his businesses, and the conversation we had with the employees of Twitter.
Now, the leaders of France, Germany and Italy are backing Ukraine's candidacy to become a member of the European Union. Emmanuel Macron, Olaf Scholz and Mario Draghi pledged their support after traveling by overnight train to the capital. A visit they say was aimed at sending a message of unity and unconditional support for Zelensky and the Ukrainian people.
Ukraine belongs to the European family. A milestone on its precondition-rich path is the status of an accession candidate. The EU member states will be discussing this in the next few days. We know it needs unanimity among the 27 EU states. At the European Council, I will push for a unified position. Germany is in favor of a positive decision in favor of Ukraine.
To this purpose, I want to say today that the most important message of our visit is that Italy wants Ukraine in the European Union. And it wants Ukraine to have candidate status, and it will back this position in the next European Council meeting.
We will stand by Ukraine to support it in this European perspective, as we agreed at the Versailles summit. And this is what we reiterated to President Zelensky.
Well, joining us now is Bloomberg's Berlin bureau chief, Birgit Jennen. Birgit, so what's been achieved with Scholz, Draghi's and Macron's visit to Ukraine?
Well, it is a very important signal that the three European leaders, Scholz, Macron and Draghi, are backing basically the EU candidacy status for the Ukraine. This has been in the discussion for years, so that it is now coming sort of in the middle of the war is obviously a clear signal also to Putin. We don't have to expect that this is now going to have an immediate impact on the war, but it is more also a signal for the Eastern European countries that basically the EU is not divided and will stand up if Putin really plans to go further in the coming years.
Birgit, and a story that was significant but was somewhat overshadowed by all the central bank action was that cut by Gazprom of supplies to Europe. What are your sources in Germany telling you about the depth of concern and how much is being put in place to try and shelter Europe if indeed Gazprom and the Russians go further?
Well, we have seen over the past days that Russia has already substantially cut back gas. So the level of concern, obviously, in Berlin is sort of alerted and high, and they have said that while at the moment Germany's gas supply isn't in danger, or basically there is still sufficient gas, but they are watching this very, very closely on a day-to-day level. And we do have to see that really this current the backing of the EU member states for Ukraine accession is a political move from the European Union, which will be watched very closely in Moscow. And we have heard from the German economy minister, Habeck, that the gas moves have been motivated politically. So we have to see how Putin is now going to react to the EU opening up the perspective for the Ukraine to join the EU.
Okay, continuing to watch those gas flows into Europe on the politics, of course, and the geopolitics of Ukraine and Russia. Birgit Jennen, of course, Bloomberg's bureau chief over in Berlin. Thank you. Now, coming up, retail traders look under the hood of the ESG commitments of big funds. Bloomberg looks into how one investigation is tarnishing the halo of the industry. This is Bloomberg.
about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Welcome back to the Open, everyone. 40 minutes into the European trading day, and you can say we're talking about these markets being without conviction. I have to say they're kind of oscillating. It's a big word for a Friday. You know, they're between gains and losses. They're now down 0.2%. They were gaining by a similar amount a short while ago. They look at central banks and the risk of recession and try and figure out what that means for their portfolio building. Now, ESG has become a punching bag for the far right, for disgruntled corporate executives, and even industry insiders. That's according to a Bloomberg Quick Take. Retail investors are slowly starting to look under the hood of the $40 trillion ESG industry. That's increasingly steering their savings, and many are not liking what they see, Tom.
Joining us for more, Bloomberg's managing editor for ESG in EMEA, Tasneem Broga. Tasneem, what do we know then about the redemptions that we've seen, the outflows? What is triggering? What is behind the souring mood on ESG?
Yeah, thank you. Good morning. So there are a couple of things that are just important to note about ESG at the moment. During the pandemic, ESG funds were actually comparatively resilient. But this year, they've seen a bigger dent to flows and returns at any point during the pandemic, and that distinguishes them from the rest of the market. And that's largely due to the fact that a lot of ESG funds that have tended to be successful in the past have relied heavily on tech, which is obviously having a really bad year so far in 2022. The other thing that's noteworthy is something that's put eloquently yesterday at an event in Zurich by Claudia Bolli, who's the head of responsible investing at Swiss Re. So in her words, she said, it can be a little bit easy to do ESG or sustainable investing when markets are going up, but it's a different conversation when they're going down. And we've got high inflation, we've got rising interest rates, we've got a bear market, we've got a cost of living crisis, we've got a war in Europe, all of which means that investors are just laser focused on returns, which at the moment are coming from industries like commodities and energy. We just look at Glencore this morning. But the other thing is then the regulatory framework, where Europe just wants to steer capital toward a more sustainable economy. So ignoring ESG in the long term is a pretty risky undertaking.
And so, Tasneem, I was going to ask you actually about regulation and regulatory environment. How exactly will it shift, and what will it shift to?
Well, I think, again, with regulations, there's just a really sort of important thing to note first, is that what we're hearing from asset managers and from their lawyers is that ESG regulations at the moment they're just overwhelming. And that's actually increasingly understandable. Like, we've got the Sustainable Finance Disclosure Regulation in Europe. That was already a mammoth rule book when it was passed or enforced in March last year, but it's continually being updated. And that just means that the industry has to devote huge resources to coping with what are really just like fiendishly complex regulations. But the other thing that we've noticed is that regulators aren't necessarily giving the industry any kind of grace period to adapt to these regulations, as evidenced by, we've got the Goldman probe that was broken on Friday last week, and we've had the stunning sort of scenes of a police raid at the offices of Deutsche Bank and DWS. So there's clearly sort of a step up in the regulatory heat.
Okay, a moment of reckoning potentially for the ESG space. Tasneem Broga, thank you for breaking down what is going on. Let's get more details now on analysis and reaction with Eric Peterson, Head of Responsible Investments at Nordea. Eric, good morning. Thank you for joining us. What is your take then on the outflows that we've been seeing, those regulatory challenges? But let's focus on the outflows for now and whether you are getting any sense that that is starting to turn, or does it not turn until the broader markets and you get a clearer sense on things like inflation and where the central banks are heading? What is, for you, the key catalyst behind the ruptures that we've seen in the ESG space?
I'm actually not sure that these outflows are larger than they are from the industry in general, because a lot of people are fleeing to safety, as it were, in these markets. But I think it's true
Eric,
that
we had the biggest ever monthly redemptions from ESG funds in May, right?
And that's the U.S. and I think redemptions in general from retail funds were also larger than you normally see. So still. But I agree that it's a challenge when you've made promises, if you've made promises that the ESG would always outperform, and to us that's always been something that we've been very careful with. Clearly, when you have an environment like the one right now, where oil and gas are outperforming, defense are outperforming, tech is not doing very well, then that shows that there is, yes.
So where is that? So money's taken out of the ESG to be put where? Do people not believe in the transition? What is the concern out there? Do they worry about greenwashing, or that it just doesn't deliver the returns?
I think most of it is driven both by allocation really out of the market, and then also towards investors looking for short-term returns who maybe, how should we say, were not that committed to begin with, were in there because these funds had a long streak of outperformance relative to other parts of the industry. And now, as they're being challenged by the rallies in these sectors that you typically don't own in ESG funds, then you see some money being moved, or maybe actually just some inflows being less, and therefore the normal outflow that you have, the circulation back and forth, showing through this way.
Where are we, Eric, in terms of the education of retail investors around the ESG space? What is your sense of how much appetite there really is amongst retail investors for ESG when they're looking to protect their own portfolios?
I think there's a lot of appetite, and I think we'll see that coming August, when the new MiFID regulation kicks into force, when suddenly now all financial advisors across Europe will have to ask their clients, how do you feel about sustainability? And clearly, retail investors, like all investors, are in it for return, but our feeling, at least our experience, is that a lot of them are also looking for some kind of guardrails around their investment as to what am I really being involved in here? What am I investing in? How am I making this profit that I want to make? And can I sleep well at night and feel good about myself? And our experience is, because we've, through Nordea Bank, our parent company, have been asking clients about this actually for 2-3 years already, depending on which country we are talking about. And around between 40 and 60%, depending on the client segment and the country you're in, will tell you that they do care. And then, of course, under the new rules, that's where the conversation starts. Right. How much do you care? Where do you want to put your money? What are you? Is it climate? Is it gender equality? What's the thing you want to focus on?
All right, Eric, thanks so much. Eric Peterson, their head of responsible investments at Nordea Asset Management. Now, coming up, chaos in the travel sector. European airports begin capping travel numbers, potentially pushing carriers to even more cancellations. More on that story next. And this is Bloomberg.
soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open. Happy Friday. 50 minutes into your European trading day. Choppiness across European equities. You're seeing gains now of 0.7%. 1% is the gain that you're looking at on the FTSE MIB, and that draws me to the BTPs then, the Italian 10-year yields, currently trading at 3.68, 3.68 on the Italian 10-year, lower by 6 basis points. We did have some at least modest clarity from Christine Lagarde. I was going to say Francine Lacqua because you speak to her a lot. From Christine Lagarde at the ECB about how they're going to deploy this anti-fragmentation tool.
Yeah, and we did have, so she was speaking basically, we have a source inside or maybe outside, but in the, she was speaking to finance ministers, and she was basically saying, like, look, they have something to, put in place where they can sell things and buy other things. But again, I don't know how convincing that is, especially when you have a big part of the governing council that just does not feel that the spread in these yields is crazy. But think about the week we've had. I mean, we've had the ECB, meeting. We had the Swiss franc with the S&P yesterday, surprise 50 basis point hike. We had the Bank of England, and you start wondering whether all of this was maybe coordinated.
Oh, interesting. Were they on the phone to each other? If they were, they didn't draw in Kuroda, clearly, because he's sticking to this ultra-dovish policy. Yeah, but there is an idea that actually at the IMF, apparently, they got together and say, look, we just need to give a clear message to the markets, not to front-run them, but certainly to placate them. But you're right, Kuroda is not playing ball if that was the case. You put him to one side, and that seems like a pretty plausible setup then, because as you say, 5 straight hikes from the BOE, the ECB coming through with their emergency meeting and this tool, and then, of course, the Fed at 75 basis points. So the market's wrestling with all of that. Currently, as I say, equities here across the European space getting 0.7%. And over in the US, we saw some heavy losses yesterday, particularly on the NASDAQ. You're now seeing NASDAQ futures gaining 0.9%, Francine. Now, coming up, we'll talk a lot more about the Bank of England. He's the first official to speak after that Bank of England monetary policy decision yesterday. He's the chief economist, Hugh Pill, and he'll join us at 10:30 a.m. London time to talk about the latest MPC decision. Now on to travel chaos. Many of you will have experienced this yourselves. London Gatwick Airport has said it will scrap hundreds of flights over the peak summer travel period, hours after Amsterdam's Schiphol hub took a similar step. As the aviation industry's staffing crisis deepened, joining us now is Bloomberg's Sid Phillips. Sid, what do we know about the clear causes for the travel chaos that we're seeing? How much of this is about the inability to get the staff that they need, and why have airlines and airports not been better prepared? They knew this was coming.
Yeah, so, I mean, for the past 2 years, the airline industry has been asking people, governments, everybody else to allow them to restart travel. And then when travel really came back, the airline industry wasn't really prepared for it. And that's largely down to the fact that they've had to cut lots and lots of staff during the pandemic. And a lot of those staff members have either found other jobs or aren't really willing to come back to the aviation industry. So that's really behind all this chaos in Europe at the moment.
Sid, I travel a lot for work. I have to say it's always a little bit stressful trying to get to where you need to be in good time. How long does this disruption take? I think we heard from the Heathrow chief executive this could be 18 months. So what's the thinking? Are they now worried to hire more staff in case there's a recession and people stop traveling?
So it is really an interesting sort of time period for the airline industry, because at the moment, really, transport is really taking off, and that there is no sort of clear indication as to what happens post-summer. So while summer demand is really, really massive, post-summer, it is really a question mark. And so the airline industry says that they're hiring a lot of workers, they're trying to bring back as many as possible. But at the same time, they are probably mindful about the fact that rising cost of living is going to take an impact on travel demand as they go forward.
Sid, what about energy costs when it comes to the aviation industry and their ability, some, not all do this, to hedge around the prices that we're seeing?
Yeah, so the European airlines tend to hedge oil, and that's really helped them as they sort of ramp up, especially with rising costs elsewhere. So Wizz Air, which is Europe's third largest low-cost carrier, they announced they were going to go back into hedging oil. And that sort of really shows the extent of it, because oil is the largest sort of expense that the airline industry has. And so for the airline industry to actually try and make anything of this summer, they really need to get oil and under control, and at least some sort of respite from the volatility.
I'm asking this for a friend who travels a lot, Sid. Is there an airline that cancels less than others? Is there a ranking so that we can all get to either our work trips or our holiday trips?
I think we need to start getting one going, because at the moment, really, it's widespread across airports. I mean, every day it seems to be a new airport that's struggling.
No, honestly, it's a nightmare. It's like we had problems on Swiss and it was BA. I need Sid to kind of like, be
we need Sid on it. We need a function on the terminal.
Index.
Just type it in and you get a list of the airlines that actually can take you and aren't going to kick you off once you book a seat or tell you to rebook in a week's time. Sid, thank you very much indeed. Bloomberg Sid Phillip, of course, heading to their IATA conference in Dubai over the weekend to get some more clarity on what happens with the travel sector, of course, facing a number of pressures right now. Francine.
Yeah, we continue looking, of course, at the travel sector. That's it for the European market open, but Surveillance Early Edition is up next. What a week we've had. I mean, it's really sunny in London, and actually our Sarah Rappaport, a great producer, also did a 13 best bars in London. So if you've had a heavy week on the markets, maybe that's
the perfect go-to after the week that we've had. A lot of our viewers will be heading out into the sunshine after a tumultuous week. They need to look that up on the terminal and on .com. Get to some bars, have some relaxation. Happy Friday. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Global economy is at a turning point.
If they're serious about 2% inflation, they're going to have to crack the U.S. economy hard, and it's then going to take the easing to offset that.
We are choosing to pass part of the price increases to consumers.
Inflation is out of control.
But now in a bear market, we see a lot of good deals on the table now.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Friday, the 17th of June. I'm Francine Lacqua here in London, and here's what's coming up on today's program. The BOJ resists the global wave of central bank tightening, sticking with super easing monetary policy and hitting the yen again. While the rout resumes, driving the S&P 500 to the lowest level since 2020 as recession fears return, futures limp higher even as Treasury yields rise. Plus, ECB President Christine Lagarde tells officials that the bank's new crisis fighting tool will protect borrowing costs for weaker Eurozone nations. BTP yields close the gap with Booms. So let's go straight to our top story. It's been a major week, of course, for a change at the world's central banks. Now, the BOJ has resisted the urge to join the rate hike club and kept its key rate at minus 0.1%. Now, Japanese assets tumbled and the yen sank towards a 24-year low after Governor Kuroda held firm with rock-bottom interest rates. Kuroda also said the central bank was focused on stemming losses in the country's currency.
The recent rapid weakening of the yen is negative for the economy as it increases uncertainties and companies will have a harder time putting together their business plans.
Meanwhile, stocks in Europe are trading little changed after hitting the lowest level in more than a year. Overnight, the Nasdaq wiped $750 billion from its overall market cap. Unlike Japan and the U.S., the S&P and the ECB both surprised this week, the former with a 50 basis point rate hike and the latter with an ad hoc meeting that led to new anti-crisis tools. Now, the S&P's governor, Thomas Jordan, also said the central bank needed to get ahead of the narrative.
We believe it was necessary to increase rates today. If you look at our inflation forecast, it clearly shows that inflation is now higher. There's also a certain risk of second-round effects, a certain risk that inflation does not come back below 2% by itself. And so we came to the conclusion that it's now the right time to make a certain adjustment of our monetary policy and to tighten.
Meanwhile, Christine Lagarde's soothing words on a bond limits are narrowing the gap between German and Italian yields after the risk premium spread to its greatest in over 2 years. In the UK, the Bank of England raised rates by a comparatively meager 25 basis points, continuing a narrative of steady and successive increases. Well, joining us now to break down all of these moves are reporters around the world, Michelle Jamrisco, Alexander Weber, and Lizzie Burden. So, Michelle, let's start with you. What are the highlights from the BOJ announcement? It's pretty incredible that they're going against the grain and not budging.
Well, really what we saw here, Governor Kuroda really holding the line, stubborn almost, on holding that yield curve control policy. He said there's no reason to doubt its sustainability. In response to one of our own reporters' questions on whether there were limits to YCC, he said there was no need to look at that right now, that right now you can tighten, or you can watch others tighten, in the face of maintaining YCC. So I think really what we saw here is him holding the line. We saw a market reaction that was, a little wild in some ways, but really relatively favorable given the week that we've had. And now you're seeing, traders and the rest of us kind of limping into the weekend. And I think you see that yen kind of holding right near that 134 level. Now, it is important to note that Kuroda never mentioned a level during the press conference. He wanted to, of course, keep that out of it. But he is mentioning all these reasons to continue to monitoring currency very closely right now.
Michelle, thank you. Alex, tell us more about the ECB's new anti-crisis tool.
Well, we have yet to see it. So the unexpected meeting this week only decided to accelerate work on this tool. We've heard some bits here and there. It probably will, it will come down to bond buying of weaker nations in the euro area. Some key questions remain to be answered, like how will they do that without affecting their monetary policy stance? Reminder, they have to face record inflation at the moment. Also, what's the size of this new tool? And how will they make it palatable to the courts, which will look at this closely, and it will probably be challenged in court. So they have to come up with a way that's legally watertight. And we'll be looking for details probably ahead of the next Governing Council meeting in July.
Alex, thanks so much. And Lizzie, the BOE only went for 25 basis points because they're looking at different data points. But, they talked about forcefully, and it's freaking out the markets a bit.
Exactly. So the decision looks dovish compared to the Fed, but the guidance is more hawkish. The context is that the BOE's never gone for more than a quarter-point hike in its independent history. 5 hikes in a row is already unprecedented. And remember, the BOE was out of the gates first in terms of tightening in its major peers. But the reason that 6 of the 9-member Monetary Policy Committee didn't want to go for a bigger hike was because inflation's now forecast to peak at 11%. They think that's going to tame itself and weigh on demand, whereas the other 3 members are more optimistic about the resilience of demand. But it's curious they're not in the majority when the GDP data showed that people are still going out and spending despite the cost of living crisis. Nonetheless, as you say, the guidance is more hawkish, and now markets expect rates to end the year at 3%.
Yeah, which is quite significant. Thank you to all of our reporters, Michelle Jarmisko, Alexander Weber, and Lizzie Burden. Now joining us to talk about some of the market analysis, Mike Bell, JP Morgan Asset Management Global Market Strategist. Mike, we had a really crazy week when it comes to the markets and central bank action. What did you learn this week?
I guess we learned that the central banks are serious about dealing with inflation, particularly the Fed, who are now being priced to put rates up to about 3.8% near order. So, the world is in a position now where central banks are trying to deal with the inflation problem, but also facing the fact that that's going to lead to weaker growth.
Is there a policy mistake in the making, Mike? And actually, I was speaking to Philip Hildebrand of BlackRock, and he was saying, look, markets, or at least central banks, need to make sure that the markets understand that because this is a supply shock, they won't be able to fix output. So I guess a recession could be inevitable.
I think it depends how you define a policy mistake, because I think, unfortunately, the central banks are in a position where either they're going to have above target inflation for quite some time, or the risk of recession is uncomfortably high as they tighten to try and deal with that inflation. So either way, if we end up in recession or with persistently above target inflation, which is the choice they have to make, you could argue that in hindsight, they're making a policy mistake. So I think it's a bit unfair on the central banks in that ultimately they're in an almost impossible position here where, to deal with inflation, they're going to have to put rates up to a level which does risk causing a recession. I do think that recession risk is uncomfortably high at the moment.
Yeah. So is it still a possibility that the Fed can engineer a soft landing?
It's possible, but historically, when you look at the soft landings that we've seen, I wouldn't say it's that likely, because when you look at history, the occasions when we've had soft landings in the past had much lower wage growth than we see now. You've never had a soft landing with wage growth as strong as it is currently. So that suggests that history is not on the side of the Fed.
So what does it mean for your portfolio building, Mike? What are you buying and what are you selling?
Yeah, so back in February, I was saying it made sense to cut risk back down to neutral in terms of equities. I stick with that view. Obviously, markets have come down quite a long way since then. So, even though I've been thinking that it makes sense to be neutral risk for the last few months, if anything, I now think we're probably getting sort of closer to the bottom of this bear market than we are the top. That's not to say that equities couldn't still fall further, but we've obviously seen stock markets have fallen about 20% in most major regions year to date in a normal recession. And I think this recession, if we get one, is going to be a relatively moderate one compared with, say, the dot-com bubble or 2008. And so in a more normal recession, you tend to see stocks fall about 30%, and we're down something like 20% now. So I would argue the market's already pricing about a 2/3 probability of a recession. So, you've got the fact that at the moment, recession risk is uncomfortably high, but at least the market knows that. So I would stick with neutral on equities at the moment. What's interesting to me is that the bond market is not pricing in a recession. The bond market is pricing in the tightening in monetary policy that's going to be required to deal with inflation and perhaps cause that recession. But of course, in every recession in history, the central banks then end up cutting rates. So one thing I would be doing at the moment is reducing underweight positions to duration.
So, Mike, what does this tell us about, for example, I don't know whether Eurozone periphery looks expensive right now, or whether you think that the ECB has tools, or there are some of the idiosyncratic dislocations that we saw this week that you would buy into?
But ultimately, I think that the ECB will do what it takes to keep the Eurozone together. There's always, when we come to these kind of crisis points, and obviously a recession or much tighter monetary policy risks putting the Eurozone under some pressure again. But ultimately, you always get this discussion around how will the ECB deal with it? How will they get around the kind of legal hurdles that are in their way? But ultimately, I think they're going to do what it takes to contain the spread between Italian and German bonds so that they can transmit monetary policy effectively and keep the Eurozone together. Because if they don't do that, then all the laws and all the rules about how you're meant to conduct monetary policy are irrelevant if they don't contain the Eurozone. So I think ultimately they'll do what it takes.
Okay, given the shock from the Swiss National Bank hike that actually energized the franc, and given what we heard from Governor Kuroda of the Bank of Jay, was Swiss yen the trade of the week?
I think the yen's fascinating because there's really two scenarios in which the yen could go stronger from here. The first is if you get the BOJ give up on their yield curve control, which obviously they didn't do last night. But the other scenario in which the yen could go stronger is if you get a recession and then the very aggressive monetary policy tightening that you're currently seeing being priced in for the major DM economies outside of Japan, if actually the market starts to price that rates are going to have to be cut rather than keep going up and up and up, then the yen could strengthen in that environment.
Mike, thanks so much. JP Morgan Global Market Strategist Mike Bell stays with us. Coming up, also, don't miss our exclusive interview with the Bank of England Chief Economist Hugh Pill. That's on the latest MPC decision, and it's at 10:30 a.m. London time. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
the turning point? Will the inflation continue so strongly? And will the central banks be able to slow it without creating a recession? I am optimistic, so my answer would be yes.
Even if there is a recession here or there, and there has been recessions in the past, I'm pretty confident about the ability of the beauty industry and of L'Oreal to be totally resilient in whatever the context. And that's what we see today. Today, the beauty market hasn't slowed down a bit versus 2021. We see that consumers want to socialize after 2 years of lockdown.
We also know that for employees, and 60% of them told us that globally, that their number one concern is how to keep their purchasing power. How can you do that as an employer? Obviously, you have to raise the salaries, but sometimes you are not able to cope with the pace of inflation. So you have a digital solution, it's a Edenred solution, access to 250 different programs of benefits where you give money in benefits. It's very well appreciated by the employees.
Now, you heard there from the chief executives of LVMH, L'Oreal, and Edenred. They were speaking to Bloomberg at the VivaTech conference in Paris. Well, still with us is JP Morgan global market strategist Mike Bell. Mike, we were talking a little bit about the dynamics of central banks across the world, and you were saying that you were particularly interested also in what Yen and Governor Kuroda did. Are we looking, no matter what, at an earnings recession?
I mean, I don't think it's inevitable, but I think if you get an economic recession, then it will lead to an earnings recession. And so, you know, that's the risk out there. The good news at the moment for markets is that valuations have come down a long way. So in pretty much every major market, with the exception of really the growth stocks in the US, which are still on a P of about 20, despite the sharp falls we've seen, the value stocks in the US are trading on a P of about 12, and stocks in UK, Europe, and China on a P of about 10. So valuations have come down a long way now. They look pretty cheap. But that's a price to earnings ratio. The risk is that the earnings now come under pressure if we end up going into a recession. And that's where you could see a bit further downside for equity markets if earnings do indeed go into an earnings recession on the back of an economic recession. So that's why, as I said, we would be still sort of more neutral on equities. Maybe a bit too early to be aggressively adding in at these levels. But given the valuation correction that's already happened and the fact that markets are already down 20% or so, I think it's going to be very hard to sell and then buy back in cheaper. So that's why we think, you know, big underweight positions or selling now is probably not wise.
Even in tech?
Well, so I think in tech, that's where you've got valuations that haven't come down as much. You know, they started very high. So the Russell 1000 growth was on a P north of 30. That's now come down to 20. But as I say, most other parts of the world are trading on PE sort of closer to 10 to 12. Now, I don't think the PE on the tech stock should come down to 10 to 12 because, you know, a lot of these businesses can still deliver pretty good growth over the next 10 to 15 years. So for the genuine growers, the question is, what is the fair PE for them? Is it 20? Or is it somewhere a bit lower than that, but still higher than the kind of 10 to 12 region? And I think, you know, there is risk that valuations on some of those tech stocks could still fall further. So within that broadly neutral equity position that I've been discussing over the last few months, I think it's important not to have big overweight positions for tech and growth stocks as well.
Mike, what do you do with China right now? So they're concerned, of course, about a housing bubble, about a huge correction underway. What does it mean for global markets?
Yeah, I mean, I think the risk for China really is that if the rest of the global economy slows materially, then that would obviously hit China as well. I think if you were just worried about what's going on in China, then I would be looking at the market at the moment and thinking, well, it's gone down an awful long way already. And you know, the valuation in China is very cheap. To be able to buy an economy which we think is going to grow at about 4% in real terms per year over the next decade on a P of about 10, most of the time you'd be thinking, well, that's a pretty attractive opportunity. And I think if you've got a medium to long-term investment horizon, it is, and I would just sort of be looking to add there and hold for the long term. More tactically, if you care about the near term, as I say, I would be neutral, but it is the market that's priced in the most bad news, so I certainly wouldn't be looking to be underweight there.
All right, thank you so much, Mike Bell there, JP Morgan Global Market Strategist. Now, coming up, the National Australia Bank Chief Executive Officer Ross McEwan joins us at 9:30 a.m. London time. We'll talk market volatility and how well-equipped banks are to handle it. That's coming up shortly, and this is Bloomberg.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. And the World Trade Organization has approved a deal to water down intellectual property restrictions for the manufacture of COVID-19 vaccines. WTO ministers approved a package of agreements that included the vaccine patient waiver. Well, Director General Ngozi Okonjo-Iweala has previously said she wanted to end the morally unacceptable inequity of access to COVID-19 vaccines. While the deal is a blow to vaccine manufacturers such as Pfizer, Moderna, and AstraZeneca. Now, Joe Biden says recession in the U.S. is not inevitable. In an interview with the Associated Press, Biden says his aides, including Treasury Secretary Janet Yellen, and others have told him that his COVID aid package could have a marginal impact on inflation. He also said he disagreed with that view. His comments came a day after the Federal Reserve executed its biggest rate hike in almost 3 decades. And sources say the European Commission plans to recommend that Ukraine and Moldova be granted candidate status to join the European Union. The move could be a symbolic step forward in the lengthy process to join the bloc. Well, EU leaders are set to discuss the matter next week in Brussels. Germany's Olaf Scholz, France's Emmanuel Macron, and Italy's Mario Draghi endorsed Ukraine's membership bid during their trip to Kyiv. The U.S. House Committee investigation on the January the 6th attack on the Capitol has heard that Vice President Mike Pence came within 12 meters of the mob before being rushed away by his security team. According to an FBI informant, the invaders would have attacked Pence if they'd found him. The panel painted a picture of then-President Donald Trump being indifferent to the danger his vice president faced. And that's the Bloomberg First Word News. Now, a lot of the action, of course, that we saw this week is going on when we look at the markets, not only in Treasury, but also some of the stocks. If you look at stocks and futures for the moment in the U.S. bouncing back, again, traders trying to catch their breath after a pretty strong rout triggered by fears of an economic downturn. Treasury yields rose, the dollar rebounded from a 2-day of losses. Now, markets are rounding off a week buffeted by interest rate increases, including the Federal Reserve's biggest move since 1994. We also had that shock Swiss National Bank hike that energized the franc, and then we had the latest boost in UK borrowing costs. In fact, the rate hikes are draining liquidity, and that has sparked losses in a range of assets. Coming up, National Australia Bank Chief Executive Ross McEwen joins us next. We talk market volatility and how well-equipped banks are to handle it. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The BOJ resists the global wave of central bank tightening, sticking with super easy monetary policy and hitting the yen again. The rout resumes, driving the S&P 500 to the lowest level since 2020 as recession fears return, but futures limp higher even as Treasury yields rise. Plus, ECB President Christine Lagarde tells officials that the bank's new crisis-fighting tool will protect borrowing costs for weaker Eurozone nations. BTP yields close the gap with yours. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the specter of massive increases in Australian interest rates is threatening to break the back of the country's stock market, where banks play, of course, a dominant role. Investors are fleeing bank shares following the central bank raising the cash rate by 50 basis points to 0.85% last week. Well, I'm delighted to be joined today in the studio by Ross McEwen. He's Chief Executive Officer of the National Australia Bank. Thank you so much, Ross. It's been a while, so it's so good to catch up and in person and with nice weather in London.
It's beautiful. Been a beautiful week in London. Thank you for putting it on for me. It's nice to be back.
No problem. Talk to me about volatility and actually how much of a nightmare or how much of an opportunity that is for your bank.
Well, it's a bit of both, and it's been interesting to see how the stock has come off about 20% over the last 10 to 15 days in an environment when actually banks can usually do reasonably well with interest rates coming up. We've had 12 years of interest rate down, which is actually very difficult on a trading bank or commercial bank. And finally having them come up, and the bank stocks have come off. But it just shows people are worried about what's happening with the economy.
But people are worried about what? So are they worried about inflation? Are they starting to price in a recession? Or actually they just don't see a way out of this?
Well, look, it appears that every country has got a difficulty with inflation, and be that short-term or long-term inflation, it's certainly coming through. We haven't seen it for 30 years. But the other side of that, each country is quite different in how it needs to handle it. For example, the Australian economy is very strong. Yet it appears that the UK economy is a lot weaker. Therefore, how do you deal with interest rate rises? So an interest rate rise in the Australian marketplace may be easy to absorb than actually in the UK, where if you push it too hard, you'll stop the economy.
But even in Australia, do you worry about your mortgage book? So the economy can be, strong enough to sustain it, but maybe some of your customers are not.
Well, look, our customers in the general sense are in pretty good shape. Now, there'll always be, when you get into different groupings, there'll be some that will have some difficulty, and we need to work with them to get them through these shocks. But have a buffer on what we actually think they can pay anyway when we do their assessment. And because the economy's been so good for so long, and interest rates have been dropping, many of our customers, we haven't reduced down their interest payments that they've been making. Therefore, they've got quite a buffer in there. So we think they're in pretty good shape, but there will be some that will have difficulty.
So at the moment, you're not seeing any strains on borrowing, for example. In terms of timeline, if there were, some concerns, when would you see it?
Well, I think it's yet probably in 12 to 18 months, because a lot of the customers are still sitting on a standard variable rate. Yes, the rates have gone up. We've got a number that have gone in the last couple of years onto a fixed rate, and probably you've only seen about 3 months of those group coming through and going on to a higher rate. So that will take some time to come through. And the same in our New Zealand business, which is a fixed rate market.
Right.
The shocks will be felt there first, because you're going from 2% to 4.5% when you come off. At the moment, we're not seeing any impact from our customers having real difficulty. So there's still good resilience in the marketplace. They've still got jobs. 3.9% unemployment, 3.2 in New Zealand, I think it is.
Not bad.
We've got a job, and if you've got a job, chances of payment are pretty good.
Russ, of course, the relationship between Australia and China is extremely strong. What does, the COVID zero policy and the fact that we think it's here to stay mean for natural resources and therefore the Australian economy?
Yeah, I'm not an economist on what the impact will be, but it's just
for the
one. For the bank, just it's one of other things that we're having to deal with. Be it interest rates going up, be it inflation being higher, and all the input prices being higher, and then a slight slowing down of China, which does over time impact Australia because it's a big trading partner of ours. But at this stage, we're not seeing major implications, but over time, it will have an impact on Australia.
Yeah, given all of this market dislocation, given all of the volatility, what do you worry about the most for the bank?
Well, right now, the biggest worry I have for the bank, but for Australia, is labour. Despite all that we're talking about, we've got one of the lowest unemployment rates that we've ever had. Every employer I talk to cannot find labour to grow their businesses. It's just amazing. Infrastructure programs in Australia are very strong. I came through Northern Territory on my way up here, talking to the Northern Territory government. The projects that are going on in those areas, they need labour. And so that would be the biggest one at the moment.
But, I mean, this is a huge problem because there's a mismatch in how much time, when they need labor, and I guess how much time to train them. So why is there this mismatch, which we're seeing almost across the world?
Well, we're seeing it across the world. And there must be a big group of people who have stepped back from the workforce. Australia has seen it.
COVID-related, do you think?
Yeah, but COVID-related, and then after COVID, reassessing what they really want to do with life. Maybe they've retired slightly earlier and not been in the workforce for the next couple of years. Maybe they've taken a step back on some of the jobs that they were doing and saying, I'm not going to do as much. Thank you, I'm feeling okay. There's a lot of money in the system, so they're feeling all right about it. But in the Australian situation, we lost a big number of our overseas students which participated in the workforce. We haven't seen immigration for the last 2 years. We saw net loss of migrants last year in Australia for the first time, I think it's 40 years.
Wow.
So this is quite big for the Australian economy. So getting it going from a labour perspective is probably, in my mind, one of the biggest things to keep the economy moving.
I mean, reassessing your life is never a good idea. We'd probably be, I don't know, with
you'd come on down to Australia.
Or in South Park or something like that. Ross, talk to me a little bit about, so you have a unit in France.
Yes.
What does that mean for the UK? Is the financial sector moving more to mainland Europe?
Well, we've got a lot of customers that actually operate out of Europe, and because of the UK coming out through Brexit, we have to service those customers, and our operation in France will do that. Of our top 100 or largest customers, 33 of them have businesses in Europe.
Okay.
So there's a very strong connectivity between Australia and Europe, as there is between Australia and the UK. So we've just set up a new office. I was over there yesterday opening it. We've got a really good team set there and met a lot of the customers that we will do business with through Europe.
But so the unit in France is what, because of Brexit, so that you need two bases, or how would you explain it?
We've got two bases. There are some things that we can do out of the London office that we've been allowed to do from a regulatory perspective, but the core of our European business and the specialist people and the risk takers need to be in the European market, and we've based them in Paris.
How do you see London changing because of that as a financial centre?
Well, it's one of the things for London. I think it just needs to find itself getting out into the marketplace again. I think the UK just needs to get its confidence back to get back out into international markets and do business again. And so you've made the decision to come out of Europe, so get back into the markets as quickly as you can and rebuild the confidence, the trade, and then the banking sector will be fine.
But easier said than done. Is that through incentives?
Well, I think a bit of energy towards it might help, rather than constantly, squabbling over what the issues are here. Let's get out and get the UK back trading again. I know the trade missions are out there, but I think that will be very helpful for business as well.
Ross, thank you so much for joining us. Russell McEwen there, the Chief Executive Officer of the National Australia Bank. Now, coming up, European nations are being forced to confront the possibility of keeping their economies running without Russian gas. We discuss that story next, and this is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacquet here in London. Now, against the backdrop of the meeting in Kyiv between Ukraine's president and leaders of Europe's biggest economies, the region's worsening energy crisis, of course, is continuing. European gas prices gyrated as Moscow tightened its squeeze on crucial flows on the continent. Now, this is forcing European nations to confront the prospect of keeping their economies running without Russian gas. Well, joining us now is Anna Shirashevka, Bloomberg's natural gas reporter. Anna, so what is exactly the impact of the Russian gas supply cuts this week?
So at the moment, we are seeing about 50% increase in natural gas prices in Europe on a week-on-week basis. At the moment, we are in the summer, so demand is lower, but it's very crucial to fill gas storages in Europe. And we are seeing first signs that this reduction in Russian gas supplies is already affecting injections in the storage. And their estimates, with McKinsey estimates that if Nord Stream supplies into Europe shut completely, then we may actually run out of gas in storage by January, which is going to be a peak winter demand. Gazprom reduced flows via Nord Stream by 60% this week.
So, Anna, how will this actually affect the gas markets a little bit later into the summer and then into winter, which it could get pretty tight?
Indeed, the attention is now on the summer refill campaign into the storages. The European Union ordered that storage facilities must be at least 80% full by the 1st of November. That's a very challenging target now to achieve if we are going to see a sustained reduction in Russian gas flows. Then comes winter. Obviously, much will depend on the winter. It will depend how much LNG Europe will be getting from the nations such as the US, Qatar. But still, if these flows from Russia remain reduced, there's going to be a challenge in the winter.
Anna, thank you so much for, of course, all of the update, and then we'll see what happens also on the Russian side. Anna Shirashevskaya, Bloomberg's natural gas reporter. Now, joining us to talk about the energy transition is the titan of the energy industry. He's Lord John Browne. He had a 40-year career at BP, moving from apprentice to chief executive, where he was a leader in the movement to push the company away from fossil fuels. Now, he's now Beyond Net Zero chairman. So, Lord Browne, thank you so much for joining us. I know we'll talk a little bit about equality shortly, but first on the energy transition. It seems that there's a lot less appetite for ESG products. It seems that we don't have enough of the things to make sure that the transition is sped up. What kind of grade would you give your governments, our governments today, on how they plan for this transition?
Well, inevitably, the grade cannot be a good grade because we, for years, forgot that the one important thing about energy is getting secure supplies. And that means you need more than one choice on the sources of energy, and you need more than you need available to you at all times, just in case something happens. So we have a situation where energy security is right up the agenda. We have to diversify sources, not least in Europe, especially in Germany, after the invention of the so-called energy Energiewende, which reduced the number of choices Germany had in power generation. So this is going to take time. We're going to have to invest in everything, including hydrocarbons, importantly for the next 5 years. Very important indeed.
Yeah. But Lord Browne, if this takes time, and we don't have that much time because we're losing that supply from Russia, how tight and how messy will these energy markets be?
They're going to be very tight, and they'll be very messy. We have to get investment to catch up with demand, and that's the important thing. We can put in a lot more renewable energy because it is local, but it takes time to get the goods and services in place, supply chains are tight, and to get permits as well. We also have to develop hydrocarbons, but not, I hope, for the long term, just to get us over this bridge. I do think ESG is not in the back burner, it's just frozen for the time being, while we do something which is realistic, which is to get energy to people regardless.
But Lord Brown, I mean, given the high inflation numbers, it feels like we're running out of everything. There's not one commodity that hasn't gone up or that we're struggling to either mine or get to where it needs to be. What happens in the next 2 to 3 years to inflation because of commodity prices, because of energy?
Well, I'd expect energy prices to stay up for quite a long time. And so whether they'll keep going up or stay up, I can't comment. It all depends on the day-to-day. But I think we're going to have to marshal a lot of resources. It's not as if everything is not there. It's just not available in the supply chains. And the supply chains need to be geared up again. We've broken quite a few of them. We need enough supplies to make electric motors for wind turbines. We need more. We need more solar panels. We need more cables. We need all these things to get going now.
But Lord Brown, do we have, so even if we have the technology, do we have the right components? Or is the supply chain so broken that this will take 18 months, 24 months longer than it would have 5 years ago?
Well, in an ideal world, but there's no such thing. We would have sort of laid all this out and got it just right and everything would be perfectly smooth. So this is going to take several years to get sorted out. It's not going to be overnight, without any doubt. And it takes, I think, a lot of great management and leadership to do this. We need to be clear. Yeah. We have to put in place more capacity for energy than the day-to-day needs to have the ability to cover interruptions. And we need to make sure we still commit to getting a carbon in the energy system down. But I repeat, we'll still need to generate, the transition is a transition. It's not a cliff edge. We have to generate enough hydrocarbons to bridge. What I hope we don't do is invest in hydrocarbons that last for 30 years. And we say, well, we've got them 30 years. We need them in the intermediate term right now.
But is there a danger, again, oil and gas seems to be back in vogue because of the higher returns, because of the price of oil and the returns that they give back to shareholders through dividends. Does that actually mean that the transition will be delayed?
Not really, I don't think. I think the oil and gas has never really been out of vogue globally. It's been out of vogue on the stock markets in the West. But actually people have still been generating a lot of oil and gas output all over the world. And you know, most of it comes from outside the world, the sort of US, European world. It comes from elsewhere. So we have some supplies, not least in the US, that can bridge a gap and can bridge quite quickly from the shale, both gas and oil. And I think investment's now forthcoming, now because prices are high. But in the end, we have to figure out how to balance our energy mix so that the total net emissions from energy goes down. Incidentally, that means we need to really redouble our efforts to decarbonize hydrocarbons.
Do you believe that, President Biden going to Saudi Arabia, asking for extra barrels to be put on the market, does that send the wrong message to net zero countries?
It can do, if it's forever. But we're trying to, I think, everybody is looking at a very practical situation, getting across a bridge here where the depth is, there's nothing to cover the bridge at the moment. So prices are very high. If there were a real expectation that supply would be better, prices will come down. And that's important for economies. I think nobody wants to go around supporting a position where energy is not affordable for people, both in the West and especially in the world outside the US, North America and Europe. So I think
Lord Brown, thanks so much, John. Yep. Thank you so much, John Brown there, Beyond Net Zero chairman. Of course, he stays with us, and we'll talk a little bit about equality. Now, coming up, we continue the conversation with Lord Brown about power politics and homophobia. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So do you have to be straight to get ahead in business? Well, the former BP boss, John Brown, Lord Brown, thought so and lived for years in the closet until he was outed by his first boyfriend about 8 years ago. Now, since then, he's written a book exposing the homophobia within the business world called The Glass Closet, Why Coming Out is Good for Business. Well, we're back with Lord Brown, Beyond Net Zero chairman and former BP chief executive. Lord Brown, you wrote this very important book in 2014. Since then, do you believe that things in the business world have gotten better?
Oh, definitely. I wrote the book with obviously looking backwards over my life, which it was I chose to stay in the closet for all sorts of reasons, my family and the behavior of society. And then in 2014, I wrote the book, and I think things have continued to improve. There's no doubt that people continue, that the situation is improving, such that I think if I speak to people of a very early generation entering business, they keep wondering what the fuss was about and why I wrote the book.
But could we do even better? I mean, I'm sure we can do even better. How would you do even better? Does it go to the culture, or do you? I don't know whether, many chief executives are still in the closet because they think that it will penalize their careers.
Well, indeed, they might be, because there's so few people out of the closet. Clearly, gay CEOs. There are very, very few in the Fortune 500. There are very few. 0.5% apparently of the boards, the members of boards of directors of the Fortune 500 explicitly out as gay. that these numbers are vanishingly small. So I think what it takes, obviously, to get a great sense in a company that people can all be included, regardless of sexuality, for example, is tone from the top, making sure that there's continuous statements are made, inclusion matters. Secondly, role models. You have to have people who actually have succeeded, and you need to promote them. Otherwise, you simply are lecturing people about what could be. And thirdly, being completely intolerant of any bigotry, any discriminatory action, and taking immediate action. I think that's important. If you can create an inclusive society in business, you are bound to get better team performance, and you're bound to get better financial performance. It's
Lord
again.
Bart, yeah. And who's better at this? The Americans, the Brits, or the Europeans?
I think it depends entirely on the leader, and I don't think there's an exclusive or national trait. I'm very struck with the rate of improvement in the UK. The UK has done very well. It was really pushing hard under a variety of prime ministers to get equality of marriage, equality of discussion. I still think that there's plenty to do here, there's plenty to do in Europe, and there's plenty to do in other sectors. We're still only just seeing, for example, in sports, people wanted to come out.
Yeah. Thank you so much for joining us. That was John Brown, Beyond Net Zero Chairman. This is Bloomberg.
The end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Inflation is out of control.
They're serious about 2% inflation. They're going to have to crack the U.S. economy hard, and it's then going to take the easing to offset that.
We are choosing to pass part of the price increases to consumers.
But now in a bear market, we see a lot of good deals on the table now.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Friday, June 17th. Our top stories today. Ever the outlier, the BOJ resists the global wave of central bank tightening, sticking with super easy monetary policy. That hits the yen again. Under construction, officials are working on a call between Presidents Biden and Xi, with tensions high between the world's two biggest economies. And the Bank of England's next moves. Our exclusive interview with the BOE's chief economist, Hugh Pill, is straight ahead. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kriti Gupta in New York. Kaylee Lines is off today. And Kriti, what a week it has been. Assets really whipsawed. Stocks, though, looking set to end the week lower. European equity markets taking some time to find their stride, but actually making some gains this morning.
Well, I think a lot of the spotlight was actually on Asian equity markets, even going into the closing bells yesterday here in the States. A lot of this having to do with what the BOJ may or may not say. This is really important because they didn't quite deliver the perhaps groundbreaking market-moving news that a lot of people were expecting to, that this would be the moment that would crack the JGB market. We did not get that, Anna. In fact, we didn't get that. We also got comments that the BOJ is continuing to look to ease, and that actually had a pretty dark impact on the entire Asian complex. You had the MSCI Asia Pacific Index in the red, down about 1.3% overnight. But remember, a lot of those losses were concentrated in Japan. Some spots of green in those Chinese indexes. But take a look at this. The Japanese yen is really where all the action is. That weakness continuing to drop, get stronger and stronger. The question here, is that does dollar yen start to test the weakness, the 23-year high, of 135? That's going to be a really important handle to watch. And of course, as we continue to see that Japanese yen weakness, we have to look at some of those other Asian currencies as well. The weakness in the Korean won. At what point, Matt, does this become an export war?
Yeah, that is interesting, but really it's all about the BOJ and trying to figure out exactly what's going on there. In terms of what's happening here, we are seeing futures bounce a little bit, but after another huge drop in the cash trade yesterday. Keep in mind that we closed on Friday down 2% at 3,900 on the S&P. Last night we closed at 3666 on the S&P. So we've lost a heck of a lot already this week. U.S. 10-year yields rising a bit, but only up to 322. We've seen 340 this week, so that's really moderate compared to where we've been. And NYMEX crude coming up, but only to 118.46. We've seen 124 on Texas Intermediate, so we're really moderate there as well compared to where we've been this week. Bitcoin right now at 21,049, up 1.8% from midnight. And everybody's really watching the $19,000 to $20,000 level to see if Bitcoin can hold. But of course, it's very much correlated, as we've seen all year, with futures, and it continues to be that way. Anna, what do you see in terms of the cash trade in Europe?
Yeah, of course, we've got a great conversation coming up later in the program on crypto. This is the picture for European stocks. And just as Matt was pointing out there, the way that we need to put the gains in S&P futures in the context of the losses of yesterday, the same is important here. European equity markets losing between 2 and 3% on the major markets in yesterday's session. So it is in that context that we look at the gains we're making today, up 1% on the CAC 40, up 1% and a bit on the Xetra DAX over in Germany. So we've struggled for direction in the earlier part of the trading session. But as US futures got a little more into their stride, so we see European stocks moving a little bit higher here. Let's have a look at what else is on the radar here in Europe. And we have the Italian 5-year yield. The yield is dropping here, so money going into the 5-year debt product out of the Italian government. And this is coming after Christine Lagarde, of course, president of the ECB. She's been offering some soothing words, talking about intervention in bond markets if we were to see some blowout in the spreads beyond a certain level, I assume. But we'll wait to see what kind of levels we're talking about there. But that certainly soothed markets in the short short term. Natural gas prices in Europe, this is the benchmark, up another 6% this morning. We are set for the biggest weekly gain in European gas prices since the invasion by Russia into Ukraine. And this because we've seen more and more European companies reporting that they're not getting hold of what they ask for from Gazprom. So Gazprom not sending them the full amount, just 50% into Italy and into Slovakia today. The pound really whipsawed yesterday by what we heard from the Bank of England and what we didn't. More on that coming up shortly in our interview with Hugh Pill, but this is where we are on cable, 123.14. And Nokian Renkat, which has the great ticker TIRES, because it provides tyres and other auto parts, the stock is up by 8%. They're guiding higher. They're saying pricing is pretty strong and demand for tyres is strong. I wonder what that tells us about the broader auto space then, Chrissy.
You know, it's really interesting. You're talking about the auto space, and once again, we're bringing it back full circle. That industry itself has so much of a dependence on those Asian supply chains. Of course, we're going to keep an eye once again on what happens in Asia and how that ripple affects around the world. Let's pivot here, though, and look at what's coming up ahead today. Fed Chair Jerome Powell makes welcoming remarks at an inaugural conference on the international role of the dollar hosted by the Fed. It's also Triple Witching Day, which is likely to exacerbate the frenzied nature of this week's price action. Of course, the eco data, it does not stop. We'll get U.S. industrial production data at 9:15 a.m. New York time, Matt.
All that is important, but the Bank of Japan has really been an obsession this week. The governor, Haruhiko Kuroda, held firm with rock-bottom interest rates, defying an intensifying global wave of central bank tightening. Let's get more with Paul Jackson, our economy editor for Japan and Korea. And Paul, tell us exactly what the Bank of Japan did. It was really just a tweak in the language, right? And the markets have really been testing Kuroda.
Yeah, I think the key point is Kuroda did just enough. He added a reference to needing to watch foreign exchange rates and our markets movements at the moment, and that was about it. The market movements this last couple of days have been favorable for the Bank of Japan. It's given a bit of breathing room for him. I think earlier in the week, when the yen was at its 24-year low and pressure was really building up in Europe, anything seemed possible today. But in the end, he's kind of got out of jail and he's bought himself another month of breathing space. But the fight goes on. We saw earlier in the day the yield levels going above the ceiling. That's to take operations to get them below 0.25. And they just announced after Kuroda's press conference this afternoon that from Monday they will be starting daily fixed rate operations on the cheapest to deliver bonds. They're closely linked to futures, and Kuroda says there's been speculative activity there.
Paul, thank you very much. Thanks for the update. Bloomberg's Paul Jackson joining us there from Tokyo with the latest on the BOJ. We'll stick with central banking once again this week. ECB President Christine Lagarde told Euro area finance ministers that the new anti-crisis tool will kick in if the borrowing costs for weaker nations rise too far or too fast. Let us get more details. Alex Weber joins us, our European economy reporter. So more commentary coming through this week from the ECB, some soothing words, bringing down those spreads a little.
Exactly. We're still looking for more details from the ECB. There are still a lot of open questions like how big is this new program going to be? How will they make it legally watertight? There's a good chance that we'll get a challenge in courts again. And then also, how do you define what's unwarranted fragmentation on bond markets? Remember, different euro area countries have different debt levels, so it's natural that there's a differential between the bond yields. But what's unwarranted? At which point will the ECB step in? That's the kind of details we are going to be looking for, and we think there's going to be more news at the next Governing Council meeting in July. Until then, ECB staff will be hard at work to make this program a reality.
All right, Alex, thanks very much. Alex Weber there talking about the mysterious tool from the ECB. We'll learn more about it at near the end of the month. Now, Bloomberg has learned that U.S. officials are working to arrange a call between President Biden and Xi Jinping of China. The sources say that the call could come as soon as July. The U.S. ambassador to China spoke yesterday.
We're carrying on an intensive dialogue, an intensive set of meetings with them. That's our job, and we'll do that to the best of our ability so that we can keep the governments talking
Emily Wilkins, Bloomberg government reporter, joins us from D.C. for more. So the two, Emily, haven't talked since right after, I think, the start of Russia's invasion of Ukraine. What do we expect?
They haven't spoken since March, and we could see a meeting potentially around July. One of the reasons that we're really looking at this right now is because you are seeing other U.S. and Chinese officials go ahead, have meetings. You saw Jake Sullivan in Luxembourg meet with a top Chinese diplomat for 4.5 hours, covering a range of topics, including Taiwan, the South China Sea. And this has sort of been the talks that have been preludes in the past to Biden and Xi getting on the phone and actually having a conversation between the two of them. You've heard top administration officials say that they really want to look to set guardrails between the U.S. and China, making sure that any disagreements between the two countries don't wind up escalating into a larger conflict.
Emily, that's not the only thing going on in Washington. Of course, those January 6th hearings are ongoing, and now we're getting some pretty chilling details about the escape of Vice President Mike Pence. What can you tell us about that?
Yeah, so we knew that Mike Pence had been very close to the mob that broke into the Capitol on January 6th, but we didn't really get a sense how close until yesterday when the January 6th committee revealed that he'd really only been about 40 feet away from a mob that had where individuals within it had stated their intent that they'd wanted to hang him, where they constructed nooses on the Capitol lawn for them. And the committee has tied this back to former President Trump, saying that he was the one who really did put pressure on Pence, that he was told that it would be illegal to try and get Pence to overturn this accounting of the electoral vote, something that the vice president really has as more of a ceremonial role. But even though that Trump was told that it was illegal, he went ahead, he continued to sort of push this. And this goes to the larger point the committee has tried to make, and it's a few public hearings. It'll have some more next week and later in the month, but just trying to really focus on the point that Trump did try to overturn the results of the 2020 election, even though his own advisors came to him and said that the results of the election were legitimate and that Biden was legitimately the president.
Emily, thanks very much. Thanks to Emily Wilkins of Bloomberg Government in Washington for those updates. Let's stick stateside. Elon Musk has held his first meeting with Twitter staff since agreeing to buy the company for $44 billion in late April. The world's richest person told workers people should be allowed to tweet pretty outrageous things. Joining us now is Matthew Bloxham, senior analyst at Bloomberg Intelligence. Matthew, good to speak to you. He said that. He also said that there are different rules for exceptional people versus others. Give us some of the highlights.
Yeah, I mean, he said a lot about his plans for the social media platform, but I guess unfortunately not a huge amount, if anything, about whether he's actually going to follow through on this deal to take the company private. And, I guess with the shares trading down slightly on the day, they're at about a 30% discount to the $54.20 offer prices made. Still a high probability in the market that the deal isn't going to happen, or certainly at a much lower price than originally slated. Yeah, on this point, he was asked about the threat of layoffs. He said that he noted that costs exceed revenue, and that wasn't a great situation to be in. So I think people maybe still be worrying about their jobs. And again, you need to be exceptional if you're going to be able to work from home. He also made some interesting points about how big he wants the platform to get. So he wants the platform to get to about 1 billion daily users. That's over 4 times the current level. And he sees an important role for subscriptions in validating human users. Now, bots and spam accounts are a big feature of the Twitter platform, and it's been an issue that he's not liked for a long time and could still derail his offer. So, some interesting points he made there.
Matthew Bloxham of Bloomberg Intelligence, we thank you as always. A fascinating story. Of course, we're going to be watching those moves in both Twitter and Tesla. But for now, let's take a look at some of the stocks moving in the pre-market trading in the United States. Let's start off with Carnival Cruise Lines, because right off the bat, remember, we had that massive sell-off yesterday, so you are seeing a pretty broad rebound. And I love to look at the cruise lines and the airlines as that kind of gauge of not just a broad rebound, but also a little bit of a volatility proxy. We remember, we're not out of the woods. The VIX still over a 30 handle. And when you have that situation, Carnival Cruise Lines, American Airlines, those kind of names tend to actually have these big moves. So Carnival Cruise Lines is one we're going to watch throughout the session, up just shy of 3%. Let's take a look at the tech space, though. TSM, Taiwan Semiconductor Manufacturing Company, the ADRs listed here in the States, is the world's biggest chip maker that looks to have the next version of ASML, the Dutch semi-equipment maker's most advanced chip-making tool, that coming in 2024, giving those shares, or those ADRs, I should say, a little bit of a boost, up 0.9%. And sticking with that theme of those tech shares, let's talk talk about Adobe, because they actually cut their sales forecast, cut a lot of their kind of guidance simply based on lower summer demand. That being said, the Street saying that makes their execution risk the new overhang. How much can they actually deliver on some of the promises they make if they're not getting that full demand? And of course, it's those comments that have the shares down about 3% in the pre-market. Anna.
Okay, we'll get back to the markets. Big picture on these markets, what a rollercoaster week it has been. We will talk to Anika Gupta, WisdomTree Director of Research. That coming up. Also, the downturn in crypto. We'll talk to Anthony Trenchev, Nexo co-founder. What does he make of the crypto winter? Where does it go from here? And what role is Nexo playing in trying to help out some of its rivals? Plus, our exclusive interview with Hugh Pill, Bank of England chief economist. They went for 25 and not 50 yesterday. Where do they go next? This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kriti Gupta in New York and Anna Edwards in London. Kaylee Lyons is off today. I'm looking at the spread between BTP's Italian 10-year debt and Bund's German 10-year debt, and it's come down to its lowest this month after the ECB held an emergency meeting and said they're prepared to start thinking about the possibility of developing a crisis tool that they'll show us sometime later. Joining us now is Anika Gupta, WisdomTree Director of Research. And Anika, this looks to have worked, at least a little bit, right? What is the ECB doing?
Well, that's a great point, Matt. The ECB has definitely tried to step in just ahead of the Fed's meeting on Wednesday to try to placate widespread concerns in the market. And the reason for that is at last week's meeting on Thursday, President Lagarde really referred to it only very vaguely. There was a very vague use towards a flexible use of instruments to safeguard transmission of monetary policy. And clearly markets were not convinced, which is why we saw the surge in BTP yields and the spread actually widened to such a large extent. Now, clearly what we've got since we've had the ECB's emergency meeting by the Governing Council was that they're clearly looking to solve this situation should it arise, but we still haven't got that clarity around what is the exact tool they intend to use, and more importantly, the exact threshold for using it. So I think we will be getting a bit more clarity over the course of time, and that would be, that is definitely going to help assuage a lot of the concerns.
Who decides the point at which it is necessary to intervene, just conceptually, Anika, in these situations? I mean, I know that I saw the view of one bank executive in Italy. He says he thinks it should be 100 to 150 basis points, but of course he holds a lot of BTPs and he doesn't want that spread to blow out too much, probably. So who should decide at what point the ECB needs to intervene?
I mean, if you look at it, Anna, the spreads, although they widened considerably, when I'm referring to the BTP versus the German Bund yield, the spreads did widen, but they were nowhere as close to what we saw in 2012 and 2014. I think it was really a concern that there was there was less of a constructive plan towards fragmentation risk. And what the market is trying to do is it's trying to push the ECB to come to a decision. And I think the threshold could range between 120 to 150 basis points, but it's very difficult to tell the exact number until we really get clarity from them.
Anika, how braced should we be for higher commodity prices here? Certainly on the energy side of things and maybe on the agriculture side of things, the politics is unpredictable and could be in the driving seat. But elsewhere, we've got concerns about growth in China and now increasingly concerns about growth in other parts of the world and demand destruction. So where do we see net, where do prices head?
Well, in our view at Wisdom Tree, the bloodbath that we've seen in global financial markets really is as a consequence of supply-side driven inflation. And so as long as that supply-side driven inflation is going to exist, that is going to lead to higher commodity prices. So we're seeing it across the spectrum. It's not just energy, which has really led the gains amongst commodities as a whole, but it's also, the rise in energy prices has also been spreading towards agricultural commodities. The rise in energy prices is also curtailing, production outputs of industrial metals. We still haven't seen inventory levels at, metals exchanges start to pick up, despite the fact that sentiment remains weak towards the industrial metal space. And more importantly, if we're now starting to see the reverberations of heightened uncertainty, coupled with the fact that inflation is, spiraling out of control, that also stands to benefit precious metals as a subsector within the commodity space.
Anika, one of the things that makes this commodity rally so fast and so furious, and I think really stands out, is just the fact that it's humming in the face of a stronger dollar. So let's go there. The currency story. To what extent is the dollar story going to continue to be the trend, say, going into 2023? How much of that might reverse?
Well, we've always held the view that, and we've always got it wrong, I should be honest about it, that the dollar should weaken going forward. We've had this very interesting observation that we've made between the US twin deficit as a percentage of GDP, and when you map that against the US dollar with a 3-year lag, you actually get to see a very close correlation, and it's actually highlighting to you that going forward, the dollar is likely to weaken. We continue to hold that view. Obviously, the dollar has been the choice of a safe haven currency amidst this volatility that we've seen. But if you look at it over the past week, the Swiss National Bank came in, acted ahead of the Fed. The ECB came in, called an emergency meeting. We've seen the euro appreciate. We've seen the Swiss franc appreciate. We've seen the dollar actually decline despite one of the most aggressive moves made by the Fed since 1994. So that tells us that the dollar has had, a great run. It has been a safe haven currency of choice, but that could turn very soon. And again, if you have a weaker dollar, that should also, again, benefit the commodity space.
Well, I'm really glad you went there because it's those central bank decisions, essentially the catching up to the Federal Reserve that I was really getting at. You completely nailed that. I have to ask, though, if you start to see perhaps that reversal or that lack of interest rate differentials for the dollar, how much farther, or how much, I should say, could the dollar actually drop? What kind of bear case scenario are we looking at?
So our view is obviously the fact that the Fed has by far been the most aggressive on tackling inflation, and given the fact that every central bank, as we all know, is dealing with its own unique inflation growth dynamics. And by far, the Fed is in the most comfortable position when you compare it to other central banks, in my opinion. And hence, the Fed is in a position to be a lot more aggressive compared to let's say, for example, the ECB, the Bank of England, or the Bank of Japan, for example. And hence, that should lead to a much further widening of interest rate differentials. Yet, at the end of the day, we do believe that the overarching concerns of the ever amounting debt load on by the U.S. should in the long run weigh on the dollar.
Anika, thanks so much for joining us. Great to have you on with us today. I hope we can get you back soon. Anika Gupta there of Wisdom Tree. Now, keeping you up to date with news from around the world, here's the first word. Joe Biden says a recession in the U.S. is not inevitable. In an interview with the Associated Press, Biden said his aides, including Treasury Secretary Janet Yellen and others, have told him that his COVID aid package could have a marginal impact on inflation. He said he disagreed with that view. His comments came a day after the Federal Reserve executed its biggest rate hike in almost 3 decades. Now, sources say the European Commission plans to recommend that Ukraine and Moldova be granted candidate status to join the European Union. The move would be a symbolic step forward in the lengthy process to join the bloc. EU leaders are set to discuss the matter next week in Brussels. Germany's Olaf Scholz, France's Emmanuel Macron, and Italy's Mario Draghi endorsed Ukraine's membership bid during their trip to Kiev. Less than a day after Revlon's filing for Chapter 11 bankruptcy, Citigroup's now infamous payment error to its lenders has been raised as an issue. 2 years ago, Citi wired creditors the balance of a $900 million loan, the principal rather than just the interest, and then failed to get most of it back. Court papers now show the bank's blunder is likely to impede the cosmetic giant's restructuring plans. Coming up, we're going to speak with Anthony Trenchev, the co-founder of Nexo. After the blow-up of Terra and then Celsius, we'll ask him how he's doing in the crypto lending business and what he expects for the future of the industry. This is Bloomberg.
En nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modelizaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Ever the outlier, the BOJ resists the global wave of central bank tightening, sticking with super easy monetary policy, and that hit the yen again. Under construction, officials are working on a call between Presidents Biden and Xi, with tensions high between the world's two biggest economies. And the BOE's next move, our exclusive interview with the Bank of England chief economist Hugh Pill, that's straight ahead. Good morning, everybody. I'm Anna Edwards in London with Matt Miller and Kriti Gupta in New York. Kaylee Lyons is off today. And Matt, we've really seen a wild ride for various asset classes. FX certainly been led on a wild ride. The yen, the pound, all been very volatile in the slipstream of monetary policy, if you like. Stocks looking for a little bit of direction this morning, but it looks as if it's upwards, rebounding, attempting to rebound.
Yeah, I mean, the yen has been more volatile than the Brazilian real. So really wild developed market runs. We've seen a lot of swings in stocks as well. Remember, the S&P cash trade closed down yesterday, another 3% in change. We have gone from basically 4,000 on Thursday to 36.66 yesterday. Little bit of a bounce here in futures, maybe to be expected after such a big drop. So right now we're up 0.9% on futures. You could see a positive open this morning, but who knows how that plays out going in to the weekend, right? The 10-year yield coming up a little to 321, but this has been a wild ride as well. We've seen yields on the 10-year up to 340. So the fact that we're back down to 320 and coming up a little bit, it just shows you how far we've moved. The same is true with NYMEX crude. 118.58. At one point this week, we were up at 124 here, and we came down significantly, obviously. Now we're up 99 cents to almost 119. And then Bitcoin at 174. What a ride this has been. Just last week, Kaylee and I were talking about the possibility of dropping Bitcoin from the board because it wasn't moving out of the $30,000 range. Well, a 30% drop in a span of 7 days will ensure that we keep this on the board for a while. Right now, 21,049, and we're watching for the next levels lower. Kriti, what do you see in terms of the pre-market movers?
Well, I think that broad rally that you were just talking about is really the key here. If you're actually looking at something like Carnival Cruise Lines, I really like to look at this name as like a proxy for this broad rebound. It's not just your tech-heavy names. It's not just your cyclicals that are outperforming. It's across the board, and that's going to be significant, up 3.3%. Remember, those cruise lines, those airlines, are also volatility proxies. So if you see higher volatility, lower liquidity, which has been the theme lately, Carnival Cruise Lines is going to be one of the names that moves quite a bit, so keep an eye on that one. The other one I want to take a look at is the ADRs of the Taiwan Semiconductor Manufacturing Company. This is the company that has the largest production of chips around the world. It's an Apple supplier, for example. They are actually up, this coming off news, that one of the most advanced chip-making tools that is competitor ASML, the Dutch semi-equipment maker, well, TSM could get their hands on it as soon as 2024, so that's going to give those shares a little bit of a boost, up 1.2%, but it's not all green on the screen. There are some downside stories. Adobe, for example, coming out with their earnings after the bell last night, saying that they're cutting their sales forecast this morning. The question among analysts is, can they actually execute in the areas where they are still strong, given the lack of demand? Those worries weighing on those shares to the tune of 3%, Anna.
Yeah, Kriti, to your point about what we saw in markets yesterday, there was breadth and there was volume. Today, we see a recovery in European stocks then, not rebounding from all of the losses of yesterday, but making an attempt, at least, up by 1.1%. And again, this has some breadth to it. Certainly, most sectors here in Europe are in positive territory. We see demand for 5-year Italian government debt. In fact, we see demand for peripheral debt in general. This following the reassuring, the soothing words from President Lagarde over at the ECB, where she says there could be intervention in bond markets if they did see the spreads blow out to levels that they don't like too much. And this is another interesting one to follow, another interesting asset to follow this week, up by 4.3% on natural gas prices. This is the benchmark for Europe. We've seen today it's the turn of Italy and Slovakia to say that they're only receiving 50% of what they ask for from Gazprom. So that conversation, that relationship between Europe and Russia when it comes to gas getting more interesting by the day, pushing up these European gas prices by the most this week than we've seen since at any time since the war started. So that's an interesting stat. The Nokian Renkat share price, this is a tire maker, a supplier to the auto industry, and it's a positive story just to show that everything is not gloomy here in Europe. They do have pricing power though, so that doesn't help on the inflation side. They have pricing power, and they say that demand for tires at least is looking good, and they upgrade their guidance.
Some of the best winter tires there, Nokian. Very good for snow and ice. Now, pressure continues to pile on for digital assets. Binance CEO CZ, however, says the crypto winter presents its own opportunities.
Now is also the best time to do M&As, mergers and acquisitions. So we're also looking to do that. So in bull markets, raising money is better. Investing is actually very hard because everything is very expensive. But now in a bear market, we see a lot of good deals on the table now.
Joining us now is Anthony Trenchev, Nexo co-founder, and Anthony, really a distinction in that you're a solvent lender, still operating your business. We've seen some incredible failures in the space over the last month, starting with Terra Luna on the Anchor protocol, and then Celsius halting withdrawals. What has brought this about? Why this crisis in confidence?
Well, you know, when the tide goes out, you see who has been swimming naked, and unfortunately, a lot of companies have been doing that. It all goes back to, you know, prudent risk management, which we always adhered at Nexo. You know, and a lot of the actors have engaged in risky activity, amongst others, you know, uncollateralized lending amongst themselves to then take risky bets, and this has caused some solvency issues for a lot of players. And you know, I'm happy to be as one of the companies that is in a very good position. And the great thing about it is you don't have to take my word for it. You can go online and check the real-time audit on our assets that we did with Armanino. Well, times were good and everybody was greedy. You can see that our assets exceed our liabilities with more than 100% all of the time.
In terms of the customers that have been left hanging, one need only look at Twitter to see they're messaging you, asking about your business. They're sort of up for grabs, right? You can take them, and there are also assets that will likely be for sale. At Celsius, for example, are you planning on taking advantage of this situation and growing Nexo?
We're planning on helping remedy the situation for the entire ecosystem. I want to echo what CZ just said. You know, this reminds me, quite frankly, of the 1907 banks panic, where JP Morgan was forced to step in with his own funds and then rally all those guys that were solvent to fix the situation. That was pre-Federal Reserve, so no lender of last resort. So the situation right now is very similar. We have been approached by three household names and Wall Street banks who are looking to leverage their expertise with the ones that are solvent to help remedy the overall situation. And this is what we're looking at. There are going to be a lot of consolidation. There are ongoing processes that are unfortunately cannot comment on, but this is definitely where we're heading: acquisitions and a consolidation of the space.
Anthony, let's talk about a little bit about Three Arrows Capital, of course, the crypto hedge fund that hasn't been able to meet some of its own liabilities. I want to ask how worried we should be about that situation and whether or not you have exposure to that crypto hedge fund.
We have zero exposure to Three Arrows Capital. You know, truth be told, a few years ago, they came to us and asked for an unsecured loan, which we did not feel comfortable providing because it goes against our risk management parameters, and they got it elsewhere. I think what has happened to them is to a large extent already priced in. The sell pressure that we saw on Monday and Tuesday was Three Arrows Capital being liquidated because they couldn't meet their margin calls. Thus far, things appear to be calming down, so I'm not worried about ripple effects immediately. But you know, the lenders that gave them unsecured loans, they are not in the greatest of spots, and we have to be carefully watching how that unfolds and to make sure that we return to best practices after this whole mess resolves itself.
Anthony, Bitcoin currently around 21,000. What do you make of the crypto winter and where Bitcoin prices head from here? Some of our colleagues writing about how we've dropped to levels that are below the peak of the last cycle, the peak achieved during the last halving cycle. Is that significant for you? How much downside is still left here?
Well, I think all the negativity with all the solvency issues and the pressure that we saw on the market is already priced in. I think there's a very good chance that these levels around 20,000 hold, which coincidentally are the previous all-time highs of the previous bull cycle that ended 2017, 2018. So there's a very good chance we see a relief rally here. But it also depends on how the overall risk on assets are performing. You know, you can have the S&P go down 3% a day and expect a heavy rally in Bitcoin. But just a quick reminder, last time we had this type of volatility in Bitcoin and it lost like 50% intraday was in March 2020. And out of those levels, it went then to go 10x and reach levels of 50,000. So after the deleveraging and de-risking of the sector, I think we'll be back in a rampant bull market.
So by the time we get to the next halving, Anthony, do you expect Bitcoin to be at new records again?
I do expect that.
Want to give us a target? Want to give us a number?
I stick by my guns and my target of 100,000 within 12 months from now. And this will not be by any measure the craziest thing that Bitcoin has done.
That's punchy. Anthony, thanks very much. Thanks so much for joining us. Anthony Trenchev of Nexo. Coming up on the programme, back to the central banking theme of the week. Hugh Pill, Bank of England chief economist, joins us. This is Bloomberg.
期待呢为开春的时候为各国运动员和随队官员提供热情周到的服务。
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kriti Gupta in New York. Now, the Bank of England raised interest rates to the highest since 2009 this week. Joining us now for an exclusive interview is the Bank of England Chief Economist Hugh Pill, and we're also joined with some wacky camera work by my colleague Francine Lacroix. She didn't do that. It was nothing Francine did.
I like
welcome,
the camera
Francine.
work.
Welcome to Hugh.
Welcome. Thank
I mean, it was quite a day. What stresses me out is that every time you hike rates, and I get a text message actually from my mortgage broker saying your interest rate has gone up by this much. Hugh Pill, it's a great pleasure to speak to you. Yesterday there was a little bit of, something for the hawks and something for the doves in terms of what you did with interest rates, but also the statement afterwards. So you talk about forcefully opening the door for 50 basis points. That was in the statement. Or forcefully actually opening the door. Does that mean that we could see a 15 basis point hike?
Well, I think you will have to make your own judgment, and financial markets will make their own judgment about that. And I don't really want to comment in detail on the judgments that are being made. I think there are sort of two elements of the statement we put out yesterday that are important. I mean, the first thing is that it was a statement that encompassed the whole of the committee. And I think it's self-evident from the vote that there have been and are different views on the committee. And that's probably a healthy thing in quite difficult and testing times for monetary policy, that we have this diversity of view. I don't think we have any groupthink on the MPC, and I think that adds to the robustness of our decisions. So the statement that we put out collectively is one that I think had a certain level of flexibility because it had to encompass those different views. But at the same time, I think what we were trying to emphasize is that flexibility also applies to what the decisions are. I don't think it's all about August. We talked about the pace, timing, and scale of future decisions. And crucially, I think the word forcefully, which clearly is a word the market is focused on, you've focused on, and has a meaning. It's also important to see that that was put in the context of, if necessary, we will act forcefully. And so there's a conditionality there.
Was that to drive the markets? Was that, again, to put that 50 basis point hike on the radar, given what we'd heard in the past?
I mean, I think it's fair to say, speaking from a personal point of view and thinking about the committee more widely, I think our previous form of communication had become a bit stale because it was seen as implying we're moving in a quasi-automatic way. The thing I would emphasize is we changed the communication in order to encompass the diversity of views, have a collective communication, but also to create the flexibility to respond as necessary to risks going forward. There can be risks in both directions.
Does the Bank of England feel like you're behind the curve in fighting inflation?
I mean, as we said in our minutes yesterday, we are acting in order to stabilize medium-term inflation expectations in line with our target. We are doing what we think we need to do collectively in order to re-establish inflation back at the target, respecting our remit, which is to do that without creating unnecessary volatility in output and employment. I think we've made a set of decisions. We started earlier than some other central banks. Cumulatively, since we started, we've done as much with bank rate as other central banks have done, perhaps more quickly in recent times. We've also started shrinking our balance sheet, shrinking the QE portfolio earlier through stopping the reinvestments. So clearly, in these testing times, we're trying to signal, yes, we may need to act further. I think you've identified that. I think financial markets have identified that. We've tried to signal the thing we're looking at, which is the persistence of inflationary pressures. We're not acting to spot inflation, which we know is going to go higher as a result of energy price movements and other things of which we can't really contain in the shorter term. But if we do see greater evidence that the current high level of inflation is becoming embedded in pricing behavior by firms, in wage setting behavior by firms and workers, then that will be the trigger for this more aggressive action.
Because that's what I wanted to ask you about. You referenced it, that word persistent. You're alert to more persistent inflation, and some commentators said, well, haven't we got fairly persistent inflation? We've certainly got elevated levels of inflation well above target. So give us a little more detail on what it is you're watching for that makes the difference between the 25 that we've become accustomed to and the 50 which takes you out of autopilot.
Right. Well, I think you make an important distinction between elevated and persistent. Inflation is uncomfortably high, for people who are having to pay their energy bills, like we all do, but certainly uncomfortable for a policymaker who has a target of 2%, is seeing inflation of 9%. But a large part of that heightened level of inflation, that elevated level of inflation, reflects the rises in oil prices, the rises in wholesale gas prices. And we know, because of the way we set retail utility bills here in the UK through the Ofgem cap and so forth, we know that given developments in markets that have already happened, there will be another step up in the utility bills and therefore in headline inflation later in the year. But the key thing is that we assume and we hope that those energy price rises will eventually stabilize. At that point, what matters for our policy decision, given the lags it takes between setting interest rates today when they begin to affect inflation, is whether the underlying rate of inflation becoming more persistently embedded and entrenched, and that's the type of thing we're looking at. And the key things to focus on understanding that are looking at many domestic indicators, how firms are setting prices, how much pricing power they have, the influence of margins as they try and re-establish margins after some of the increases in costs they faced of late. And of course, in the labor market, which has been very tight, whether we see wages pick up, whether we see the current elevated level of wages, once you include bonuses, remain at its high level.
So you talked there about, you mentioned that you've moved earlier than some other central banks, and that's certainly true. Do you think there's any argument that maybe you've squandered that first mover advantage by not being aggressive enough at the Bank of England in the earliest stages, meaning that maybe you have to tighten much more aggressively into a slowing economy?
Right. Well, I think that we have an easier answer to that, is we are always setting interest rates to pursue our remit. So our remit is to get inflation back to target at a horizon that doesn't create this unnecessary volatility in employment and activity. And I think we're always endeavoring collectively to do that. So I don't think it's a question of we are behind the curve. I think we're doing what we need to do, balancing the two risks, as the governor has talked about, the narrow path between two risks. The risks of not acting aggressively enough with monetary policy and allowing more than we would want inflation to become embedded and leading to greater persistence, and meaning that we're not really achieving our core objective. But at the same time, recognizing that if we act too aggressively, we can switch the economy into a slowdown which is undesirable.
A lot of critics say that you've consistently underestimated inflation. Do you think those critics are right?
I mean, I think we have certainly had to revise up our forecasts over the last year, 18 months. So in the sense of the outcome of our forecasts, yes, we have underestimated inflation. But I mean, I've only been at the bank, for the last 8 or 9 months. We have had a series of very big shocks, and shocks that were unanticipated. I mean, notably the invasion, the rise in energy prices, and so forth and so on. Omicron, one could extend to other things too. So I think it's important to see that a large part of why inflation has been revised up, our forecast has been revised up through time, has been the incidence of these new shocks. Shocks by nature we couldn't anticipate. And I think, the key thing to see is that even if we had known those shocks would come, monetary policy just cannot respond quickly enough or have an effect quickly enough to bring inflation down in the short order. So what we're doing, and this is very key to the statement we put out yesterday, is we are acting in the face of trying to avoid this persistence of inflation, because the actions we take today will affect inflation in a 12 to 18 month time. So it's those movements that are not driving inflation up and down in the short term to which we can respond. It has to be how we see the implications of those shocks for inflation at that type of horizon.
Thank you so much, Hugh. Thank you very much for joining us. The Bank of England's Chief Economist, Hugh Pearl. Thanks also to Bloomberg's Francine Lacroix for joining us for that conversation. Coming up on this programme, Ferrari says they will never offer a self-driving car. I guess that's not why you buy a Ferrari. Part of our interview with the CEO. That's coming up shortly. This is Bloomberg.
energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We did not suffer any shortage in this direction for two reasons. The supply chain team did a good job, and also the partners supported us a lot. If you ask me what is the view on the semiconductor world in general, I'm not so much in it. I hear different voices. Someone is claiming that by year end the situation will be normalized. Someone else is claiming that instead we still need 2-3 quarters.
That was Benedetto Vigna of Ferrari speaking with Matt Miller yesterday, who just got a glimpse of. Matt, we were just discussing in the break whether you would want to have a Ferrari that drives itself. Of course, the CEO says no. Matt, your view?
Yeah, I think that, you know, of course, if you're on a mountain pass driving by yourself, you're going to want to handle the car. But when you pick your husband up at the airport, you might want to put it on auto drive on the way home.
Good advice, I'm sure. I'm wearing the right colour dress anyway to do just that. That is it for Early Edition. Surveillance is ahead. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
the Fed's forecasts are still remarkably optimistic.
All these numbers they threw out are fantasy land. The unemployment rate's fantasy land. The rate at which inflation is going to come down is fantasy land.
It feels like global inflationary pressures have the upper hand.
Fed rate hikes just take a really long time to impact the economy.
I just wonder whether we're going to look back and say, we were in a recession. We're already in a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Let's get this week wrapped up and get you to the weekend. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Together this morning with Damien Sasser. TK taking a long weekend. Futures up 0.9% on the S&P. Bramo coming into today, we're down 6% on the S&P 500 this week alone.
We saw the lowest levels going back to 2020, the November of that month. How much have we already baked in recession? We were looking at certain models yesterday that showed that the S&P is pricing in an 85% chance of a recession in the United States in the near term. Okay, so are we there yet?
And more importantly, how much damage is this Fed willing to do?
Yes.
How much damage is this Fed willing to inflict on this economy?
A lot of people are saying that they're willing to cause a recession in order to bring prices down, to bring the pace of the pace increases down. It seems like they are committed to that. But as we've been talking about all week, let's see how strong their commitment is when we start to see negative prints on the jobs numbers, when we start to see some of that weakening data filter in, and when we start to question how much some of the tightening is actually bringing prices down, considering where the shocks are coming from.
Starting to see credit breakdown just a little bit. Damien, we talk a lot about this. Are you seeing any sign of stress emerging in this market?
Oh, absolutely, Jonathan. I mean, lack of balance sheet dealer elasticity is going to be the key risk here now that quant tightening has officially started. So we're completely focused on that. And look, you've got fixed 30-year mortgage rates now pushing up to 6%. Something's going to crack there. It may be triple Bs, it may be private residential MBS, it may be CMBS asset backs, but it looks like it's going to be tough sledding for fixed income investors.
Damon, we've spoken to a lot of people through the year so far who have this big cash position. Does 500 basis points plus on high yield spreads get it done to bring that cash into play?
You know, I'm not so sure. You know, I mean, look, what have we seen in IG spreads? 50 bips. What have we seen? 225 bips in high yield. We're not there yet. We really haven't seen, you know, that real gap widening in spreads yet, in my opinion. I think we need to see that before we really see a market bottom here.
Lisa, we saw that move yesterday, a sizable one.
And a lot of people are saying that they want to move into that higher rated credit because they are starting to get concerned, not about a default cycle necessarily, but a deterioration in credit quality. We still are looking at balance sheets that look pretty good. When you keep talking about that, how far can you go with respect to the sell-off without some sort of liquidity issue? And that, I think, is what people are focused on.
Lisa, you're in for a treat today. We're not going to talk about football, or soccer, as Tom might call it. Damien, you get to choose. You get to you get to do basketball, Damien, or you get to do a little bit of golf going into the weekend.
Oh, I mean, well, I'm not going to ignore golf, but we can't not talk about the NBA Finals. Steph Curry, NBA Finals MVP. I mean, that's his 4th championship. I mean, it's a real dynasty out there in San Francisco, and the Bay Area's got to be thrilled this morning. If anybody's still awake, congratulations.
I imagine they're just going to bed. We're going to squeeze some Rory McIlroy into this show today as well. I can't wait for that. Lisa can't wait either.
Honestly, you come out, you're like,
Do you know how this started?
I have a treat. I have a treat for you.
Before Damien came on air, I went over to him and said, what should we talk about? And he goes, I want to talk about liquidity and credit. I said, no, sport. What do you want to talk about? He said, basketball. So we'll do a little bit more of that later too. Futures up 0.9 on the S&P 500. Here's your price action this Friday on the Nasdaq 100, up a little more than 1%. Equities advancing to close out the week, for now at least. Will this move stick after a brutal week of losses on the S&P coming into Friday at the close on Thursday? Yields higher by about a basis point on a 10-year. We're back to 321 after having a little look at 350, back all the way down into the 320s again. In the FX market, euro-dollar just about holding on to 105 here, Lisa. Euro-dollar negative 0.2%.
And so all eyes do go to Europe with respect to how far they will go, considering the fact that Bank of Japan seemed to double down overnight, saying, you know what, we're going to keep this peg. And people said, okay, so we're going to sell the yen. Today, 8:30 a.m., President Biden is hosting the Major Economies Forum on Energy and Climate. The reason why I find this particularly interesting is how does he shift his message away from the pure adoption of some of these greener technologies to a recognition of the the price of gas, which is the main mode of fossil fuel usage right now in the United States, the main mode that people use to get around, price is still hovering above $5 a gallon. This is a huge liability for him heading into the midterms, heading into 2024. How does he dovetail this really fragile message? 8:45 a.m., Fed Chair Jay Powell comes back to the podium saying that he's going to talk about the dollar and its role in the international financial markets. This, as the dollar generally has been strengthening pretty steadily to some of the highs that we last saw during the peak of the pandemic. How much does he talk about the transmission mechanism that has and the potential disruptive factor that could play in the global economic recovery? And at 9:15 a.m., we get U.S. May industrial production. How much do we get factory output increasing and factory capacity usage increasing in order to offset the demand? In other words, what happens if we actually get increased supplies, John? Is this issue with inflation a supply-driven issue, a demand-driven issue, a bit of both? What could we do to equalize the supply side in addition to just simply dampening demand?
You know, the stat I saw recently on capacity utilization was on refineries at 94%. Which historically is very high, which kind of pushes back against this idea, Lisa, that the oil players are holding some back.
It also pushes back against the idea that gas prices could come down anytime soon, because if they're actually using them to full capacity, basically, where is the marginal production going to come from when it comes to refining the crude that we get from wherever the supplies are, even if it is from Saudi Arabia?
Lisa, thank you. A bit calmer today after a hectic week so far, up 0.9% on the S&P 500. Joining us now is Eric Robertson, the Global Head of Research at Standard Chartered. Eric, great to catch up, sir, as always. You've had a unique perspective over the last couple of months. You didn't think the Fed would take it this far. You thought they'd go strongly in summer, but ultimately then have to stop because the data was going to weaken. Eric, can you walk me through how your view on that has evolved, particularly after the last Fed meeting?
Yeah, sure, guys. Thanks very much for having me. Look, I think the narrative is still roughly similar to what we've been thinking about for the last couple of months, which is that the combination of Fed rate hikes combined with the other central banks around the world getting on the same bandwagon would lead to a real hit to economic growth in the second half of the year. I think what has probably been a little bit different than we expected is how elevated inflation has been and for how long. And so the Fed is really in this horrible situation where their monetary tightening is going to lead to a fairly negative economic activity environment set against what is still a pretty elevated inflation environment. Now, as we get into sort of the third and the fourth quarters, we think the hit to growth in the U.S. and globally is going to be really pretty profound. And I think that's going to raise some uncomfortable questions for the Fed and probably for other central banks as well.
So what's the trigger, Eric, for them to pivot, for them to perhaps dial back some of their rate-raising expectations?
Yeah, sure, Lisa. Look, everybody likes to talk about the Fed put and how far equities or credit have to fall before the Fed panics. I think in the current economic circumstances, it's not going to be market-driven. I think it's going to be something along the lines of the unemployment rate moving higher and a combination of other job statistics. The reality is we need to see a softening in the labor market to see a softening in wages, and that's going to be a big part of easing inflation expectations. So I don't think the Fed put is the S&P. I think it's the labor market.
Yeah, you know, Eric, everybody and their grandmother has been operating as if the PBOC is going to cut rates eventually. But, you know, we haven't seen that yet, largely because of widening U.S.-China yield differentials. You know, I wonder what your thoughts are there. I mean, clearly the dollar yuan's taken a hit, adding to the risk of capital outflows. But can we expect some monetary stimulus in the months ahead from the PBOC?
Damien, I think that's a really good question, but I think the answer is that it's unlikely. And there's two really important reasons for that. Number one, China historically does not like to be moving rates in the opposite direction of the rest of the world's central banks for exactly the yield differential story that you highlighted. And certainly with the other central banks of the world being so aggressive, I don't think the PBOC wants to be moving in the opposite direction. But the other issue, and this is a bigger picture and perhaps more profound issue, is China has really shifted its stimulus focus away from monetary stimulus to fiscal. And I think that's because they've learned some lessons about the downside effects of excessive leverage. They want to see an economic recovery with stable liquidity, stable leverage in their system. And I think they feel more comfortable directing fiscal stimulus into the economy over the next 6 to 12 months rather than monetary stimulus.
Eric, great points, as always. Interesting perspective. Eric Robson there of Standard Chart. Damien, I don't know if you saw the latest forecast out of Bank of America for China GDP. It has a 3 handle. Oh. It's down from 4.2. It's now 3.5. Yeah. Damien, from the people you speak to, are we ready for that kind of GDP print from the Chinese economy?
You know, I mean, I don't think we are, quite frankly, but that's really where we're headed here. I mean, look, you know, if you just look at the spillover into the broader Asian complex, I mean, Jonathan, that's the real risk. And quite frankly, it all goes back to dollar yen, not dollar yuan, dollar yen, because as that goes down, that's putting pressure on other Asian exporters like the South Korea won, the China yuan. I mean, that's really where the rubber meets the road, in my opinion. And then everyone starts pushing against the US dollar, trying to depreciate their own currencies. And Lisa, that gets messy quickly.
Especially because how far do they have to go in order to do that, and what does that mean for their growth perspective? I mean, we saw that yesterday with the Bank of England, how their dovish 25 basis point rate hike was received. At the same time, if you do get economic deceleration, how much do you get to a Bridgewater scenario where the dollar does weaken? Let's say that the Fed does go more aggressively. Does that become dollar negative at a certain point because of the pain that needs to be incurred?
What did you make of the BOJ overnight?
Predictable, and also just kind of curious to me because it really raises the threshold for them to pivot, and they're going to have to, right? I mean, did you see the positioning overnight? It was the highest level since 2013. People were betting against JGBs. I mean, they were trying to basically say, stop it, guys. This isn't going to work.
How many JGBs are they willing to own, Damien? That's what I'm trying to work out. How far are they willing to take this? Most people assume they're going to nationalize the bond market. Most people say, that I speak to anyway, that it's not much of a market anyway and that it's already been nationalized.
It's already been nationalized, yeah.
It's a centrally planned government bond market in Japan and seemingly no willingness to turn away from doing that anytime soon. Italy in the mix on that front too. We'll talk about that in a moment. Coming up in the next hour, Victoria Fernandez, Chief Market Strategist at Crossmark Capital. We'll catch up with her at around 7 a.m. Eastern Time. Futures right now, you're waking up to a little bit of a bounce, up 0.9% on the S&P 500 this morning. Good morning to you all. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Ukraine is one step closer to becoming a member of the European Union. Bloomberg has learned the European Commission has recommended Ukraine be granted candidate status with conditions that Kyiv will have to meet in the future on the rule of law, justice and anti-corruption. It's significant for Ukraine, but there's no fast-track path to speed up the arduous membership process, which can normally last more than a decade. Russia's invasion of Ukraine caused one of the fastest and largest displacements of people since World War II and helped push the number forced to flee their homes globally to the highest annual level since the United Nations began keeping track. The UN Refugee Agency said today the number of people displaced around the world tops 100 million, and the war in Ukraine has displaced about 8 million people within that country so far in 2022. The World Trade Organization has approved a deal to water down intellectual property restrictions for the manufacturing of COVID-19 vaccines. The head of the WTO has previously said she wanted to end what she called the morally unacceptable inequity of access to COVID-19 vaccines. The deal delivers a blow to vaccine manufacturers such as Pfizer, Moderna, and AstraZeneca. Hong Kong's outgoing leader Carrie Lam is urging residents to avoid banquets and other large gatherings amid a resurgence of COVID-19 in the city, but she held off from imposing new restrictions as serious infections remain low. Lam said today the number of new daily cases has topped 1,000 for the past 3 days, the highest level in 2 months. Fewer than 24 of those people are in serious or critical condition. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
Problem with a deep recession right now is you're not getting the fundamental drop off that the big earnings destruction. Right now, as we sit, if it is going to be a shallow recession because we haven't had the drop off in fundamentals to the magnitude of a deeper recession.
Keep throwing this R word around, recession. We need to talk about what kind of recession we'll get if indeed we do get one. Andrew Slimman there of Morgan Stanley Investment Management, alongside Lisa Ravitz and Damien Sasser. I'm Jonathan Ferro. TK, Tom Keane out of the building. Futures up 0.9% on the S&P 500. The Nasdaq 100 up a little more than 1%. Yields climbing higher by a couple of basis points. 321.81 on a US 10-year. The president's sitting down with the press. Lisa, the print press for the first time, I think, since February, to do a one-on-one interview with AP.
Yeah, to basically talk about how the U.S. can still avoid recession, how he can get down inflation, how it's not due, and this, I think, was the biggest takeaway, a huge defense about how it wasn't due to stimulus that inflation picked up so much, that was not a main driver, that he has talked to Yellen. It was sort of a nod to that whole interview, and basically rejected that as one of the significant reasons why we have inflation that's so much higher than people expected.
Acknowledge that people are really, really down.
Yeah.
That's something that has changed over the last few months, because this is a story they tried to deflect, tried to ignore going into the back end of last year, and it's the kind of story you can't ignore anymore.
Especially not with approval ratings that are as low as they are, and especially not with gasoline prices at $5 a gallon, and not with the grocery store bills that are driving people to feel pretty negative, at least if you look at the University of Michigan Sentiment Survey.
Emily Wilkins joins us now of Bloomberg Government down in D.C. Emily, what did we learn from the president yesterday?
So, I mean, Biden is really trying to really push the message here that his administration is doing whatever they can to keep the economy good. He knows that inflation is a problem. He knows it's going to be a problem in November when Democrats look to keep the House and to make gains in the Senate. But you really kind of see that the president's really relying heavily on messaging right now. You've seen officials within the White House sort of really going on TV, talking about the things that the administration is doing. A number of them actually came to Congress yesterday yesterday, met with House Democrats. Really nothing new in that meeting, but just hammering home the various talking points on inflation, on the economy, on what the Biden administration is choosing to do. And I think this interview yesterday was just even showing more. It's not very common that this president sits down with the print media and gives an interview. So the fact that he chose to do it and chose to do it on this topic shows how desperately the White House is trying to get the messaging aspect under control. But of course, you know, Americans, when you're driving around and you're seeing the gas prices, when you're going to the grocery store, I mean, that tells an entirely different message, and it's something that Democrats are trying to grapple with.
Emily, how much discussion is there about the strong message of changing up the cabinet?
We haven't heard a ton of that yet. There was certainly concern within the White House after Treasury Secretary Janet Yellen did say that she had been wrong about inflation, wrong that it was only going to be transitory. That's certainly something that sent ripples through the administration and Washington, D.C. But at this point, we haven't really heard anything concrete about changing things up. We have seen some turnover at the White House, just various folks within the administration. Part of that could be they've been there for 2 years. It's a pretty grueling job. They're looking for something potentially new. And part of it might be sort of reading the tea leaves. I mean, this is an administration that has very low approval ratings. Recent Morning Consult poll showed that only a quarter of Americans think the country is on the right track. It's not exactly a super positive time to be in government here.
Which raises the questions about 2 years from now in 2024, when President Biden may be running for re-election, how he should get ahead of this and how the Democratic Party should position if his approval rating doesn't recover all that much. What is the discussion when it comes to bringing in another frontrunner for the Democratic Party to potentially run in 2024?
You know, Lisa, that's a really great question. At this point, Biden has said, and said again this week, that he will be running in 2024. But certainly there are a number of contenders within the party who would potentially be looking to make a run. Should that change, or should they feel like they are the ones who really need to step up? And I think there's also a big question, too, who winds up being the Republican nominee? Is it Donald Trump again? Is it someone else? What sort of matchup are you looking at there? In terms of really what Biden is trying to do, they are looking at what minor levers they are able to pull on the economy. You see that Congress right now is working on a bill to bolster U.S. manufacturing, development, research. That's something that as it continues, you're going to be hearing more and more discussion that this is a bill that's going to address supply chains, that's going to try to address inflation. But really, this kind of goes back to the fact that the White House can only do so much from inside D.C., that this is a problem that does have some global implications and still is tied up in the COVID-19 pandemic.
You know, Emily, I believe you're referring to the bill where we're talking about increasing competitiveness with China, right? The $50 billion for semiconductor manufacturing, all that kind of good stuff. I think President Biden and President Xi are expected to have a call in the not too distant future. I think there's a trip planned. I mean, what are your thoughts on that? What's the tone on the relationship between the U.S. and China?
So we're still learning some more details about this potential call. It's in the works right now. It could occur as soon as July, and we're keeping a close eye on this simply because we've seen top U.S. and top Chinese officials meeting together. We saw a national security, Jake Sullivan, talking with his Chinese counterpart for 4.5 hours in Luxembourg this last week. And so that seems like a potential signal that you're going to come up on another phone call between Biden and Xi. And as far as what's going to be discussed, you're hearing some top administrative officials saying that it's really important to set some guardrails in that relationship between Washington and Beijing, make sure that any disagreements between the countries don't escalate to a larger conflict. Certainly many areas where that could happen, notably in Taiwan. There's been the reporting that Chinese officials are trying to sort of claim the Taiwan Strait while the U.S. is saying it's international waters, and a lot of sort of question marks, I think, in that area of the world about what might come next.
Emily Wilkins down in DC. Emily, thank you. Just to build on Damien's question, Ambassador Nick Burns, old friend of this program actually, saying if we want stability in the relationship, that takes connecting. Damien, your thoughts on policy? That's what I want to talk about here, not the dictator tour. Going to speak to Crown Prince Mohammed bin Salman, catching up with President Xi. What does it mean for policy?
Well, I'm so happy you just brought up Saudi Arabia. I mean, look, there's winners and losers in every market, and Saudi Arabia is certainly a winner. I mean, they're going to have a budget surplus of 10%, a current account surplus of 16%. And Jonathan, their GDP in nominal terms is going to rise to $1 trillion next year. That's a 50% increase over the last 3 years. And by the way, Biden, you're absolutely right, just announced for finally an ambassador to Saudi Arabia, and he's planning a trip there next week. So we can actually see the carrot stick being lent out.
And the problem's on the screen, Lisa. It's Brent Crude, 121.
Yeah, the winners right now are noteworthy. It's not just Saudi Arabia, it's also Qatar, and how they have a huge natural gas resource, and so Europe is tapping them. I mean, all of the players in the Middle East that are getting emboldened and enriched by this current era.
Big foreign policy implications. Futures right now up 0.9% on the S&P 500. We'll be catching up with Howard Ward, the CIO of Growth Equities for Gabelli Funds. Looking forward to doing that in just a moment. From New York City this morning, good morning to you all. Heard on radio, seen on TV, this is Bloomberg Surveillance.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Looking to wrap up a really brutal week on the S&P 500, down about 6 percentage points through the close into Thursday, on the week so far into Friday. Trying to bounce back and snap some of that trying to bite into that loss this week, up by 0.9% on the S&P. On the Nasdaq 100, up a little more than 1 full percentage point. Still heading for the biggest weekly loss since the pandemic. So far, at least. Let's see what happens this Friday. Let's get to the bond market, 2s, 10s and 30s. Your 2-year yield up just 9 basis points so far on the week, but you put it together with last week, a move of 41, up about 50 basis points over the last 2 weeks. Some big moves here in the bond market. Yields higher again by 6 basis points. With the front end now, your yield on 2s, 3.15, let's call it 3.16 on 10s. Around about 3.22, came close to 3.50 a little bit earlier in the week and then backed away. Earlier in the week, the spread between Italy and Germany, 240 odd basis points. Now, about 190. Take a look at this. Italy versus Germany. That spread is getting tighter. The difference between the two getting narrower. The story, the ECB. The ECB pushing back and saying they're going to come up with a mechanism, a vehicle to deal with this. And Lisa Visco of the Bank of Italy turning around and saying that maybe 150 is justified. Basically giving a number, telling you the number that is justified. I mean, this is central banking in the modern era, I guess, but it's getting a little bit ridiculous.
Well, he said that that it shouldn't exceed 200 basis points, that if actually you look at the spread, it should be under 150 based on economic fundamentals. This has got to really bother people in the ECB. They're trying to actually help out, and he says basically you're not doing enough, and by the way, everybody just has it wrong, and please price it better.
So is that a ceiling on the Italian 10-year spread with Germany, or is that a floor? Is that basically telling the market this is justified, 150? Is it a floor or a ceiling? How do you think about it?
Is anyone listening to him? That's my question,
Clearly
because
the market's
he's not the one with
responded,
power.
though, Lisa, to some extent the market's responded to this, right? Do they need to follow it up and actually do something? The words are working. For now, we've gone from 240 to 190. Something's happening here.
Yeah, but the cohesion in the ECB in terms of how far to go with that bond purchasing program, are they going to go full Japan in terms of controlling that entire market, or are they going to be a little bit more receptive to what the risks actually are being priced?
That's what we're calling centrally planned bond markets now, full Japan. Euro dollar 105.17. That currency pair, Lisa, down about 0.2%.
Yeah. I'm watching the euro. We saw it break down to 103. How much do we start to see parity, the main theme, especially as the ECB has a real rock and a hard place to parse through right now?
Something to look for over the next couple of weeks.
So right now, I want to get a sense of how much we are looking at a buying opportunity, and that's something that a lot of people have been talking about. How much pain have we already baked in? Howard Ward has typically focused on growth equities. He does have the chief investment officer hat for growth equities at Gabelli Funds, alongside Howard Gabelli, Mario Gabelli. How much are you looking right now, Howard, for looking at a buying opportunity of some sort of ceiling in yields that we already surpassed with the confirmation from the Fed this week?
Well, Lisa, it certainly has been very painful. The pendulum has swung from full greed to, I think, pretty full fear, and that's the good time generally to be buying stocks when they're down. You got the S&P down over 20%, the Nasdaq down over 30%. A lot of stocks down 40, 50, 60, even 70%. And so I have to believe that unless you think interest rates are going materially higher, this is a good entry point for stocks. And I would note that we think that the reset to multiples from higher interest rates is probably mostly baked in at this point. And I think it's important to realize that after the Fed raised rates this week, which I think reinforced some credibility, which they've been missing in terms of inflation fighting, after they did that, the 10-year bond yield declined. It's about 20 basis points lower than it was earlier this week, as Jonathan just said. So we've had the reset on multiples from the higher rates, the rates more than doubling so far this year. But the next thing has been the reset on the concern about a cut to earnings. And certainly some companies' earnings estimates are too high. Some companies will have lower earnings. But I think in the aggregate, earnings will continue to grow, maybe not at a 10% rate this year, but I think they'll grow. And I think most of my growth stocks will have higher earnings. So in that context, yes, I think this is an excellent time for investors to take advantage of the carnage. It's widespread, it's deep, and I don't think we're going to have, if we have a recession, I don't think it's going to be a deep and long one. I think it's going to be relatively short because the job market is just too strong.
So that's exactly where I wanted to go. How much of this bet is predicated on a short recession rather than a long one? And what's the distinguishing feature between the trajectory of one that is shallow versus one that is much deeper?
Well, this entire problem with inflation and what may or may not be a looming recession is a self-inflicted wound. This was obviously, I think, a result of massive stimulus. The Fed absolutely did blow it. $5 trillion of quantitative easing, 2 years of zero interest rate policy. They expanded the money supply by over 40% over 2 years. And then, of course, we had $5 trillion of fiscal giveaways. How can you not have inflation when you're making those kinds of decisions and those kinds of policy moves? Well, now we've got it. But now we're shocking the system because we're removing all that punch bowl. The monetary stimulus, the growth in the money supply in the last 6 months is down to about a 6% annual rate after an annual rate of over 20% for a couple of years. The federal budget they've spent less money in the first 6 months of this fiscal year than they did the year before. So we're on the right track, and the Fed is finally now raising rates. And mind you, the longer end of the bond yields started rising in August of 2020. So bond yields outside of the short end have been going up for nearly 2 years, and that's starting to impact the economy now. But I think that we're looking at a short recession because you're looking at a job environment where there's 11 million jobs that are open, and you have 5 million unemployed people. And even if you take the 2 to 3 million people that left the labor force during COVID, if they came back, you'd still have a gap of about 3 million. So I think there's a so-called, let's call it a margin of safety on the job side. You'd have to have a really negative environment for the job situation to deteriorate enough for the economy to really tank. And I'd like to point out that part of the problem, of course, has been the supply chain shortages. They're still being resolved, and they are getting better, and every month they will be better, and that is going to help. And I'm certainly hoping, and I'm hopeful that over the course of the next year, we can certainly end this horrible war in Ukraine. That will help. The Fed's doing its part. So I think that we're looking at a situation where the stock market may very well bottom before the economy bottoms. I mean, that would be somewhat typical. And so the data may continue to be negative, but the stock market's going to sniff out an improving economy in the months or quarters ahead, and it will start to move stocks higher. And not all stocks bottom at the same time. Back in 08, 09, many of our stocks bottomed in October and November of 08. The S&P bottomed in late February of 09. And I think many of these stocks that are down 50, 60, 70% they've probably put in their bottoms at this point. It's hard for me to see some of these names going much lower. You know, you can buy Amazon at 13 times EBITDA. I think that is a screaming back up the truck and buy all you can kind of multiple. And I could go on and on. There's been so much carnage in so many sectors of the market. I think you can probably be a happy camper buying a whole range of companies.
Howard, are you backing up the truck then? Can I just jump in? Have you been doing that? Have you loaded up on Amazon over the last couple of weeks?
We've been loading up on Amazon for the last couple of months. And of course, it's continued to go down. But at some point, this is a company that, as you know, is the leader in web services, growing that business at about a 40% clip still. It is a leader in e-commerce. It is a growing leader in digital advertising. This is a company that is going to be a fountain of free cash flow over the next 10 years. Yes, they overexpanded during COVID. And with hindsight, that was a mistake. But they are rectifying that, and they will grow into their capacity. And this is a great opportunity to buy one of America's great companies during a fire sale.
Howard, awesome to get your views. And what a call at the end there. Howard Ward at Gabelli Funds. Amazon down this year, so far at least, Damien, by about 38%.
You know, I picked up a little Amazon about a month and a half ago. It's like the first stock I bought in 10 years, Jonathan. I'm not kidding you.
You're probably not alone.
Yeah. No, I mean, you buy the big four, right? Microsoft, Google, Amazon, and Apple, and you hold your breath and don't look away.
Hold your breath, hold your nose, cover your eyes, Lisa, at the moment, looking at some of these moves.
Right now, the move I'm looking at is the move in real yields and how much that's affected the risk-reward analysis from there is no alternative to there is an alternative if you're suddenly getting upwards of 0.5 percentage point in order just to own benchmark rates. How much does that really shift the multiples in a way that really does reduce the proposition versus that long-term argument that, look, this is a behemoth. It's kind of almost a monopoly at an entire industry and it's going to keep growing.
It's a pretty strong line, though, isn't it? Backing up the truck. stock. Yeah. We'll see how that works out. Some of these names have been absolutely hammered. And what we heard there from Howard, I think acknowledging, Lisa, something you've talked about for a long, long time. Getting the story wrong coming out of the pandemic, how much capacity you needed, how much staffing you needed, how much inventory you needed. And retail's had to adjust to that. Not just that, but also the forward look, the prospect of this weaker consumer too.
Especially because it's moving so quickly. It's not just a wholesale weaker consumer. It's they're shifting what they're buying. They're buying more of the basic necessities. They're buying fewer of the discretionary items. They are buying fewer bulk items. How do you adjust in real time to sentiment and preferences that are shifting that quickly?
Yeah, bit of news from Reuters I want to jump in on, Damien. PBOC accepting ANT's application for financial holding. That coming from Reuters. I believe we've got a move in Alibaba as well we can take a look at as well. The stock is up by 9.4%. Any thoughts on that, Damien?
Well, I think Chinese equities are basically turning the page here. I mean, look, if you look at Chinese equities relative to the S&P, I think the margin differential has basically just kind of gone the other way finally. I mean, Chinese equities have been in the doghouse since forever. So it's interesting to see Baba, JD, Baidu, all of them kind of rallying off the news.
We'll keep building on that story. The stock up by more than 9.5%. Coming up next, Stephen Short, president of the Short Group. That's just around the corner. Futures higher by 1% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Ukraine is one step closer to becoming a member of the European Union. Bloomberg has learned the European Commission has recommended Ukraine be granted candidate status with conditions that Kyiv will have to meet in the future on the rule of law, justice and anti-corruption. It's significant for Ukraine, but there's no fast-track path to speed up the arduous membership process, which can normally last more than a decade. Ukraine is blaming Russia for stoking global inflation. Speaking in a video address to a forum in North Macedonia today, Ukrainian President Volodymyr Zelensky said Russia is using its invasion of Ukraine to spur inflation and risk another migration crisis by limiting gas supplies, blocking food supplies, and targeting farming infrastructure. Zelensky said there is not a single country in Europe that hasn't suffered in some way because of this war. And the war in Ukraine is knocking out shipments of sunflower oil, leading food producers to choose other options like palm oil. Food companies have spent years sourcing alternatives for palm oil, whose farming has led to the destruction of rainforests in Southeast Asia. Palm oil exporters like Malaysia are seizing the opportunity to win back some of that market share. And Bank of Japan Governor Haruhiko Kuroda is holding firm with rock-bottom interest rates, defying an intensifying global wave of central bank tightening. The central bank kept its policy settings for yield curve control and asset purchases today. In a rare move, the bank added a reference to foreign exchange rates to its list of risks for the first time since 2012, following the yen's weakening to a 24-year low earlier this week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think the Fed needs an exit ramp from this, because if they're just going to hitch their wagon to energy prices, funds are going to be meaningfully higher, and we're going to push ourselves into, I think, probably a sharper slowing than we probably need to have.
That's the fear, and I think Mike McKee got to the heart of it in the news conference earlier this week with Chairman Powell. That was Tom Porcelli, the chief U.S. economist at RBC Capital Markets from New York City this Friday morning. Good morning. Futures positive 0.8%, off-session highs on the S&P. On the Nasdaq 100, up a little more than 1%. Yields higher by a couple of basis points, 321.81 on a 10-year. Energy at the heart of a lot of this, Lisa, right now, not just for the chairman of the Fed, but also for this administration, front and center.
Yeah, gas prices leading to some of the low approval ratings for President Biden. What are they going to do about it? We heard about Exxon making more money than God. We heard about possibly taxing profits. At what point does this start to work, especially given the pushback from a lot of the companies where they say, we've been investing, we've been doing everything that we can. It's up to you to come up with cohesive plans.
Stephen Short joins us now, principal and co-founder of the Short Group. Stephen, let's start here. If I could be a fly on the wall of a meeting between the Energy Secretary and oil executives, that's set to happen in a meeting. Stephen, what do you expect will happen in that room?
Yeah, I would expect a lot of pushback right now. It does appear that both the industry and the White House are talking past one another. The White House has refused. This is the first real outreach that they've made to the industry, and and they've gone to some nefarious characters prior to this. And yet they're going to continue to double down and tell us we don't need to drill. You don't need to drill. You just have to raise capacity. Tell you what, capacity is already there. At this time of the year, refinery capacity is at 94%. That is extremely high for this early in the season. So the industry has responded. Gasoline production is over 10 million barrels a day for 2 consecutive weeks. Crude oil production has risen. Unfortunately, at the heart of this is the lack of refinery capacity, and there's nothing anyone can do about that. Here in Philadelphia, we had the South Girard refinery
that was producing 330,000 barrels of crude oil a day. 40% of that was gasoline. We no longer have that. You go to South Philly, that refinery is no longer there. It's a brownfield, so you're not bringing that back. So we've slashed capacity over the last 5 years. We don't have the same ability. So now we're more reliant on foreign production coming from Europe and from Houston. And there, guys, is the real problem. And that's the one thing the administration, and I do know this is part of what the executives are telling the Secretary of Energy, revoke the Jones Act. Now, for those not familiar, the Jones Act is a maritime law passed about 1,000 years ago, meant to protect the merchant marine industry, domestic merchant marine industry. The problem now here is, since we don't have enough pipeline capacity, we don't have enough refinery capacity here on the East Coast, we need to ship that gasoline diesel fuel out of Houston and into New York Harbor. But the Jones Act says that commerce interstate has to be transacted on an American flagged vessel. We simply don't have enough American flagged vessels.
Stephen, barring some sort of change to the Jones Act and frankly, some sort of wholesale shift that we're not going to see in time, the tightness of the market has raised concerns, the likes of Goldman Sachs' Jeff Curry. How much are we looking at gas prices that will continue to climb? They have been plateauing recently, but will continue to climb throughout the summer to levels that we can't really imagine right now.
Yeah, absolutely. $120 barrel oil, crude oil, both in Brent and WTI, which is pretty much where the market has been holding, to your point, has steadied out around there. But as demand continues to pick up, as we approach the 4th of July holiday, the AAA national average is slightly right around $5 a gallon at the pump. Right now, 4th of July, we are forecasting $5.40 on a national average. So there's still more pain at the pump to come. And this is contingent upon oil holding at $120 a barrel. Every dollar oil goes higher, you're going to look at another 2.5 cent rise at the pump.
Stephen, forward curves are pricing in a sharper price decline in nat gas than oil. You know, for me, I'm wondering, do you think that the price rise in oil is stickier than that of nat gas? And if so, what are the implications for example, integrated oil companies out of LATAM or the Canadian oil sands companies, all of which are more focused on oil?
Yeah, absolutely. Natural gas, it is a more seasonal market. You have two distinct markets. You have the winter and the summer. In the shoulder months, you have the refill seasons. So at this point, that backwardation is telling us that there is not enough supply. Right now, the month of May and June is when we store the most natural gas getting ready for next winter. Now, this year, it has been hampered, of course, by LNG exports or European demand for exports because they, too, have to build natural gas. So that steep backwardation priced in is telling us the market is clamoring to get gas into the ground for next winter. Now, last week, we had an explosion and a fire at an LNG export facility down in Texas. Now, that export facility accounted for about 1/5 of U.S. LNG exports. So that LNG plant is going to be closed now to probably at least October, if not November. So that's a lot more gas that's not leaving the United States that's going to be set for domestic consumption and storage. So with that added gas coming to the market at this point, you're looking at a correction in the yield curve and the backwardation, that is the front month prices, have been extremely high relative to the back end, but that's starting to correct lower because we have all this found natural gas. Now, as far as the integrated oil companies go, look, natural gas is a fossil fuel as well. So it's in the same sights as oil with regard to policy and the lack of policy with regard to promoting both natural gas production and crude oil production. And therefore, it does set the table for continued higher prices and a squeeze on margins for the companies.
Stephen, I've got 30 seconds left. I want you to throw a number on it. We're at $5 gas right now. Gasoline prices on average in America right now. By the end of the summer, do you share the JP Morgan view that this is going to have a 6 handle?
Yeah, we're about at a 14. Our modeling is at a 14% probability. We see that. The problem now is it's a race. Do we see that $6, which I said is a 14% probability, or do we see such a severe economic downturn where we see demand destruction and prices fall? Because that's where we're headed. We're headed for a recession if we're not already in it at these high food and energy prices. So yeah, I'll give it 14%. I'm on board 14% of the time with JP Morgan and that prediction.
Just 14, Stephen.
So specific.
Stephen Short at the Short Group. I like JP Morgan, just on board with them 14% of the time. Does that work for you, Bramo?
Yeah, solid.
Very carefully calibrated
chance.
over there at Short.
Especially 14% chance. I've got a 15% chance that I'll agree with that.
I noticed this move in the equity market yesterday, and I think it got a lot of people's attention. Damien, energy was down and down hard by 5.6%. Energy
that's
stocks.
a big indicator. I mean, look, it's one of the big four, right? You look at put-call ratios, you look at breadth of the market. Energy was up, 50% year to date, the energy sector within the S&P? And some. And it was the only sector that was positive, by the way. So we needed to see a little bit of bloodletting there.
Backing away, it's an anticipatory asset class here, Lisa. We're starting to see those gains just get chipped away at.
The only tool that the Fed has is to reduce demand at this point when it comes to things like oil and gas, and people are taking that seriously.
The S&P up 30, advancing 0.8%. Victoria Fernandez across Mark joins us next on this program. From New York, this is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number. And most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
think the Fed's forecasts are still remarkably optimistic.
All these numbers they threw out are fantasy land. The unemployment rate's fantasy land. The rate at which inflation is going to come down is fantasy land.
It feels like global inflationary pressures have the upper hand.
Fed rate hikes just take a really long time to impact the economy.
I just wonder whether we're going to look back and say, we were in a recession. We're already in a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
A chorus of negativity there from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz. I'm Jonathan Farrow. TK out of the building in the seat. Damien Sassower. Equity futures up by 8 or 9/10%. Lisa, you heard it there as we open this hour. This pushback against these forecasts. Bank of America saying this. The Fed funds forecast now makes sense. Their growth and inflation forecasts do not.
For them to achieve lower inflation, given what they're hoping to do on the rate side, they have to induce a slowdown in demand that will be incredibly painful. That has been the projection from so many investors because the inputs on the supply side have not contributed to a softening in inflation. And without that, it could be a painful period. You asked the question, how long and how deep?
Chairman Powell speaks a little bit later. Are we expecting anything from that whatsoever?
I mean, if he takes questions, I'm sure a lot of people will be asking him, how do you view some of these projections about the amount of pain that the U.S. economy is going to have to experience in order to dampen inflation? But no, he said what he was going to say, and now we have to wait and we have to see.
Hey, Damien, it's tough, isn't it? If you're a central banker, if you're the leader of the Fed, you can't forecast a recession even if you think there is going to be one, right?
Well, I think Scott Menard had a really good choice of words using Fantasyland, spoken like a true Los Angeles inhabitant. But for me, I mean, markets are operating as if the Fed put is dead. The Fed put's not dead. It's just in hiding in hibernation, in my opinion. So the question I have is, at what level is it a spread level? Is it an equity level? At what level is the Fed going to come back in and bounce up asset prices?
Let's go there. Let's go there. I say it's in retirement. What brings it out of retirement? What brings it out of retirement? Is it the market, as you pointed out, or is it in the economy? Is it in the economic data and not necessarily the inflation data? I'm thinking more at the moment, Damon, about the labor market data.
See, I'm thinking it's going to be spreads. I think it's going to be liquidity driven. I think it's going to be the secondary market drying up. I think there's going to be some problems in the plumbing, and I think the Fed's going to have to act.
We saw that at the back end of 2018, Bramo, didn't we? The primary market for high yield seized up, no issuance through that whole month of December. We're going to see something similar this time around. What do you see right now?
Some people have speculated about this. Others are saying the institutions are starting to buy in bulk. They are providing that liquidity because suddenly 8.5% yields on junk bonds look pretty good. At investment grade, 5% yields also look pretty good. I keep going back to what Eric Robertson said earlier in the morning, where he said, honestly, the only thing that it's going to be is the labor market data. A lot of people seem to agree with that.
I've had one complaint this morning from the audience. Just the one complaint so far, and I'm sure there's more still to come, but just the one. Not enough golf talk in a previous hour, Damien. Not enough golf talk.
Rory McIlroy.
You think Rory gets it done?
One stroke off the lead. I love him. I'm definitely rooting for him this week. But, you know, there's some other players there. Dustin Johnson, Justin Rose. I think
Justin
they're 2
Rose.
shots up. Yeah.
Was that Tom complaining?
It was Tom and someone else as well. They just want the golf talk in the mix. And maybe I do too. Phil Mickelson, can I just say this?
Yes.
He got a decent reception, Damien. I thought that perhaps he'd get some jeering, some boos, but he didn't.
Well, I mean, his putting sure could have used a little bit more cheering. I mean, I think he missed 14 putts through the first 6 holes or something crazy like that. And he ended, I think, 8 over par. So
I don't think he's making a weekend.
I don't think he's going to make the cut. No.
I don't think he's making the cut. He's making his money elsewhere at the moment, as we know, Damien. Damien Sassower in the seat. Tom Keene away. Your equity market's higher, up by 8 or 9/10% on the S&P. On the Nasdaq 100, up a little more than 1%. Yields higher by a couple of basis points, 321.81. If I had to pick an asset class right now, I know there's tons going on in credit, but foreign exchange. Lisa, foreign exchange is fascinating. Euro dollar negative 1/3 of 1%, 105.15.
Dollar strength very much coming through after the Fed signaled they were going to do what it takes. Although the stickiness of 105 I find interesting, a sort of resilience after the ECB came out and seemed to support peripheral bond yields yesterday. How much does that really feed into some conviction around the euro? Here's what I'm watching today. 8:30 a.m. President Biden is hosting the Major Economies Forum on Energy and Climate. This is a tough message for him him to dovetail. He ran on greenifying or the greenification of the energy system. And here we are with gas prices exceeding $5 a gallon. And this is becoming a major problem for him, given how much it eats into the disposable income, particularly of people on the lower income brackets in the United States. 8:45 a.m., we hear from Fed Chair Jay Powell. John, you asked me, are we going to hear anything of substance in terms of what would cause them to retrace or possibly pause some of their rate hiking? He's going to be talking about the dollar and the strength of it, how much they start to look at their international role and the disruptions that they could see outside of the U.S. as that dollar does continue to strengthen. That's actually one thing that he could talk about. And at 9:15 a.m., we get U.S. May industrial production. How much do we start to see production increase to offset the increased demand, a possible easing of inflation that comes not from simply dampening demand and slowing the economy? John, this is what people secretly hope, right? They say, yeah, we see inflation surprise to the upside, but there's a subtle transitory kind of feel that still is alive in some of the discussions that you hear.
Some economic data a little bit later. Lisa, thank you. Following up on that data, responding to it, reacting, we'll catch up with Mohammed Al-Arian around about 9 o'clock Eastern time as we count you down to the market open. The scores right now look like this year to date. Tom, this is for you. The Dow down 17%. Won't be doing that again. The S&P 500 year to date down about 23%. The Nasdaq down by 32% year to date. Joining us now is Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. Victoria, we're down 32% on the Nasdaq year to date. Are you buying any tech stocks yet?
Yeah, actually, Jonathan, I mean, you're right. Look at how far the Nasdaq's down and look at individual stocks within the Nasdaq. And some of these tech stocks have come down even more. NVIDIA is a name we actually bought this week. NVIDIA's down 48% year to date. But we're looking at a company that had good earnings, a company that's growing with their data center, with their gaming. So there's a lot of good companies with strong balance sheets that are out there that have taken a significant hit as yields have moved higher. And so I think you can go in, be a little opportunistic, and add some names in there. And it's not just in the tech space. You can do it across the board, but you've got to choose quality companies. Don't just go all in on one sector like we used to do a couple of years ago.
Victoria, you don't believe the recession talk. You think that the U.S. can avoid one. Why?
Yeah, I mean, look, probability of a recession probably went up over the last 48 hours or so, but I don't think we're going to have a recession this year. I still think the underlying fundamentals in the economy, when we look at household balance sheets, I know we have gas prices going higher, and that's taken a big hit, and food prices higher. But when you look and kind of split up household balance sheets, higher wage earners are doing pretty well. They respond more to household wealth than they do commodity prices or food prices. They're still strong. Corporate balance sheets are still good. We haven't seen those earnings expectations come in yet. That's something we were looking for to maybe think that recession is closer than next year. So we're sticking with next year on that. And the labor market, you've talked about it all morning, it's still strong, even though the Fed is trying to bring that down a little bit to help inflation. So we don't see a recession this year. We would see it more likely second half of next year. But again, things can change pretty quickly if the Fed continues to increase at the rate that we've seen.
Victoria, if the Fed does indeed engineer a soft landing, by the way, inflation's unlikely to return to pre-COVID levels anytime soon. I mean, what asset classes in that environment, specifically on the fixed income side, would you prefer owning?
Yeah, so Damien, in our fixed income portfolios, we've actually been short duration for an extended period of time, which has worked really well for us lately. What we've started doing is really extending duration, building up some of that credit. I mean, you talked about yields earlier, you talked about spreads with high yield and with an investment grade. We prefer, just like we like quality in equity, we want quality in fixed income. So we're looking at high quality investment grade corporates. We're getting more yield on them now. We're adding some of those to our portfolios, but we're doing it while trying to extend duration a little bit to get closer to neutral, because we do think we perhaps have seen the peak in yields at that 350 on the 10-year Treasury earlier this week, and we'll start to see yields settle at a lower level. So if we can build in some of that yield now and lock it in the portfolios in quality corporate names, I think you're well positioned.
Victoria, let's just finish on that. How do you expect that relationship, that correlation between risk assets and treasuries to develop through the summer?
Look, I mean, one of the things we're watching, actually two of the things, Jonathan, energy and 10-year yields. They usually peak prior to data peaking, whether it's inflation or other data. Have we seen that? That's the question. We don't know yet. So there's the correlation. If we can see the peak in yields and start to see yields moderate a little bit, that should be some support for the equity markets over the summer months.
Victoria, awesome to hear from you. As always, Victoria Fernandez there at Crossmark Global Investments. Who said it first on this program a number of weeks ago? Was it David Stubbs at JP Morgan Private Bank? Lisa, who said bonds are back. Bonds are back. Then Scott Minard, earlier in the week on the Fed show with us and Tom as well, saying that he was thinking about the long end of the bond market as well. 350 got close, yields have backed away since then.
Yeah, and Subhadra Rajappa seemed to emphasize that as well. We saw that yesterday. I'm looking right now at the Bank of America Merrill Lynch Move Index, and that still is incredibly elevated. We're looking at levels. This is basically implied volatility in Treasury yields going back to 2020. We haven't seen these levels of implied volatility. So I think it may be a little soon to say that we've seen that peak, especially as people project out 4% Fed funds rates.
To build on that just a little bit, Damien, I think I've heard someone call the top on yields about 20 different times over the last 12 months, and then we break out again, which is Lisa's point.
I mean, Jonathan, markets are pricing in a 9% CPI print in each of the next 2 months. So, that tells you everything you need to know about the pressure. It's to the upside, I think, on U.S. yields. And certainly if we break through 356, that's when things get a little bit messy.
What would you be looking for after that?
375. If it breaks through there, it's
Pushing
4%. Yeah.
Can you imagine 4%? Lisa, do you think we've fully adjusted to what's happened in rates?
Okay.
I hear this a lot in the equity market. We've adjusted to the rate story.
Right.
Fully adjusted. Now it's about earnings. Do you think we have?
I think if we get a 4% 10-year yield, everything changes. I think that will be a game changer in many ways. What I'm struggling with right now, rents. Well, how are they going to come down? We're not even seeing housing prices come down that fast. And if people are priced out of buying homes, they're going to have to stay in their homes and rent more. That's going to create more demand. I'm trying to pair this all together. It's not adding up.
Jonathan Gulliver, Credit Suisse, is going to join us and try and make sense of it all. He's got a more constructive outlook on this equity market, and particularly on earnings too. Your equity market up 0.9% on the S&P 500. We'll catch up with Gulliver the next hour on Bloomberg TV and on Bloomberg Radio. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden will convene world leaders from roughly 24 countries in a summit today focused on propelling the fight against climate change. The virtual summit is on track to be the largest gathering of world leaders focused on climate action ahead of a critical United Nations summit in Egypt this November. Biden will highlight the war in Ukraine as evidence of the need to accelerate the clean energy transition and bolster food security. Ukraine is one step closer to becoming a member of the European Union. Bloomberg has learned the European Commission has recommended Ukraine be granted candidate status with conditions that Kyiv will have to meet in the future on the rule of law, justice and anti-corruption. It's significant for Ukraine, but there's no fast-track path to speed up the arduous membership process, which can normally last more than a decade. Russia's invasion of Ukraine caused one of the fastest and largest displacements of people since World War II and helped push the number forced to flee their homes globally to the highest annual level since the United Nations began keeping track. The UN Refugee Agency said today the number of people displaced around the world tops 100 million, and the war in Ukraine has displaced about 8 million people within the country so far in 2022. Hong Kong's outgoing leader, Carrie Lam, is urging residents to avoid banquets and other large gatherings amid a resurgence of COVID-19 in the city, but she held off from imposing new restrictions as serious infections remain low. Lam said today the number of new daily cases has topped 1,000 for the past 3 days, the highest level in 2 months. Fewer than 24 of those people are in serious or critical condition. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
The Fed is shown that it's going to have to be very data dependent over data that it doesn't necessarily have a great deal of control over. The Fed is somewhat captive to the incoming inflation data that matters a lot. And then the growth outlook is also very uncertain.
That was Andrew Sheets, the chief cross-asset strategist at Morgan Stanley. His view, and many others too, from New York City this morning. Good morning. Alongside Lisa Bravitz, I'm Jonathan Ferro, together today with Damien Sassow. TK out of the building. Here's the price action. Equities up 32, advancing 0.9%. Yields higher by a couple of basis points, 121.62, or rather 321.62. I've got my cap on from 10 years ago. It has a 3 handle now. In the FX market, euro-dollar 105.16, euro-dollar negative about 1/3%. This story just crossing from the Washington Post, Lisa. Here's the second paragraph, first couple of lines of it. Biden officials are taking a second look at whether the federal government could send rebate cards out to millions of American drivers to help them pay at gas stations.
Yeah, but the second line or the third line is also fascinating, that in the past they've rejected this idea because of a shortage in chips that were needed to make that card, just highlighting how multifaceted some of the shortages and supply shortfalls have been.
You couldn't make that up, could you?
You could not make up the fact that they couldn't get the rebate cards in enough supply because of the chips. But look, do you really want to basically keep demand at the same level? This is sort of the existential question. Do you want to keep demand at the same level and then basically have this be a supply issue that cannot be fixed because supply can't come on quickly enough? And then you just basically end up in this inflationary spiral, or do you go at this somehow differently?
And you've got to finish with the last line of this paragraph as well. Even if the administration embraces the proposal, Damien, it would probably require congressional approval and face long odds among lawmakers wary of spending more money.
Well, I have to draw a comparison to, really to the GCC, to the Middle East, because quite honestly, fuel subsidies work there. They've suppressed inflation pretty nicely in places like Saudi Arabia, Qatar, Kuwait. Maybe we're pulling a feather out of that hat. Who knows? Maybe we can kind of bring down that demand that Lisa's referring to, because quite frankly, that's the only way we're going to get this economy right-sized.
I mean, I guess it helps if you're the state producer as well and you make money from exporting to everyone else and then you dole out some subsidies domestically. That's probably how that trade works. I'm not sure how that works here.
Well, no, you're absolutely right. But I think, look, the fact of the matter is it's not just fuel subsidies, it's food subsidies. I mean, if you see what's going on in places like Pakistan, Sri Lanka, I mean, everywhere. I mean, you're seeing rioting in the streets, you're seeing protests everywhere. It's a very big deal, and it's about social instability, I think, and that's really the key point. Look, guys, many know I'm an emerging markets guy, so those are the things we look at, and I got to tell you, things are getting far worse.
Let's get to Emily Wilkins down in D.C. of Bloomberg Government. Emily, I want to start with the headline of this story from the Washington Post. Soaring gas prices lead the White House aides back to brainstorming. What are they coming up with?
I mean, at this point, you kind of know that there is the idea of potentially gas cards. I mean, they've talked in the past about a gas tax holiday, but that's something that you saw House Speaker Nancy Pelosi shut down pretty quickly, saying, look, we're not sure if we try and give this gas tax holiday, companies might not pass those profits along to consumers. And that was why that idea got nixed. They're looking for other potential avenues to have something like this. But then there's also the question about the international aspect, about what Biden is doing, about which countries he's working with. Certainly some eyebrows being raised about that proposed trip to Saudi Arabia and what that could potentially mean for the U.S. going forward. At the same point, lawmakers are really feeling the pressure to do something here on gas prices. I almost wonder if we will see some sort of legislation that will have some of these subsidies or potential gas cards, even if it's something that is only able to, say, pass the House and not able to go forward in the Senate, just so Democrats can say we are trying to do something, to go back to voters and show them something.
Emily, there is this sort of unspoken truth that at a certain point, people will start rationing how often they travel. They will start reducing certain aspects of their lives in order to offset the higher costs. At what point will the administration lean into that and say, if we all can just basically turn off the lights, as we were talking about earlier, or take a few fewer trips, then that will actually ease the problem itself?
It'll be interesting to see, because initially the Biden administration did kind of begin to talk about it in those terms. They said, look, there's high support in the U.S. for the war going on in Ukraine, high support for Ukraine. And look, if people have to pay a little bit extra at the pump so the U.S. can make sure we're not getting any Russian oil, that might be something that people would be interested in. That, of course, was before you saw gas prices get quite as high as they are now and really trickle into inflation in other items like food, groceries, anything that really does need to be transported. And so I think it is a major concern, and I wouldn't rule out anything at this point, because the Biden administration and Democrats in general know that it is such a problem that they do have to come up with some sort of solution. I think there was initially a hope that, you would see Biden tap into the Federal Reserve, that you would see lawmakers try to take smaller measures to address it, and you might see prices go back down, but that has not happened. And as you mentioned, it's summer. You've got families who are looking to take these trips, and you've got gas prices that are really prohibitive for a number of people to drive as far as they would like to.
Emily, can you clarify for me? I mean, what I see President Biden reaching out, trying to mend fences with Iran, Venezuela, now Saudi Arabia, and yet on the flip side of that, he's accusing ExxonMobil domestic producers of price gouging. Is this just plain old politics?
There is certainly a little bit of politics that comes into here. This is certainly Washington, D.C. I think Democrats have made a calculation that most Americans are not super big fans of major corporations, and that it's going to be pretty easy to pin the blame on them, particularly with some of the revenues that we've seen from these oil companies. The Exxon numbers this week led to another round of the White House saying, hey, why are the profits so big? Why isn't some of this being passed along to consumers? And I think it's this point the White House is sort of looking sort of everywhere at this point for if there's any avenue that they can take to lower prices, if it's going after big companies, if it's working internationally. They're kind of scrambling here to figure out what the solution is going to be, and if they can have prices go down in the next couple months before the November elections.
Emily, thank you. Down in Washington, Emily Wilkins there of Bloomberg Government. I'm going to take the audience back to the end of last year. It was at the end of October where the Energy Secretary came on this program, and we asked what you could do domestically to boost output. And what did we hear? Laughing. Now, Damien, I don't want to understand why it's gone from blaming OPEC to now blaming domestic producers, when 6 months ago we had a similar story, and Russia wasn't a factor, of course, and we can add Russia into that, but we could see the direction of travel. Energy prices were already very, very elevated at the pump, out of the ground, the drilling, all of the above. And yet we got laughed at when it came to suggesting boosting production here at home. And now it's all about domestic production.
Well, for me, I mean, look, and I think Emily kind of, did a good job of avoiding it. I mean, we're talking about Texas here. We're talking about terrorists versus Texas. I mean, and by the way, terrorists, I'm not accusing anyone of being a terrorist. But I mean, look, that's exactly what the market believes. The market believes that Biden is picking his spots here, and he'd rather reach out to, unsavory actors as opposed to domestic producers. And, they're all, look, that's big Texas. That's a Republican stronghold. And so I definitely think it's a political issue.
Dictators or Texas? Maybe a more savoury way of saying
wonderful.
it, but some people might agree with you. Futures up by 1% on the S&P 500. The president seemingly would rather go and see the Crown Prince Mohammed bin Salman at the moment and try and do something there. We'll talk about this some more. From New York, this is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
From New York City this morning. Good morning to you all on TV and radio. This is Bloomberg Surveillance, and here's your bounce back. Futures higher, positive by more than 1% on the S&P, on the Nasdaq 100 up by 1.4 through Thursday. The losses this week down 6%. Close there, biggest weekly close, weekly loss going all the way back to the pandemic. Bramo, it's been that bad. What was interesting about yesterday is that we had energy, crude rallying, but energy equities falling. Is that the first sign that this market's starting to price in some demand destruction on the energy side in this equity market after a monster rally year today?
If you're going to give it a narrative, that seems like a good one to give it. There was a whole host of selling that people didn't quite understand yesterday, though, as well. You do wonder whether people are selling what they can, maybe not what they want to, at a time when it's very unclear what the trajectory of the economy is going to look like.
That's where the profits have been. Let's be clear about that. Where they haven't been is big tech.
Right.
We heard from Howard Ward a little bit earlier this morning of Gabelli Funds, and he was talking about backing up the truck for stocks like Amazon. When we followed up and asked him, he said he was having a nibble, just thinking about it. So we'll think about that too. That's the equity picture. Here's the bond market story. 2s, 10s, and 30s. Your two-year yield on the week, just a little bit higher. Nothing like last week, up by more than 40 basis points on a week last week. This week, up around about 9 so far, including 3 or 4 basis points move higher today by 4 to about 315 on a 2-year, on a 10-year right now, 321.81. Wanted to finish in Europe. Haven't talked much about it this morning, but certainly on people's radars. Are they finally getting something done on the periphery? Because spreads have seen a monster move this week. A couple of days ago, 240. Italy over Germany. Right now, sub 200. Lisa, that's a big move. It's a big move. They're planning to make a plan. They haven't made a plan just yet. And haven't agreed on a plan either. So there's a couple of steps still to go here. Will words be enough to cap what's happened in this bond market? As this ECB looks to do something they haven't done for a long time, since 2011 in fact, and that's hike interest rates.
We have heard that they are going to front load some of their reinvestment of the PEP. So basically they are going to potentially increase their near-term purchases, and that could potentially offset this. But it's hard for me to imagine for them not to follow up, that it wouldn't have the exact opposite effect in this market.
To see a German 10-year bond through 180 briefly in the last couple of days. I mean, this is a huge turnaround, guys. We're about 167 right now. We were negative 17 basis points at the end of last year on a German 10-year. In Italy, last summer, 50 basis points on an Italian 10-year. Right now, 357. I know we were through 4 earlier this week, but the change we've seen over the last 12 months has been absolutely massive. That's the cross-asset price action. Let's get you some single names, some movers. Let's say good morning to Romain. Good morning, Romain.
Hey, good morning, John. Well, some investors are out there trying to nibble. Of course, you talk about futures being higher. A lot of those big tech names also moving higher. That's pretty much your big ballast here, with Apple up about 1%, NVIDIA and a lot of the semiconductor names up about 2%. Similar story for most of those big tech names. The big question is, how much conviction is there right now into some of those nibbles? Is it going to be broad-based, particularly in a market where we've seen a lot of declining liquidity as well as a lot of declining faith here in the economic trajectory? There is some optimism when it comes to a lot of those Chinese tech stocks, Alibaba amongst them. Those shares, ADRs here in the U.S., up by almost 10%. That's on the back of that Reuters report that the Chinese government would actually allow Ant Group to move forward with those earlier plans to convert to a fintech company and, of course, have that IPO. Alibaba, JD.com, and a lot of the other big Chinese tech stocks moving higher here in the pre-market. But at the end of the day, it really comes down to with the commentary that we're getting out of a lot of these executives here. We did hear from the head of JD.com's retail division basically saying that they're seeing basically a lot of muted growth here with people really not opening up their pocketbooks and spending. Then we heard from U.S. Steel last night, which actually raised its profit forecast for the full year. You're seeing those shares higher by about 7%, but there are some skeptical analysts out there, a lot of sell-side notes saying that this is sort of a temporary boom for that company and basically enjoy it while it lasts. Well, it'd be interesting to see whether that price action this morning actually lasts into the end of the day. Adobe also came out with earnings, and this is an interesting story. Those shares are down 3%. The quarter was a blowout quarter by any stretch of the imagination, but they did revise their guidance lower by a relatively minor amount, basically say it's $17.7 billion in sales from a previous forecast of $17.9 billion. But that caused a lot of concern here as a lot of people do start to worry about the backlog with a lot of these companies that particularly were sort of pitched as being a bit recession-proof. The idea that business spending, IT spending would sort of keep a lot of these companies afloat. A lot of concern that that may not necessarily be the case. And keep an eye on Revlon shares here. Revlon up about 67% after that bankruptcy filing on Wednesday. Apparently, a lifeline could be thrown to this company. Reliance Industries over there in India is said, based on a report out of India, that they could be interested in buying Revlon. John?
Hey, Romain, awesome. Yep. As always, sir. Looking forward to the close a little bit later with Romain Bostic and the team. A couple of stats for you. This came from Michael McDonough of Bloomberg. This really jumped out to me, Lisa. He said the following. In January, a monthly mortgage payment based on median existing home price and the going 30-year mortgage rate was $1,200. It's now pushing $2,000. That's the big change we face at the moment.
People's base costs, if they want to buy a home with a mortgage, have basically doubled in that period of time. And what are the consequences long-term in terms of the home ownership versus the rent proposition?
The home builders, Damien, this year, they have been hammered, smashed. The performance of those stocks, brutal.
Well, I mean, look, the indicator I most look at is the Corey Sassower proprietary index of Westchester home price sentiment. What it's telling me is that you no longer have contingencies. You can't just waive your right to inspection. You can't just waive your right to whether or not a bank is actually going to give you a loan. You're seeing days on market increase. These are all negative factors that are certainly weighing on the housing market.
Damien, is that particular index personal?
Oh, yeah, no,
it's
absolutely.
Personal.
I can give you access, though.
Damien, thank you. Seth Carpenter joins us now, Chief Global Economist at Morgan Stanley. Seth, Bank of America said this: the Fed funds forecast now makes sense. Their growth and inflation forecasts do not. They think the Fed's too optimistic on those fronts. Do you?
There's definitely a lot of optimism in their forecast. What they laid out in their projections was essentially the absolutely perfect soft landing scenario where they get growth to come down just a little bit below potential, and they get the unemployment rate to rise over a few years to just at their estimate of the natural rate. That's very aspirational. That's what they should be trying to hit, and so it makes sense that they would write that down as their forecast. But boy, you got to have some luck to go along with really good policy making to get that outcome.
Based on where inflation is, would the economy have to go into recession to achieve what the Fed is trying to achieve?
I mean, you've got clearly the most difficult question here, and I have to say over the past year and a half, the hardest question is how much of the inflation that we're seeing now is underlying structural macroeconomic inflation and how much of it is an artifact of all the frictions from COVID. And so if we think about the fact, if we look at the Fed's forecast, they're clearly banking on still a bunch of that being temporary and going away on its own. And, you know, the energy prices presumably do that, at least when oil prices stop rising. I think it's really hard to say for sure how much of the rest of it goes away on its own.
The stealth transitory line of thought out there, Seth. One aspect of inflation is the rent picture. It's a big component of CPI, and we're looking right now, as John was talking about earlier, at 6% average mortgage rates, which increase the cost of owning a home at a time when costs already were highly unaffordable. How much does this have the opposite effect of what the Federal Reserve wants to achieve, actually boosting rents further because it prices so many people out of the home ownership market and back into a borrowing or renting?
I completely agree. I think in the short run, it could be going in the opposite direction. What we know for a fact is that there's a structural housing shortage. Affordability is at its worst place in decades. And so if people were thinking about giving up their rental to buy a house, they're probably reconsidering that thought right now. So rent matters a lot. I will say, though, central banks, as we've seen over the past couple of weeks, are having some challenging moments with communication. The Fed's going to have an even more challenging moment because you mentioned the 40% weight that rent gets in core CPI. It's a little bit less than half that in core PCE, and of course it's PCE that the Fed sets a target for. So those two measures of inflation are going to diverge, and they've already diverged to close to historic rates, and that fact is just going to complicate even more so the Fed's challenge in communication.
Seth, the Fed bumped up its PCE target to 5.2%. That's a 90 bip increase since March. You know, I have one simple question for you. Does the Federal Reserve have a credibility problem? And if so, what can it do to regain the confidence of investors?
Credibility is a tricky thing, and the credibility for investors, I think, is critical. We have seen markets continue over the past 6 to 9 months mark up aggressively the path for their expected funds rate. So that to me says the market believes that the Fed will be raising rates and they'll follow through on those rate increases. Moreover, if you look at the Eurodollar futures contract, the market's pricing in some reduction in the funds rate in the out years, which I will point out matches the Fed's dot plot now that there'd be some cutting in rates at some point in the future. So I think in that regard, the market still believes that the Fed is set to raise rates pretty aggressively. And we have seen the curve continue to flatten. So if the Fed had no credibility and inflation were going to be runaway inflation for the next 10 years, presumably you'd see more of that price into the long end. So I don't think there's a complete loss of credibility. I think what's critical now is the Fed being clearer with their communication and following through on their plan.
Seth, always good to hear from you, sir. Thank you for this morning. Seth Carpenter there from Morgan Stanley. I want to go back to the forecast of December 15th. If you have a look at the summary of economic projections on December 15th of this Federal Reserve, this is what they had penciled in for 2022, the median forecast of that committee. For the Fed funds rate, 0.9% this year, year end. For core PCE, they were at 2.7% this year, year end. And you're right, Damien, that has changed in a massive way, because for 22, they now see Fed funds at 3.4 and core PCE at 4.3 and headline PCE at 5.2. It's a big change. This Fed has been struggling to forecast, Damien, forever.
I mean,
forever.
Look, the central bank, the Fed is chasing inflation. It's running out of good options, and it's intensifying asset price volatility. It sounds a lot like an emerging market central bank. No, this is the Federal Reserve we're talking about, Jonathan. So yeah, no, I agree with you. Credibility is an issue for sure, and it's gonna take some time for them to win it back.
You can't forecast the war, Lisa, and seemingly we can all agree on that. It's had an impact. It's exacerbated things when it comes to inflation, particularly, of course, specifically in energy. But they missed the inflation story through the whole of last year, as many people did, but particularly through the back end of the year too.
Well, and we even got revised employment numbers that really rejiggered how strong that employment market was. There was a belief that there was a softening. It's been a very difficult market to get right. It's easy to cast stones, except for when you're in that house. However, this is a credibility issue for a market that's searching for direction.
These aren't stones, they're rocks. We're throwing rocks at them.
Really?
Smashing windows.
I have empathy. It's a tough picture.
You have empathy with the Fed.
I have empathy for how challenging.
The way you've spoken about the Fed for the last 15 years.
For how challenging.
You've got empathy with the Fed.
For how challenging this picture is to get right.
Okay. And no one believes you. Equity futures at 1% on the S&P.
No one.
You don't believe it. From New York.
Come on.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Sweden's Riksbank has named a new governor. Stefan Ingves will leave the central bank at the end of the year after 17 years of steering monetary policy in the biggest Nordic economy. He will be succeeded by Erik Thedéen, who now heads the Swedish Financial Supervisory Authority. The news comes as the Riksbank has made a momentous policy shift. The central bank is addressing a surge in inflation and is under pressure to speed up rate hikes it flagged back in April. BNP Paribas has expressed interest in a potential acquisition of Dutch consumer lender ABN AMRO Bank. Bloomberg has learned France's biggest bank recently reached out for a meeting with the Dutch government to discuss its interest. Shares of the ABN AMRO rose as much as 18% on the news. Cross-border European bank mergers have been rare in the last decade as negative interest rates weighed on results and executives waited for progress on a banking union in the bloc. Airlines have been working hard to convince passengers it's safe to fly, but they're having a tough time convincing staffers to do the same. Aviation officials are facing an unprecedented labor crunch that is resulting in long lines, delays, and the cancellation of hundreds of flights worldwide. The severe staff shortage is sure to be a topic of discussion at the International Air Transport Association's annual meeting that kicks off in Doha on Sunday. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Isn't it, just how sensitive the markets are to any commentary about trade? We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Personally, am concerned that global inflation will creep into Japan. The BOJ will be forced to move, but I'm pretty confident they'll move on their own timeline and that they won't be bullied into this move, and they have plenty of firepower to prevent it.
He is such a sharp dude. It's Greg Jensen there, Bridgewater Co-CIO from New York City this morning. Good morning. Tom Keene away, Damien Sasser in the seat alongside Lisa Abramowitz. I'm Jonathan Ferro. Futures up by about 0.9% on the S&P, up a couple of basis points on a 10-year, 321.81. The Japanese yen. Lisa, what a mess this is becoming for the BOJ.
Yeah, although they don't seem to recognize that. The only recognition was a new line in their statement that came out, the decision, that they were aware of yen depreciation as a potential headwind, as a potential risk factor. But it seemed like they were absolutely going to commit to this rate peg that most people say is unsustainable.
I'm calling this Operation Ostrich, Damien. Just the head in the sand, hoping that everything going on around them is not happening, but it is.
Well, I think the Bank of Japan, Jonathan, I mean, they were very plain and simple. I mean, they are targeting the cheapest to deliver contract on the JGBs, and by doing that, they're basically acknowledging the fact that FX is an issue. I think the last time the BOJ intervened was 1998 when it hit 150. We're not that far off.
Dollar yen right now, close to 135. Let's get your chart of the day. We could do that, of course, with Chrissy. Morning, Chrissy.
Well, good morning, John. Of course, you've led me right to where I was going to go in my chart of the day. We're using a two-line chart this time, to the horror of Tom Keene, but stick with me here. We're looking at JGB yields, of course, bouncing up against that key 25 basis point level, but it's also looking at that in the context of yen swaps. So once again, the divergence is what's key here. For our radio audience, what you need to know is that these are two lines that move together. They move in sync. But in the last couple of, I want to say months, since going back to March, you've started to see that diversion to the point that yen swaps are getting high higher and higher, essentially the weakness getting, or the chances I should say of the weakness getting stronger and stronger. One of the big concerns here too, what John was saying earlier, was do we test 135, but not just 135, the record high, the 23-year high of 135.59. That's what seems to be in play here if you don't really see the BOJ remove their stance. And overnight, a lot of the expectation here, if you look at overnight volatility, was that they would do just that. They would somehow tweak their stance. John, in light of them not doing that, of course, you're seeing weakness yet again in the yen.
A ton of weakness. Credit Gupta, thank you with your chart of the day. Let's carry on that story with Win Thin, Global Head of Currency Strategy at Brown Brothers Harriman. Win, how sustainable is the BOJ's policy stance?
Well, look, I think I agree with Mr. Jensen, your previous guest. They can keep this going. There's obviously stresses that are popping up in the JGB market, but they have unlimited firepower. Obviously, you made a comment about ostrich in the sand. Yes, they are the incredible outlier. You have the Swiss National Bank hiking rates. So when you're more dovish than the Swiss National Bank, that's saying something. Basically, we tie it back with the currency. They can express all they want, all the concern they want about the currency, but I keep going back to Professor Robert Mundel's impossible trinity. You can't have free capital flows, independent policy, and try and target the exchange rate. With zero rates, free capital flows, that exchange rate is just going to keep going to the moon. I think the 147 and change high from mid-1998, I think is the next big target.
So what's going to stop them? And what's going to be the trigger if it's unsustainable?
Well, again, the yield curve control, to have a target 10-year yield in this era of high and rising inflation, in a sense, it just sticks out. I think it is sustainable, but at some point they have to acknowledge sort of the laws of economics. It's just unnatural to keep these rates targeted at zero when inflation is running so high. But again, I agree with your many of your previous guesses that the BOJ will change, but they'll do it on their own terms. I don't think the market can force them into this. They really do have unlimited firepower. If there's dislocations in the JGB market and some speculators and arbitrageurs get hurt, well, so be it. I think it's a pretty strong statement that they maintain their current stance. Yes, at least as you mentioned, they play some lip service to the currency. But again, there's really nothing they can do about it as long as they maintain this ultra dovish policy. And monetary policy aversion is really the main driver for FX markets right now.
Wait, enough with the doves. Let's talk about the hawks. Let's talk about Brazil, Chile, the Czech Republic. I mean, is there room for some of these central banks who were early on in the hiking cycle to start giving some relief, to start injecting some stimulus back into their economies and cutting rates?
Well, I think that was the theme maybe several months ago. But as you know, the inflation story isn't going away. I think there's some hope that some of the inflation measures were sort of topping out. But obviously this ground war in Ukraine has gone on much longer than I think many anticipated. And so food and energy prices remain elevated. So it's going to be tough. And you saw a shift in Brazil earlier, right? They rather than, I think, previous meetings, they've been sort of saying, well, hinting that, well, we're near the end. But they're pretty explicit that this tightening cycle is likely to go on further. So the swaps market has reacted. It's tough. I think I tie this in with the whole global liquidity story. This is, emerging markets sort of caught in a hard place. They'd love to ease, but global monetary conditions are tightening. It's hard for them to sort of lean against what is really a global trend. So it's going to be a really, really rocky road for emerging markets over the next, I'd say, 6 to 9 months. Until we sort of see the end of the cycle for the Fed.
Well, Win, I mean, that transitions beautifully into King Dollar, right? I mean, let's be very, very clear. Non-dollar bonds comprise over half of the $59 trillion Bloomberg Global Aggregate Bond Index. Talk to me about King Dollar. I mean, what's it going to take to knock King Dollar off its pedestal?
Well, to me, I mentioned monetary policy divergence. To me, I think if a U.S. recession happens, then that's when the dollar rally ends. We've seen the cycle play out during the great financial crisis, during the pandemic. The Fed is the first and most aggressive to go to zero and to crank up the QE machine. So, if and when, obviously a recession will happen at some point. I don't see one at least for the next 12 months if you look at all the tea leaves. But if and when that happens, the Fed is typically very, very aggressive. And that starts sort of the cycle of this, well, the QE feeds into dollar weakness, low interest rates, et cetera. And then we start this whole sort of cycle all over again. So anyway, I think for the next, I'd say at least 6, 9, 12 months, the Fed is continuing to tighten. The end of the tightening cycle is nowhere in sight. The economy is slowing, but remains, in a sense, robust compared to, I think, what you see in the UK Japan. I mean, it's all about the relative story, right, in FX. And I think despite all these worries about the U.S. economy, it still, to me, stands out as the most resilient and most prepared to deal with any issues.
Win Thin, awesome to hear from you. Win Thin there of Brown Brothers Harriman. He mentioned at the end there the UK. Just from your perspective, Damien, do you sense that currency is becoming more and more EM-like as the weeks go by?
Well, here's the way I have to look at it, and you're kind of opening me up to this. I'm just going to give you a stat here. There are only 4 of 21 emerging market currencies that are up versus the dollar year to date. If you look at it in euro terms, 16 of the 21 are up year to date. If you look at it in yen terms, 19 of 21 are up year to date. So look, I mean, this whole emerging, not diverging, markets, going into this year in terms of looking at EM currencies and saying they're going to be winners and losers. That's true, but it's not true in dollar terms, unfortunately.
We'll turn back to the equity market in just a moment. At the top of the next hour, we'll catch up with Jonathan Golub of Credit Suisse. Let me leave you with this. The median year-end forecast on the south side is 46.50 on the S&P 500. Yes, it is still 46.50. That is 1,000 points, Lisa, above where we closed yesterday.
What did Binky Chadha said that their base case is 47.50, but their bear case was what, 3,000?
Something like that. I think Jonathan Golub is going to have some things to say.
Yeah.
From Credit Suisse. Jonathan Golub joins us next.
The end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're in for a tough couple of months in markets.
We're certainly in for at least the last several years in broader asset classes.
Higher rates or lower rates are going to be very challenging for equity markets.
These central banks just have to try to assert control and just calm markets.
I think there's an opportunity coming. I just think it's too early.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Damien Sassower is in the seat. TK is away today. Equity futures are higher by 0.9%. The damage done year to date so far, Lisa. The S&P down 23%. The NASDAQ year to date down 32%.
Is it enough? And that's what a lot of people are talking about. If we do go into a recession, what some of the drawdowns would look like and how much more pain there is. The range of potential outcomes have gotten as wide as I have ever seen them. I just keep going back to that range that Binky Chadha put out there of either 3,000 on the bear side or 4,750 on the base case.
Is there a base case anymore? I think people just have a bull case and a bear case. Let's do the bull case, the bear case. The bull case is the damage is done. We've already seen so much selling. It's a buy. The bear case is we've adjusted to rates. We have not adjusted to lower earnings. Which point is the more compelling one, Lisa, right now?
And how much does the stock market have to overshoot on the downside when you do get those earnings downgrades before people start to expect what Andrew Sliman was talking about, which is the next phase, the next cycle, and typically markets do get ahead of that. It's unknown. We don't even know what we're dealing with in terms of multiples. We don't know what we're dealing with in terms of inflation, and we don't know what we're dealing with in terms of growth, and even the companies are having trouble pinning it down.
Damien, we've seen this pain in the equity market for most of this year. What I hadn't seen in credit is spreads really start to blow out, and I think that line in the sand for a lot of people in at around 500 basis points. We took that out just yesterday. How important was that?
Yeah, you know, the question I have, Jonathan, is what is really driving spreads? Most people would have you believe that it's fundamentals, but in my opinion, humbly as it may be, it's technicals. It's secondary market liquidity. And, you know, when secondary market liquidity is getting pulled out of the system because we have quant tightening and the Fed raising rates and financial conditions tightening, it's anyone's guess where they go. And remember, we're not talking about equity valuations where they have a floor of 0. We're talking about spreads where they can just go.
Is that a fancy way of saying stress, that you're seeing stress in the credit market?
Not quite the way I expect to, but I think we will have to before all is said and done.
Lisa, what do you make of those cracks?
Honestly, you're gonna really rail into me.
I'm just, you know, just winding you up, just getting you going as the morning progresses.
You know how I'm gonna sort of tarnish my brand, but usually I'm this big bear, and the wider that spreads get, and the more that yields go up, the more I understand the bull case for some of these instruments. Honestly, but you look at it, people have been complaining about no yield for years and years and years. These companies have fortress balance sheets. They're not going to have to roll over their debt in the near term. You're seeing this, and I understand the case for people who are starting to see value.
So this analysis, just to be very specific, is on a fixed income side of things, not on equity.
I'm not going to pretend
in
to know
credit or in the sovereign space, in treasuries.
I would say treasuries are anyone's guess because we just don't know. I mean, everybody's trading off every inflationary print. But on the credit side, if you look at the fundamentals, to Damien's point, the fundamentals are not showing the same stress that the pricing is. Maybe they will, right? Because markets tend to get ahead. But this is the dissonance and the tension underpinning the lack of volatility paired with suddenly yield.
It's a case away and you're getting constructive.
I'm not going to go. I'm just making.
It's
I have to. Okay, let's just.
I nudged her. You can blame me.
Was that you, Damien?
Yeah.
You agree, don't you, Damien?
Of course I do. No, absolutely. I like fixed income here. I mean, look, I mean, you're absolutely right. Relative to recent years, I mean, my God, I mean, you get a positive yield now. I mean, go figure, right? 60-40 is back in vogue.
You guys aren't alone. We mentioned it earlier this morning. We heard it from David Stubbs, who said that bonds were back. Scott Minerd earlier this week, Lisa, as we were starting to push 350 on a 10-year, was thinking about the same kind of thing.
Exactly. I just have to say that a listener writes in, a terminal user, are you hungover?
Are you hungover?
Bull. I mean, there is this idea that, I have been bearish for so long, but if you're going to see suddenly yield and you're going to see an economy that isn't falling off the rails yet, you can make every argument under the sun. We don't know, but I understand.
Someone gave Bramo TK's tank. That's what happened here. Equity futures on the S&P. Drink.
It's clear.
Up 0.9% on the Nasdaq 100. It might be something else. Up by more than 1% on the Nasdaq this morning. Bouncing back. On the S&P this week, we're down about 6%, heading for the biggest weekly loss going back to the pandemic. It has been that bad. Yields higher by a couple of basis points, 321.62. Before we started this segment, we talked about the median year-end forecast on the south side on Wall Street. It's still 46.50. Jonathan Golub joins us now, the Chief U.S. Equity Strategist at Credit Suisse. John, great to catch up with you, sir, and thanks for coming into the studio too. You've been constructive on this equity market. It's been difficult. You can't get them right all the time. Walk me through what you're learning as this year progresses and how you're thinking about the future now.
Well, I think you guys are actually right on point. So let's start with Damien's comments. Credit spreads have blown out, but there's not a credit performance problem. And what I mean by that is, people are paying their, are making their interest payments, and people aren't going bankrupt, and companies have lots of cash, and they've termed out their liabilities, so they don't have this rollover risk. So the credit is performing as if we have this incredibly healthy economy, and yet you have credit spreads really wide. And I think one of the things that are going to drive equities higher between now and year end is if we don't have a recession between now and the end of the year, which I think is unlikely, then I think that the credit spreads actually come down because there's not a credit problem, and yet the market is pricing one. Now, there's a second issue, John, which you raised, which is so far, year to date, the market has really discounted a higher cost of capital, not a recession. And people are saying, is the market discounting an earnings problem, this, that? Not really. I would say, though, the last week, the market is starting to say it's not just a higher cost of capital or a higher discount rate. It's actually the damage that the Fed's going to do, and are we getting a recession sooner? And there, I think the debate is, it's a simple debate. It's hard to figure it out, is when does the recession start? If you think that we have a recession in 6 to 9 months, the downside from here is substantial. If you believe that the recession is in the latter half of 23 or further out, then you got to buy stocks right here because the earnings will come through and there won't be an earnings problem.
Jonathan, I wanted to go there, the range of outcomes and just how big the extremes are. I just go back to what Andrew Hollenhorst said. Volatility may prevail now that the market will reprice Fed policy based on each monthly inflation reading. How wide is your bear case scenario and your bull case scenario?
Lisa, so we actually put out a report yesterday, which was it was kind of like a wonky report for guys who kind of love market internals, and it got a lot of attention. We looked at the dispersion of analyst estimates. So let's say you picked the stock, Microsoft, and are all the analysts clustered at a very similar outlook, or are they all over the map? The more that the estimates are all over the map, the more it tells you that people are concerned about recessionary outcomes and the direction of the economy. And we're seeing that in 9 of 11 sectors, you are below average in dispersion, meaning that there's very little doubt from analysts on the direction of profits. Now, where did the analysts come from this? It's not like they're pulling it out of their head. They're talking to company management, and company management is saying we actually have a surprising amount of clarity. Things seem okay. We're not seeing stress with our clients. Margins are under pressure, but a little, not a lot. So it was actually pretty surprising to me when we looked at the data, how clean the earnings story looks, not only in terms of the earnings being good, but how there's this pretty high level of conviction on both the part of company management and Wall Street analysts.
Well, Jonathan, I think, we've seen the two main factors that are driving, equity earnings expectations, I think, are rising bond yields and higher commodity prices. So my question for you is the pace, are you comfortable with the pace of downward revisions going forward? Do you think it's going to accelerate, or, are we there yet?
So if you look year to date, the earnings revisions have been solidly positive. So let's say at the beginning of this year, if you look at the 12-month outlook for earnings, and then you do the same thing today, we're 7.5% higher than we are. So the market's down, what, 23% or something like that. But you have a positive 7.5 on the earnings and a negative 31% on the stock multiple. So it really says is we have a problem. Yeah, listen, you have cash flows. You discount them at a higher discount rate. They're worth less money. And it makes sense that people would say, yeah, but maybe the market's really telling you the earnings aren't good. I don't think that's the case. I think that what you have is a real downgrade to what you're willing to pay for $1 of earnings, not the other way around.
John, we've got to finish on this. Everything you've said, is it enough to get us back towards 5K on the S&P?
I think the answer is directionally yes. I think that right now the market is really oversold. If you look at the way that how intense the daily moves are and how much volatility there is, the key is that we have to be confident that the Fed's not driving us into recession. If we start to see, for example, the next couple of job reports, if we see God forbid, a negative print where you actually have a loss of jobs or something, well, then the market's going to freak out and you're looking at much lower numbers. But look at what we've had. The ISM, which is an indication of industrial activity, well above normal. The last job report, very strong in terms of jobs. Earnings season, really big beats. So I think that ultimately the fundamentals win out. But I will tell you that the last week or so shakes everybody's confidence.
In a big way. John, I'm just going through the numbers, and I don't want to beat up on you. You're not alone. I've got Oppenheimer at 53.30 year end. You're at 4,900. Got Bowski over at BMO at 4,800. Got others, Bank of America, Savita, who hasn't been constructive, Savita Subramaniam, at the best of times, and she's at 4,500. I just wonder, as an analyst, as a strategist, John, and you look at this market run away in the other direction, what do you have to do? What should you do?
Well, I mean, so we actually lowered our numbers. I don't know, about 8 weeks ago, a little bit, and when we went back to the to the pieces, we're not. The right thing to do is not to forecast a market. It's to say, okay, let's start with the earnings. Are my earnings right? Are they too high or too low? When we went back and tested them, and the earnings, if looked incredibly solid. I mean, we looked at our numbers and said, if we're going to make a change, maybe we should move them higher. I mean, the earnings were looking pristine. Some of that is more coming from energy, but nonetheless. And then we look at the multiple, and this is why we actually lowered our estimates a little while. Is like, no, I mean, you have to lower your expectations for stock multiples, for PEs, when the cost of capital goes up. Now, if we were to downgrade our number, it wouldn't be because we think that our earnings are off. Yeah. It would be because we say, listen, these those credit spreads that Damien was talking about before, if they stay wide, then stocks can't rebound. They have to come in.
I had to squeeze that in, John. It's good to get your perspective. Jonathan Golub there of Credit Suisse. Equities up by about 1%. Next up, we'll hear from the White House. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. Ukraine is one step closer to becoming a member of the European Union. Bloomberg has learned the European Commission has recommended Ukraine be granted candidate status with conditions that Kyiv will have to meet in the future on the rule of law, justice, and anti-corruption. It's significant for Ukraine, but there's no fast-track path to speed up the arduous membership process, which can normally last more than a decade. BNP Paribas has expressed interest in a potential acquisition of Dutch consumer lender ABN AMRO Bank. Bloomberg has learned France's biggest bank recently reached out for a meeting with the Dutch government to discuss its interest. Shares of ABN AMRO rose as much as 18% on that news. Cross-border European bank mergers have been rare in the last decade as negative interest rates weighed on results and executives waited for progress on a banking union in the bloc. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
The 75 basis point move I thought was a bold one. He wants to send the signal that the Fed's committed to not letting inflation expectations get entrenched in corporations and pricing. And in the meantime, I think clearly we have to do everything we can to get the supply chain open.
That was Congressman French Hill of Arkansas on a range of issues this Federal Reserve and this White House is facing at the moment. From New York City this morning, good morning. Alongside Lisa Bravitz, I'm Jonathan Ferro, together with Damien Sassow. TK out of the building, equities higher. No correlation there, I'm sure, at 1% on the S&P 500, on the Nasdaq 100 up by 1.2. This inflationary backdrop is a big challenge to everyone in this country. It's a big challenge to this White House too, and I'm pleased to say that joining us now is Heather Boushey, the member of the White House Council of Economic Advisors. Heather, fantastic to catch up with you. You guys are taking this very seriously. The Washington Post is out with a story this morning on a range of issues, proposals that you're putting forward at the moment. One of them is imposing price controls and banning exports of U.S. energy. And I'd just like to know, first up, how seriously we should be taking that reporting this morning.
Well, certainly, as the president made clear over the course of this week, all options are on the table in terms of energy. He sent a letter this week to oil refiners to say, hey, you all need to do your part. And that was part of showing just how important this issue of inflation and gas prices is to the president. He understands that this affects war by Putin in the Ukraine that has upended oil markets, leading to shorter supplies and increases in prices. But one of the things we also know is that refiners are, there's a gap now, a growing gap between how much they are paying for the oil that they bring in and how much they are charging at the other end. That gap used to be about 50 cents. It's now over $1. And so that is one of the things that the president is focused on this week. And then, as he said in the letter to them, he is willing to use all of his powers that he has available to him to take next steps, but he wants to talk to them first, figure out what they can do together.
Heather, let's flesh some of this out and give me some time to do so if you can. I'll go through it. This is what the president said. Exxon made more money than God this year, buying back their stock and making no new investments. A quote from the president. This is what Exxon said. Globally, we've invested double what we've earned over the past 5 years, $118 billion on new oil and gas supplies compared to net income of $55. This is what the president said. At a time of war, historically high refinery profit margins being passed directly onto American families are not acceptable. He's alluding to them deliberately holding back capacity, alluding to price gouging. You've done the same. Your own Energy Information Administration has reported only recently that the industry was working at incredible levels of capacity utilization of over 94%. Your own Treasury Secretary has said it's not price gouging, it's demand and supply that's largely driving inflation. So, Heather, my question to you, and thank you for allowing me to flesh that out, is who's giving the president these talking points, because they do not add up?
Well, here's the thing. One of the things that we have seen, again, in large part due to both the pandemic and the war in Ukraine that Putin has been waging, has been there has been a capacity at refiners globally that has been taken offline. So over the course of the pandemic, here in the United States, about 800,000 barrels per day were taken offline. And so the president is saying, hey, can we work together to figure out how to get that back online as quickly as possible?
Heather,
Let's
I hear you,
increase
but
that
the
capacity.
president's not just doing that. He's suggesting something nefarious is going on here at the same time. That's the politics of it. I hear it. He's alluding to price gouging. He's saying they made more money than God. They're buying back their own stock. They're making no new investments. Yes, they are buying back their stock. Yes, they are also making investments as well. As I said earlier, your own Treasury Secretary says this is supply and demand. We're having a policy conversation. The president isn't. He's speaking just about politics. He's trying to make out something nefarious is happening down in Texas.
That is not true.
I've just read out all the quotes, direct quotes. Which bit of it isn't true?
It is not true. The president is having a policy conversation. He is looking at the data and the evidence in front of him about what is happening in this industry. And what you cannot deny is that the last time that oil barrels were priced at 120 barrels, $120 per barrel, gas prices at the pump were about $4.25. Now, at this same price level, of course it fluctuates every day, but now at this price level, you're seeing prices at the pump of over $5. There is a gap there, and this is what the president is focused on. That doesn't, obliterate anything that has happened in between, and yes, certainly investments have been made, but the president is saying, what more can we do? Yeah. Because we need to get this oil supply to consumers at this moment. People can't very quickly change their demand for gas. People need, drive their cars to get to work. So he is focused on what else the refiners can do. And there is evidence that they are bringing in exceptionally high profits, and that there is this gap between the prices that they are paying and the prices that they are charging that is larger than before. So that is all evidence, and that is still about supply and demand.
Well, but Heather, let's say you cannot get that supply on in the way that the president would like in the short term. How worried are you about essentially going against what the Fed is trying to do with dampening demand by things like rebate cards or subsidizing the prices of gas and other goods at a time when the Fed ultimately is trying to get demand to come down?
So that is such a great question. You've elevated how this particular economic moment is very tricky because we have so many supply side challenges. As Jay Powell himself noted, the Fed's tools are blunt and they are essentially on the demand side. But we have these, and we've seen them over the past few years, these incredible supply chain snarls. We're seeing these challenges in large part because of the pandemic. And so that is why the president has had a multi-pronged approach to figure out all of the different ways we can attack where prices are too high for consumers.
We don't have a lot of time left, but just quickly, the point is that it's very hard to deal with the supply chain disruptions, and it takes time. So without that really getting remedied in the short term, why is it good not to just see demand come down a little bit?
Well, certainly the president is letting the Fed do their job. But, so yesterday, the president signed new legislation on ocean shipping. Here's a place where that legislation and the work that the Federal Maritime Commission is doing right now could have an impact on prices that consumers pay for goods that are being shipped from overseas. So the president is doing everything he can to lower prices using all the tools at his disposal and trying to work with Congress to do so.
Heather, I promised I'd let you go at 8:25, and there's 5 seconds left, so I'm going to do exactly as we promised. Thank you for catching up with us today. Heather Boucher there of the Council of Economic Advisors. Lisa, this is a really, really sticky one. It's an incredibly sticky one. And the president, and of course Heather Boucher's got a view on this, a perspective. And we gave her the time to say what she had to say. But what he's saying and the facts sometimes on this do not stack up. You can't reconcile the facts with some of the things he's saying. For one, the investing, can't reconcile it. With the price gouging, their own Treasury Secretary is saying it's not price gouging. At the same time, they're going around saying it's price gouging. So something's going wrong there.
And there have been a lot of different messages, and they aren't necessarily always cohesive. President Biden has a difficult moment. There also is this recognition that there are certain things they don't have control over. The speed is what I'm concerned about.
Equity futures right now at 1% on the S&P 500 from New York City this morning. Good morning. This is Bloomberg.
En nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic. We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Live from New York City this morning. Good morning to you all on TV and radio. This is Bloomberg Surveillance alongside Lisa Bravitz. I'm Jonathan Ferro. Tom Keane out of the building. Damian Sassa into the seat. Equity futures look like this on the S&P. On the Nasdaq, we're positive by more than 1% on the Nasdaq 100. On the S&P, just short of that level, up 0.9%. Yields up a couple of basis points, 321.62. I want to jump straight to this conversation with Drew Mattis, who's going to give you a different perspective of things. Chief Market Strategist of MetLife Investment Management. Drew, you think this Fed's getting it wrong. That's not new. A lot of people see it that way. You think they're getting it wrong for different reasons. Can you run us through it?
Yeah, I think whenever you're talking about the Fed containing inflation, right, the thing I hear is they have to do it. They have to contain inflation. It's their imperative, and they have to do whatever it takes, including a recession, to get us into a lower inflation environment. What I think people miss is that there's always a trade-off between growth and inflation. And we know how to solve the inflation story. We saw that actually in March of 2020. You can just shut the economy down, inflation will come down. Right. So really, the Fed's job is to manage inflation lower in a way that causes the least amount of damage to the economy over time. And I think in this case, by not really getting investors to think about core inflation and not taking the signals that longer term inflation expectations from professional investors are giving them, they're actually rushing ahead to solve a problem that can't be solved by their interest rate hikes.
Drew, there's a debate right now of what's causing inflation. There are a lot of debates, there are a lot of unknowns, but one of them is this more demand-driven and more supply-driven? The president is saying this is largely supply-driven and pushes back on the demand-driven side, saying it was not necessarily the stimulus checks that were sent out last year. Are you also saying this is completely a supply issue, not a demand issue, and has to be entirely fixed on that end?
No, it's both. It's both supply and demand. There are clear supply chain problems that are creating inflation pressures, but there's also a demand story. And so really what the Fed should be saying is we're not targeting 2% inflation because 2% inflation is in a normal environment where supply chains are functioning. We are targeting core inflation, so absent food and energy, because we can't control food and energy prices. And we believe this portion of inflation is due to supply chain issues, which we're also not going to solve with interest rate hikes. And if they did that, if they recentered the conversation, they could stop worrying about credibility. They have credibility. If you look at five-year inflation expectations, you look at longer-term inflation expectations, the market believes the Fed is going to strangle inflation. They're going to stop it. It's going to end, and it's not drifting into the longer end of the yield curve. By continuing to say that you can stop inflation now, whip inflation now, right? It was the old comment, and it's a shame Tom's not here, or else I would have gotten him started on something. But if you keep focusing on shorter-term inflation pressures you can't control, you will lose credibility because no one believes that you can do that.
So, Drew, let's say that they go ahead with what they've said that they're going to do and try to dampen demand to offset the lack of supplies or some of the supply chain disruptions. How bearish are you? I mean, do you basically think that this will be a Fed policy error, the likes of which we haven't seen in decades, and will cause you to hide out in cash?
There's been a series of Fed policy errors this cycle, and I think the main one really, and a lot of people have alluded to it on your show, which is, they just didn't start soon enough. They knew there was a problem, and instead they continued quantitative easing. They continued hiking rate or lowering rates or keeping rates low when they could have moved earlier and the market would have accepted it and actually appreciated it. And instead they waited, and now they're trying to play catch up. And there really is a difference between doing a series of 25 basis point moves over half a year or 3/4 of a year and trying to get there all at once. It's not a linear movement in terms of the market response to 25 basis points, 3 25 basis points moves versus 75. And I think that's why you're seeing the market behave the way it is because the Fed seems a little disjointed here. They told us 50, then all of a sudden it was like, oh no, we're going to go 75 after they ruled out 75 the meeting before. Nothing really changed all that dramatically. There was a slight uptick in inflation expectations on one survey. So it doesn't really justify the kind of swings we're seeing in Fed policy. And I think that should probably make everyone nervous.
Drew, last month's Fed minutes, flagged the potential hit to U.S. Treasury liquidity due to quant tightening. And, here we are. We've got $522 billion of runoff expected between now and year end. There's been a widening of bid-ask spreads in the 10 and 30-year tenor. And next week, we've got $160 billion of Treasury auctions coming. What are you looking for there? What's your confidence in dealers' ability to intermediate in the Treasury market?
I'm not actually overly worried about that at this point. I don't think we've seen a lot of movement. Quantitative tightening is going to happen over a very long period of time. It's not always going to be pushing more supply into coupons, right? A lot of actually what's going to roll off, what the Fed's going to allow to roll off, is actually going to get pushed into bills, where there actually is a kind of a decent demand for them. And so I think as we look ahead, the real impact of quantitative tightening it should be to actually lower inflation over time. And I know it's kind of out of favor to look at the size of the Fed's balance sheet and look at inflation. But if you look at it historically, there actually is a little bit of a relationship there, a little bit more than you would imagine, given the fact that people really don't like the MV equals PQ equation. Money times velocity equals nominal GDP. People have kind of said that doesn't work. If you really dig into the balance sheet, there actually is a little bit of a relationship there. And so you have to wonder, what's actually been causing this inflation pressure? Yes, it's the government sending checks out. It's the increased demand. But at the same point, there's clearly, in my mind, a balance sheet component to it. And as we move that back towards normal, that should alleviate some of the problem.
Drew, you mentioned Fed credibility, and I just have to ask this question. 75 bips, do you think they actually gained credibility by going 75 bips to fight inflation, or did they lose it because they clearly flagged 50 bips? I'm just curious to hear your thoughts on that.
I would say it wasn't helpful. I would have, they had laid out a path of 50s. Extending that path, I think, in my mind, would have been more reasonable. One of the ways we look at Fed credibility is the relationship between real assets and financial assets. And up until a few weeks ago, they were actually doing quite well, historically speaking, in looking at that relationship. And as of late, that relationship between those two, the relative value between those two, has been shifting, which suggests that kind of the recent Fed movements are not well understood by the market to actually be supportive of kind of a longer-term, limited inflation dynamic. At the same point, though, five-year inflation expectations continue to stay low. And that is really what they should be hammering, which is we cannot contain food and energy inflation. And historically, we've never tried to. But what we can tell you is that inflation's not going to be this high once we get through this period. And define the period or not, it doesn't really matter. But telling people that you can affect inflation now is probably not great. I took some comfort from the economic projections. I know a lot of people don't think that they're all that reasonable, but if you look at their core PCE projections, core PCE has been coming down. They have core PCE continuing to fall in a way that's I think realistic. And so it's still going to be above 4 at the end of this year, according to them. But I think if they were to kind of take a step back and say, hey, you know what, we target 2, we're willing to accept 2.5, and we have a supply chain dynamic that maybe means it should be closer to 3.5, it really would suggest that they're actually getting much more momentum towards their goal. And I think it would comfort people to understand that there is a stopping point for the Fed.
Drew, just quickly, your analysis is a little bit different. We started the interview that way. You provided that analysis for us. Can you tell me how your investment approach is different? What's the big market call that sets you apart as well?
Well, so we live in the same world that everyone else is in, and so there's a big inflation component to it. There's a weakening growth story. The retail sales numbers, which got completely ignored, but which were, in my opinion, one of the worst things that I've seen in a while. There are all these signs that growth is slowing, and you have growth slowing, you have inflation rising, and when you look at that, certain assets tend to do better. MetLife is a big real estate investor. That's helpful for us. We're also big ag investors, helpful for us. And then, of course, there are opportunities within credit. You just have to be careful.
Do you have to be careful in real estate right now, Drew?
You have to be careful everywhere. I mean, we're in an environment.
Particularly real estate facing the mortgage rates it is right now. It's pretty brutal.
It is. But that's actually another kind of interesting point you bring up. You're raising rates, so you're raising mortgage rates, so you're pushing more people into renting when we have an issue with rental demand. And so, once again, just because you're hiking interest rates doesn't mean everything you're doing is going to help contain inflation.
Drew, wonderful final point. Drew Mattis there of MetLife Investment Management. And I can tell you repeatedly in the commercial breaks for the last 3 hours, that point is the point that Lisa Rabbit has been making repeatedly.
Well,
Lisa, you're thinking about that a lot, aren't you?
Well, because if you look at the CPI components, this is one of the biggest components is rents. And if you start to price people out of the mortgage market, you price people out of home ownership, that keeps them in the rental market. It actually jacks up rents even more. And to Drew's point, he's talking about this, they're buying up properties because they can raise the rents. I'm not saying he's going to raise the rents, but that's a steady source of income that can be pretty sticky considering the lack of supplies that we're getting in the housing market.
Will you write a column on this for us this weekend?
Don't get ahead of me. Yes, you're going to try to front run me. Yes,
no, good. That's exciting.
Yeah.
I'm looking forward to reading that.
Thank you.
On the plane, away from here. Lisa, thank you. And Damien, thanks for jumping in the seat as well. We appreciate it, mate. Just fantastic. Final call from you. Rory, does he get it done on Sunday?
I just have to ask you this question. It's really for Lisa. Lisa, you're here every day, 5 days a week, 3 hours a day, and not once do you ever try to speak in a British accent? Just a little bit, Lisa.
How much money are you getting paid for that?
A little bit.
Seriously, are you trying
I
to?
gave you the floor to make a golf call, not to come after me. And
no,
the country.
What? I would never do that. Jonathan, never. Come on.
Coming up in the next hour, away from these two, Mohammed Al-Arian, Bloomberg opinion columnist and Queen's College Cambridge president on Bloomberg TV at 9 a.m, counting you down to the market omen. Devin, thank you.
Thank you, Jonathan.
Awesome. I think I called it the market omen and not the market open then. Make of that what you will. Futures on the S&P up 0.8 of 1% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden will convene world leaders from roughly 24 countries in a summit today focused on propelling the fight against climate change. The virtual summit is on track to be the largest gathering of world leaders focused on climate action ahead of a critical United Nations summit in Egypt this November. Biden will highlight the war in Ukraine as evidence of the need to accelerate the clean energy transition and bolster food security. A cross-asset sell-off for the ages is shaking the conviction of money managers around the world, yet Cliff Asness remains steadfast in his belief that value investing can keep winning as the quant strategy notches heroic gains in a year to forget on Wall Street. The co-founder of AQR Capital Management tells Bloomberg there should be more gains to come.
So we are still kind of maximally excited at value. A year and a half ago, you had to say, damn momentum, I'm ignoring it. This is ridiculous. You now have something that's not quite as ridiculous, but something I didn't think we still have prices I didn't think I'd see again in my career going on now. So we love value still going forward.
Sweden's Riksbank has named a new governor. Stefan Ingves will leave the central bank at the end of the year after 17 years of steering monetary policy in the biggest Nordic economy. He will be succeeded by Erik Thedéen, who now heads the Swedish Financial Supervisory Authority. The news comes as the Riksbank has made a momentous policy shift. The central bank is addressing a surge in inflation and is under pressure to speed up rate hikes it flagged back in April. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think space, you probably think One space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I'm here at the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
We've underestimated inflation. A large part of why inflation has been revised up, our forecast has been revised up through time, has been the incidence of these new shocks. Shocks by nature we couldn't anticipate. Monetary policy just cannot respond quickly enough or have an effect quickly enough to bring inflation down in the short order.
Hugh Pill, chief economist at the Bank of England, after them raising rates by 25 basis points, the expectation was potentially for a 50 basis point rate hike. Damien Sassower is putting on a British accent here alongside me. Lisa Abramowitz, Jonathan Farrow off to his next property. Tom Keene having a nice extended weekend. We've been talking all week about the pound and how weak it is and how it really is between a rock and a hard place for the Bank of England. And then someone comes out after writing a book with incredible expertise on the history of crises in England, and that is no one other than Sir Howard Davies, who is chair at NatWest Group and author of this book, The Chancellors. Sir Howard, when did you start writing this? I mean, honestly, it comes at such an amazing time of crisis where people are looking for history and anything as a guide.
Yeah, well, it was a lockdown project. I felt guilty in the lockdown. I had to use somehow the time that I was saving. So I thought, well, maybe it would be a good point at which to reflect on the history of the last 25 years, which has been pretty exciting in the UK. We've had the great financial crisis, we had Bank of England independence, we've had Brexit referendum, Scottish referendum. And I asked the various chancellors who'd served through this period if they were prepared to reflect on it. And of course, they had time on their hands as well. So in fact, they were very happy to talk to me about it, as indeed were quite a lot of officials. So what I've tried to do is to tell the story of the last 25 years as seen from the Treasury, which turns out now to be quite a relevant thing, I think.
Sir Howard, we were talking earlier this week about how the Bank of England raised rates because they were concerned. They raised rates only 25 basis points because they were more concerned about the labor market softening or perhaps consumer demand getting crimped and discretionary spending than they were about the inflationary inputs that continue to create huge pressures on the economy. Was that the right move based on all of those conversations you had?
Well, I think I was with the three in the minority. I mean, it was a 6-3 vote on the Monetary Policy Committee. Interestingly, of the 4 external economists, 3 voted for a 50 basis point rise and 1 voted with the Bank of England insiders for the 25% rise. And I was with the 3 out of the 4 externals, I have to say, because I think one of the problems that we have, and you just referred to it, is that the weakness of sterling is contributing to inflationary pressures as well. And if you look back at the experience of oil prices, and one reason why we're now facing a £2 a litre diesel price is because the pound has slipped down to 120 something. And it's not long ago that we were at 140. So we are making our problem more serious by the fact that sterling is weak. And I think in part, that is weak because of the perception that rates will not rise as much here as they're going to rise in the US.
Sir Howard, you rightly call out central banks for openly claiming that they can't tame inflation, but in reality, they can. I mean, they have a blunt tool. They can raise rates, choke demand, and drive an economy into recession. My question for you is there any way that central banks can do that without driving an economy into recession? Are there other policy tools at their disposal, or perhaps it's not providing as much forward transparency? I'm curious to hear your thoughts on that.
Yeah, I think what's one got to look at is the time dimension here. And obviously, if you get a very sharp exogenous shock, like an oil price increase on the sort we've had and the war, then you can't expect central banks to deal with that instantly. But in fact, the inflation target formula explicitly recognizes that. And inflation targeting is meant to target an inflation rate at 18 months, 2 years ahead. So I think whereas I can accept the central bank saying, look, we can't respond to this immediate spike, that's fine, that's understood. But what they must do is present a plausible path of interest rates, which is going to deliver them back to the inflation target in 18 months or 2 years' time. And that's why I think you need a higher rate at the moment in order to give credibility to this medium-term inflation outlook. And I don't think that's where we are at the moment, unfortunately, in the UK.
Well, Sir Howard, let's tear up the script a bit. You've been a member of the International Advisory Council for the China Securities Regulatory Commission since 2003. There's about 200 China listings on U.S. exchanges, I think roughly 1.7 trillion in assets. With all that's going on, with the lack of transparency with the PCAOB, I'm just curious to hear your thoughts on that. I mean, what is China's approach to all this? Do you think companies like Baidu, JD, I mean, are they going to avoid having to delist in the near term?
Well, the Chinese approach is evidently changing. Up to now, the CSRC, the Chinese equivalent of the SEC, if you like, has had a general policy orientation towards opening up Chinese markets. They've established a link between Shanghai and Hong Kong, a link between Shanghai and London, and that's been the direction of travel. Now, there are, however, signs recently, as you say, of the Chinese wishing to pull back because they're unhappy about the influence that external regulators have via a Chinese company listing in other markets. I think it's very difficult to say at the moment where this is going to go. And of course, for the last 2 years, COVID has got in the way of direct connections. You know, I remain on that advisory council, in fact, I'm chair of it, but we haven't actually had a physical face-to-face meeting, and it's in the face-to-face meetings where you really understand what's going on. So I'm not trying to avoid your question, but it's honestly quite difficult to answer in circumstances where you haven't actually met people for well over 2 years now.
Sir Howard, before we let you go, do you think that the pound is ever going to get above that 145 mark versus the dollar that we saw pre-Brexit?
Unlikely would be my guess. I can't quite see why, There are the short-term issues we've been talking about involving interest rates, but also in the longer term, we do have a structural trade deficit, and that's been offset by capital flows for a long period of time. But you can only sell the London property market once externally, net, if you see what I mean. They can trade it amongst themselves. You can only sell it once. So I don't see quite what is going to push the pound up.
Sir Howard Davies, thank you so much for taking this time, and congratulations on writing this book. I do want to bring you some headlines from Fed Chair Jay Powell, who has been speaking, saying that the Fed is acutely focused on returning inflation to 2%. But Damien, I was struck by him saying that the dual mandate hinges on ensuring financial stability. Is this code for saying that they are starting to get concerned about some of the liquidity concerns that you were talking about earlier?
Well, I think they've been concerned about it. I think he's hedging. I mean, look, what we're talking about is policy optionality, flexibility, something that Chair Powell really just hasn't been very good at to date. So, for me, that's what we're looking for. I'm sure it's a step in that direction.
Meanwhile, we are looking at something trying to be a rebound, although fading through the morning. S&P up 62, 36.93. Nasdaq up 0.8%. You could see Treasury yields just edging downward a touch, especially on some of these headlines. Coming up in Balance of Power, Steve Ballmer, owner of the Los Angeles Clippers. This is Bloomberg.
Connection lost.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Let's get this week finished with what a brutal week for equity market bulls. Equity futures this morning positive from New York. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, wrapping up another messy week in markets.
The equity market continues to be very sentiment-driven.
Really rally in risk assets is going to be short-lived.
Really don't think there's anywhere to be hide.
Global yields rising.
Sustained bear market.
Discretionary sectors, for example, you can see the real pressures.
What we're focused on this summer is increasing the liquidity of our portfolios.
Recession risk is uncomfortably high, but at least the market knows that.
Every central bank, as we all know, is dealing with its own unique inflation growth dynamics.
Central bank sentiment and central bank moves, they're affecting each other.
The trade-off it faces, this kind of invidious choice.
More than likely more pain to come in broader markets.
A lot of people are wondering if it's time to sell or time to buy here.
Let's have that conversation right now. Joining us is Bloomberg opinion contributor Mohammed Al-Arian. Mohammed, fantastic to catch up with you, sir. Let's start with this Fed. Based on what we heard this week, has the Fed just committed to driving us into a recession?
That is an unfair question because the Fed has no choice but to confront inflation. So in doing so, and because it's late, yes, it has increased the probability of a recession. But the original sin, John, was committed last year. And once you start from such a suboptimal position, you end up in this dilemma, which the Fed has right now, which is going to end up making one of two policy mistakes. Either push the economy into recession with a high likelihood, or alternatively persist with high inflation for too long.
You believe they would take the latter option. Is that still your stance?
I believe they're going to flip-flop. And that's the worst of all three possibilities. That right now they're focused on inflation. As the growth consequences become clear, that they're going to ease their foot off the brakes and then have to slam on the brakes again. And that is my fear, that they will end up flip-flopping, something that we used to witness in the old days with central banks. And I worry that we may see it again. I hope we don't, but I do worry that we may see it again.
Is that weakness clear now, and do you think their dual mandate is in conflict right now already?
So it depends how you define the mandate. If the mandate is strictly defined as employment, no, the labor market is still doing well. If you take it broader and look at growth, indicators are that growth is slowing down. The Atlanta Fed is at 0 for the second quarter. An average of projections see it coming down below 1%. So growth is slowing down, but the good news is that the labor market is still strong.
So, Mohammed, when Chairman Powell says this line from this morning, the Fed is acutely focused on returning inflation to 2%, how much damage do you think he will have to inflict on the economy to achieve that?
Unfortunately, he's going to have to inflict some damage, John. He's late. He's very late. He should have started last year easing his foot off the stimulus accelerator. He didn't. I always go back to the very simple factoid. The week in March that the U.S. printed a 7 handle on CPI, the Fed was still injecting liquidity into this economy. Just think about that, John. So he's very late, and therefore the collateral damage is going to be significant.
And they carried on doing QE. And carried on doing QE, which is your point. Mohammed, I want to look at the forecast with you and just piece by piece very calmly go through it and ask you which one is kind of out of sync for you. They've got the Fed funds rate, the median for 2022 at 3.4. They've got PCE back down to 5.2 by year end and unemployment at 3.7. Next year, unemployment at 3.9, PCE at 2.6, and the Fed funds rate at 3.8. We've had Scott Minerd of Guggenheim call these forecasts fanciful, fantasy land. I've had another guest call them aspirational. Mohammed, what would you call them, and which one don't you quite fully believe in?
You also had Bill Dudley said they are unrealistic, and they are, okay? And, you know, I have two complaints about this Fed, and I'd really appreciate the fact that they're finally moving and they finally did something meaningful. But two complaints. One is the lack of total openness and frankness about what's ahead. Compare what Chair Powell has been saying to what Andrew Bailey has been saying here in the UK. Andrew Bailey has been much more open. He's been criticized for it, but he's been much more open. He's played the role of trusted advisor. And that's what I think a technocratic central bank should do. It shouldn't get political. But also, John, unlike the ECB, the Fed is yet to explain why its inflation forecasts have been so wrong for so long. So it's not enough for Chair Powell to say he's laser focused on inflation. That's not going to be enough to regain the inflation credibility that he needs. They're also going to have to address these other two issues.
Mike McKee addressing some of those issues in the news conference earlier this week. And pleased to say Mohammed Mike's with us right now. Mike, a lot of people are asking the same question. And we can talk about all the other central banks in a moment. But it's whether this Fed chair is chasing something he can't address, which is energy.
Well, he's kind of forced into that position, as Mohammed was saying. The Fed has to respond to headline inflation because that's their mandate. And it is also, as the chairman explained, what Americans look at, because they're not looking at the core, they're looking at the gasoline prices they're paying every month. The one thing that the Fed has no control over is the fact that this is a worldwide problem. These are all the central banks that in the last month or so have raised their rates by 50 basis points or more. A really, really significant number of countries. So the inflation fight is on. And as Mohammed was saying, that is going to produce some unwanted, if not unintended, consequences. They know they're risking a recession, and the recession indicator, the white line there, is starting to rise into territory that says we're going to have a recession. And not only that, it's going to be a problem for the rest of the world that then blows back on the U.S. That's the trade-weighted dollar in blue. And it just gets higher and higher as the Fed gets more aggressive than everybody else, and that will create problems, especially in a lot of emerging markets with dollar debt. This problem is just getting deeper and deeper. At the top of the show, a lot of the portfolio managers you had quoted there were suggesting we don't know what to do. Well, right now, here's what's going on. Everybody is selling everything because they don't know what to do. And the problem going forward is, what kind of effect is that going to have on the economy as well?
We've unwound 1 year's worth of gains in the equity market in around about 6 months. Mike, thank you. Stay close. Mohammed, I want your view on the market. You've separated it into 3 different pieces over the last few months on this program in our regular chats. You talked about credit risk. You've talked about liquidity risk. There's another risk that I'm forgetting. You can talk to me about it. Mohammed, run me through where you are as you work your way through those 3 steps.
So the first risk was the one you've forgotten, is interest rate risk.
Of course.
And it's the market waking up to the notion that financial conditions were going to tighten because central banks were no longer going to be the provider of massive liquidity and were no longer going to keep interest rates at 0 or at negative. But now with all the recession talk, credit risk has woken up. And that is what we saw yesterday with the bond market rallying and the stock market selling off so violently. Look, John, I think we can deal with both those risks. It's not going to be pleasant, but we can deal with it. It's the third risk that I worry a lot about, which is market functioning risk, liquidity risk. We are seeing pockets of stress, but nothing systemic, which is the good news, but keep an eye on that. John, there is now an acknowledgement that we are entering much more difficult financial conditions globally. But where there's still not enough of an understanding is that this is secular, not cyclical. A lot of people want mean reversion. That's what they're looking for. They think of it as a cyclical pothole. This is not a cyclical pothole. This is a secular phenomenon.
Mohammed, can you build on that? What does that mean for the nature of a possible downturn in the economy? And what does that mean for the character of the market correction too?
It just means that a lot of companies, a lot of activities, a lot of resource allocation in markets that relied on very loose financial conditions for a long time are going to be problematic. You've seen what's starting to happen in the housing market. We've seen it in SPAC. The IPO have basically dried up. Capital market activity has come down a lot. We haven't yet seen zombie companies have to refinance. That's coming down in the next few quarters. So there's a whole host of what I call misallocation of resources that went on in this world of zero rate, endless liquidity injection and general conditioning of investors And unfortunately, all that can no longer be sustained in a secular tightening of financial conditions.
Mohammed, you're raising a really important point, and I want to flesh it out just a little bit more. Are you saying we still haven't fully realised the consequences of unwinding the dominant policy regime of the last 15 years? And what's happening now is something that stays with us for a whole lot longer?
I am, John. You put it much better than I can. That's exactly what I'm saying.
So what does that mean for the losses we've experienced in this market? Because typically, when a bubble bursts, and you can tell me if that's what you think it is, sometimes they're not lost years, they're lost decades. And I'm trying to work out which one we're experiencing right now.
So the big difference, John, from the past is that while the flows are going against the market, the stock of liquidity